I'm Robert McClelland, a Senior Fellow at the Urban Brookings Tax Policy Center, and I'd like to welcome everyone to the 15th Annual IRS TPC Joint Research Conference on Tax Administration. I also wanted to thank Brett Collins for leading the IRS team that put together a great program this year. This year we have over 725 registered participants, including hundreds online, a testament to the ongoing importance of tax administration. I want to go over a few housekeeping items, and then I'm going to pass the microphone. First, the event is being recorded, and the recording will be posted online afterwards. Slides, programs, and abstracts are available online. Members of the virtual audience can type questions into the Q&A form at any time. In-person attendees can use the QR code to submit questions. And finally, if you are speaking, please check in at the green room behind me a few minutes before your session. Now I'd like to introduce Reza Rashidi, Acting Chief Data and Analytics Officer of the IRS.
Thanks, Rob, and good morning, everyone. It is a real pleasure to be here with all of you for this 15th IRS TPC conference on tax administration. I would like to start by thanking the Tax Policy Center and the Urban Institute for partnering with us on this conference and hosting this event in this beautiful facility and online. Next, I'm going to introduce our our opening remarks by our first speaker. It is my honor and distinct pleasure to introduce Dr. Michael Falkender, the 16th Deputy Secretary of the U.S. Department of the Treasury and Acting Commissioner of IRS. Dr. Falkender's distinguished academic and government career includes most recently serving as the Dean's Professor of Finance at the University of Maryland. Prior to that, he served as the Assistant Secretary for Economic Policy at the Treasury, where he helped shape the economic policy, negotiate the CARES Act, and lead the implementation of the Paycheck Protection Program. Dr. Falkender's work has been published in top academic journals, received numerous Best Paper Awards, and has been cited by Wall Street Journal, Washington Post, and the New York Times, among others. It has been it's a testament to his, how he cares about research for taking time off of his extremely busy schedule while serving two important functions to be here today with us. So please join me in welcoming Dr. Falkender to kick off the conference with his opening remarks.
Morning. Thank you for the opportunity to join you this morning for today's conference. It's a pleasure to be with you to talk about from the IRS to make it more efficient and provide excellent service to the American taxpayer. I'm honored to serve as the Acting Commissioner of the IRS. As we await the confirmation of our new IRS Commissioner, Secretary Bessent has asked me to lead this agency and our transformation efforts. Even after the Commissioner comes on board, the IRS will continue to be a significant part of my responsibility as Deputy Secretary, and I look forward to continuing this important work. I'm especially excited to be here today because I come from academia. I'm a researcher at heart. I look at the issues at the intersection of economics, finance, and policy. My work included also being an associate editor of the Journal of Finance and the Journal of Financial Services Research. My research examines the major factors behind company financial decision-making, such as investment, capital raising, and executive compensation. Included in that work was research on the incentives and the disincentives that are in the tax code related to multinational corporations. My academic background has helped me understand the important role that research plays in forming tax policy and ensuring effective tax administration. As a career academic, my perspective on public policy was from outside the government, documenting the outcomes after changes in law or regulation were implemented. I have firsthand knowledge of what goes into developing a research paper and presenting it in front of your peers. So I want to congratulate everybody who has a paper on the program today, because I know the hard work and dedication that you have put in to getting your paper to this point. I think it's important to remember the work that you and other researchers do in the tax area is helping ensure the success of an agency that is vital to the success of our government. It's essential for us to maintain a well-functioning IRS, given that the agency processes the vast majority of receipts that are used to pay our troops, to provide benefits to our seniors, and to make critical investments in our nation's future. During this period of transformation at the IRS, the agency continues to work at full speed and has delivered a successful 2025 tax filing season. Tax receipts this year were up across the board over 2024, and here are some of our highlights. Through the end of filing season, the IRS processed more than 138 million individual tax returns, an increase of 1.5% over last year. The IRS issued 86 million refunds, totaling more than $253 billion, an increase of $8 billion over last year. Call center efficiency remains strong, with wait times averaging under 5 minutes for taxpayers seeking live assistance, and our taxpayer assistance centers provided in-person service to roughly 740,000 taxpayers. While it's important to acknowledge the successful filing season, the IRS still needs significant reforms to deliver efficient and cost-effective, friendly results for taxpayers and the tax system. We are committed to transforming the IRS so that it works better for the American people. Today, I want to outline our goals for that transformation and give you an update on our progress. By taking advantage of historic investments in new technologies, we have an opportunity to reimagine how the IRS serves the American people, making it easier, faster, and more transparent for taxpayers across the nation. We're building a modern IRS that will deliver for generations to come. These improvements will ensure common sense tax administration. I would note that researchers have an important role to play as the IRS strives to increase tax compliance through improved service and better targeted enforcement. Research into tax administration issues will give us new approaches and tools in these areas in the future. Secretary Bessent and I believe that one of the keys to improving the IRS is delivering on the promise of modernization. It's unfortunately the case that for the last 35 years, we have been 5 years away from the IRS being modernized. We will not say that in the 36th year. We are working to complete the vast majority of our modernization efforts in the next 2 to 3 years, and there is no reason why after 35 years, we should still be 5 years away. To reach that goal, we are allocating resources towards making sure that modernization is accelerated and gives the American people an experience with the IRS that is similar to what they realize from their private sector financial institutions. We are learning from the private sector how best to integrate legacy systems into 2025 financial services platforms. Modernizing the IRS will allow the agency to show significant improvement in Secretary Bessent's 3 priority areas of collections, customer service, and privacy. A refreshed IRS will be better positioned to focus its audit resources on the most significant pockets of noncompliance, improve taxpayer access to their own data through the use of modern technology applications, and safeguard taxpayers' private financial information. Now, critics of the president's efforts to improve the efficiency of the IRS have warned that that effort might result in up to a 10% shortfall in receipts. Instead, the opposite happened. April receipts this year were up 9.5% over the previous year, and in May, receipts were up 14.7% over the previous year. Going hand in hand with modernization, another key to transforming the IRS involves increasing efficiency in agency operations. We are committed to ensuring that the IRS prudently spends taxpayers' dollars. Progress is already being made in this area. We have successfully cut $2 billion from the IRS information technology budget without any operational disruptions. We have achieved these cost savings by renegotiating, scaling back, and in some cases eliminating wasteful IT and professional services contracts. As any of you who have interacted with IRS data may know, we have 17 largely independent data files and systems that don't really talk with each other, which means that we have over time unfortunately purchased redundant contracts because each of those 17 systems was essentially siloed. By going through and reviewing the contracts that we have and identifying where we're actually paying for the same service multiple times, we are able to more prudently utilize taxpayer dollars without any impact on service. We have also addressed longstanding inefficiencies, such as these unused licenses that have automatically renewed for years without anyone asking whether they are still needed. These interventions will save taxpayers hundreds of millions of dollars each year. Another way we're making the IRS more efficient is by taking steps to reduce administrative costs with a particular focus on paper processing. We're supporting the President's executive order to reduce delays, unnecessary costs, the risks of fraud and lost payments, theft, and inefficiencies by decreasing paper-based transactions. Last year, the IRS spent approximately $450 million on paper processing. Using modern scanning technology, we aim to reduce that expense to less than $20 million. These gains will be accomplished through our Zero Paper initiative. The IRS is working to eliminate paper-based processes across the agency by digitizing forms, approvals, and workflows in ways that improve efficiency, access, and sustainability. As part of this initiative, we are committed to removing the physical aspects of paper across the IRS submission centers. As this paper becomes data, we will leverage a continuous delivery method to update and maintain data-driven solutions for yearly updates to forms and tax changes. Another way the IRS will achieve efficiency gains is by harnessing the opportunity of new technology, especially artificial intelligence. I would note that your session on leveraging machine learning is especially timely in relation to what we're working to achieve at the IRS. Our use of modern technology tools such as AI is especially important to our efforts to improve tax compliance. As I've learned in my time as IRS Commissioner, non-compliance amongst taxpayers largely occurs for two reasons. First, the vast majority of it is that there are taxpayers who make inadvertent mistakes when trying to comply with the requirements of a very complex tax code. To the extent that we can modernize IRS systems and use AI to facilitate improvements, we can provide better guidance and clearer information to taxpayers who want to comply. Second, we do know that there are those who willfully avoid their tax obligations and try to cheat the system. Data analytics and AI will facilitate our ability to determine where there are pockets of purposeful non-compliance. Think about it. Bringing in large numbers of unseasoned collection agents, as was done in the past, is not an efficient way of increasing these collections. Efficiency gains in compliance are more likely to be accomplished through the use of modern technology such as AI. If we can improve our modeling capabilities because we have more data and better technology that will allow us to better identify areas where purposeful non-compliance exists, that in turn will help us reduce the resources spent on false positives and audits and improve service to taxpayers who are doing their best to comply. Tax compliance has always been a ripe area for study, and your conference sessions on business compliance, investigating filing behavior, and understanding the tax gap are all in line with the major issues that exist as we strive to increase voluntary compliance across the board. As this administration works to transform the IRS, another top priority along with customer service and compliance is enhancing cybersecurity. We are committed to maintaining the security of Treasury systems, including at the IRS, and to safeguarding sensitive data against ongoing cyber threats. The IRS is strengthening privacy by empowering technical cybersecurity experts and reducing system complexity. Historically, only a very small percentage of the government's IT employees were technical. We are turning that around and ensuring that those on our IT teams are primarily technical in nature. It's also important to note that recent data leaks at the IRS largely stemmed from contractors. We are minimizing contractor access and hardening systems which will reduce vulnerabilities. This reduction in contractors and a leaner, more technical privacy staff will reduce opportunities for leaks and result in stronger data protection. In that way, we will improve our ability to safeguard the IRS's own systems as well as sensitive taxpayer information. As we work to modernize the IRS, I also want to mention that we are already preparing for next year's filing season. Once it becomes law, the IRS will begin implementing President Trump's One Big Beautiful Bill, and we hope Congress will pass in the next few weeks. This legislation will importantly make the Tax Cuts and Jobs Act permanent while making additional investments in R&D, manufacturing, and America's workers. Timely implementation of this legislation will be a first-order activity for Treasury and the IRS. And as we move forward, I am confident that the experienced and talented IRS workforce is up to this challenge and will fully implement these changes in time for next year's filing season. In conclusion, let me once again thank you for the chance to be with you today and to congratulate you on the important work you're doing to shed light on important issues of tax administration. Thank you for the hard work and dedication to the research that helps make our tax system work better for all Americans. Thank you.
I'd like to invite the participants of the first session to please take the stage.
Good morning. Is this on? Okay, because the instructions about the microphones did not have this set up in it. All right, so very welcome to the first session. And today's session is going to be on how AI assistants can help out with the tax compliance and figuring things out. It's a little bit of we have an interesting group of papers, starting first with Sina, who will tell us how AI can help with tax assistant tax preparers aid low-income populations in filling their taxes. It's interesting how one can integrate existing software with AI and how beneficial that is and how precise that is, because we all hear stories about AI hallucinating, and I'm curious whether that happens here too, or it's a very safe environment. Kenneth will enlighten us on how unsupervised learning can improve calculations of the corporate tax gap. We're all familiar of how complicated corporate tax returns can be with the timings and rules and all of those things. So I'm very curious to find out how that works. Even though Kenneth works in my group at the IRS, I'm not quite familiar what he does in the cubicle next over, so I'm looking forward to find out what he's been up to there for the last year. And then we had another paper, I believe, by Sanith, but very luckily for us, well, he couldn't do it for whatever reason. I'm not privy to that. But we're very lucky that Daniel was able to step in and tell us how the self-reporting of wealth has changed over the past 10 years with the FATCA improvement. And I'm going to save the leftover time for the questions at the end, because I don't think anybody needs to hear any more ChatGPT jokes or any ChatGPT jokes in this session, though it's a ripe opportunity. I understand that. So let's go for it.
Good morning, everyone. I'm Sina Gorgani-Khiavani, and I'm excited to have a chance to talk to you about our research in tax. More specifically, how can we use the latest advances in AI to make the tax preparation process better for both the taxpayer and the IRS? So before we go into the challenges and the proposed solutions, it's important to first understand the program we are working on, the Volunteer Income Tax Assistance, or VITA program. VITA is an IRS-sponsored program with a simple, powerful mission to provide free, high-quality tax preparation service to those who need it most. And its focus is on serving key communities. This includes low to moderate income individuals, persons with disabilities, the elderly, and taxpayers with limited English proficiency, often the very people who find the tax system most difficult to navigate. The entire program is powered by certified volunteers, dedicated members of the community who undergo training and must pass an IRS certification test every year to ensure they are qualified to prepare accurate returns. These result in a program that delivers billions of dollars in impact every year. But these volunteers face a daunting challenge. We ask them to master the US tax code, which is intricate and frequently updated. They have to navigate nuanced regulations and go through many documents, which can be even hard for seasoned professionals. This creates a resource gap. There might be some experts at these sites, but not nearly enough. When a volunteer needs an answer right now, their primary tool is often a static PDF, like publication 4491. These manuals are valuable, but they lack the on-the-spot interactive support required to efficiently handle the huge variety of different taxpayer scenarios. And that's the problem we set out to solve. So with the challenges facing Vita volunteers, we thought, how can AI help? The reality is that using these as standard, ungrounded AI alone is insufficient. They suffer from several critical pitfalls. First and most famously is the problem of hallucinations. These models are designed to be creative and can confidently invent facts, making up tax rules or citing IRS forms that don't exist. Secondly, they have a problem with outdated knowledge. An AI model's understanding of the world is frozen at the time its training was collected. This means it's almost certainly unaware of the very latest changes to tax law for the current filing season. And finally, there's the black box problem, or a complete lack of verifiability. When a standard AI gives you an answer, you have no idea where that information came from. There's no source, no citation, no audit trail. A Vita volunteer cannot and should not trust an answer they cannot independently verify. These pitfalls, hallucination, outdated knowledge, and the lack of verifiability make it clear that we need a more sophisticated approach to use this. So to bridge this resource gap we just talked about, we developed a system to make these answers grounded in IRS publications. Our system uses a technique called retrieval augmented generation, or RAG. Now I know that sounds technical, but the concept is incredibly simple and effective. The best way to understand it is to think of it as giving the AI an open book test. Instead of asking the AI to recall tax law from its vast general memory, which might be outdated or incorrect, we force it to first look up the relevant information from an IRS publication. The volunteer asks a specific question. Our system instantly searches the official IRS guide for Vita volunteers, which is publication 4491, to find the paragraphs that apply. It then has the specific relevant information to the large language model and says, based on this context only, and answer the question. This process grounds the AI. It tries to ensure the AI answers not just based on general knowledge, but based on correct guidelines. So how does our AI system actually work? So a key challenge in these systems, in RAG systems, is making dense document like IRS publications searchable based on meaning rather than the keyword. We address this with a one-time preparation step called indexing. During indexing, we take the entire document and use an AI model to convert each section into a numerical representation known as embeddings. These embeddings act as semantic fingerprints, allowing us to later retrieve relevant sections based on meaning, not just exact word matches. You can think of it as creating a semantic map where every tax concept has a unique coordinate. Concepts with similar meanings like earned income credit and low income worker are located near each other on this map. This proximity allows the system to retrieve relevant information if the user's query doesn't exactly match the original wording. When a volunteer asks a question, we first convert that volunteer's question into a coordinate on that same map. Then for a recall step, we perform a similarity check. This is a fast mathematical operation to find the 500 paragraph coordinates that are closest to the question coordinates. This is how we find the most relevant information in seconds. From there, our two-stage process takes over. The re-ranking model intensively analyzes those 500 chunks to find the absolute best five. And finally, the LLM uses that precise context to generate the final answer. This embedding-based approach is what allows the system to be both fast and semantically intelligent. Now, here is a question and scenario from Vita certificate test. The questions or scenarios are in two categories of basic and advanced. Questions can be true or false, multiple choice, or open-ended. Open-ended questions usually have a numerical calculation in them. Before we move into the full experimental setup, I want to address an important part of the methodology, establishing the ground truth. This was a big challenge as the IRS does not publish the answers to Vita certificate test. To overcome this, we implemented a validation process based on professional expertise. Two of our authors, a certified public accountant and an IRS certified tax preparer, took on this task. First, they both independently answered every single one of the 130 questions from Vita test, and then they came together for a multi-hour reconciliation session. They compared their answer, discussed any differences, and referred back to the tax law to arrive at a consensus on the correct response for every question. This created our final expert-verified ground truth. So let's bring it all together into our complete evaluation methodology. First, our benchmark was official 130 question VITAS certification test. Second, our knowledge source for RAG system was the Guide for Volunteers, publication 4491. And third, our experiment was a direct before and after comparison. We tested the AI models on their own to get a baseline, and then we tested them again with our RAG Copilot Enable. I should mention that our focus is on smaller models as they are cheap to use and suited for a free tool. We wanted to answer the research question, how much RAG actually improve AI performance in a real-world tax assistant scenario. So let's look at the results. This is the this is how the AI models perform on their own without the RAG. This is the overall accuracy. You can see the performance is mediocre. They are generally correct between 40 and 60% of the time. They clearly have some knowledge, but it's unreliable. But that's not the real story on this slide. The more interesting finding in this chart is the performance on open-ended question that require a numerical answer, like calculating a deduction or credit. As you can see, every model scored 0, 100% failure rate across the board. It tells us that while these models are okay with choosing the correct answer in multiple choices or true or false, they are not able to answer any open-ended question, which mostly need some numerical calculation or reasoning. Now, the question is, can a RAG system, the AI with an open book, fix this? Let's take a look. This is I show the performance of the same models on the same test, but this time with our RAG system enabled. Looking at the overall accuracy chart, the improvement is obvious. All the bars are visibly higher. For example, GPT-4o Mini's score on basic scenarios jumped from 58 to 71%. This shows that having relevant context makes the AI better at all types of questions. On the right, we see the result for the same numerical test that had a 100% failure rate. We can see some success here now. GPT-4o Mini, Llama 70 billion, and Cloud Haiku were all able to correctly calculate answer to some of these questions. To be clear, the scores are not 100%, but the critical takeaway is that we've gone from impossible to possible. Now let's put them side by side in a single slide to distill the key insights from the comparison. Here, the lighter bars are the baseline and the darker bars are the performance with our RAG system enabled. Now we can see the conclusions here clearly. First, as the chart makes plain, RAG consistently improves overall accuracy. This isn't a fluke, it's tangible improvement across different models in both basic and advanced scenarios. Second, and more importantly, is the success on numerical tasks. We moved the needle from 0% success to some success. Finally, it's important to be realistic. Our third insight is that while this improvement is the first step, the accuracy of these numerical tasks is still modest. This tells us that the context from RAG is a great aid, but it isn't a magic bullet. The underlying reasoning capability of the AI model itself still plays the bigger role. The clear benefits and the remaining challenges lead us to the final discussion on the limitation of this work and the exciting future direction that lie ahead. First, our system's knowledge is currently limited to publication 4491. This is a starting point. It means if a volunteer asks a question that is from another form, the system wouldn't be able to answer correctly. Second, our choice of models. We deliberately focused on smaller, more efficient models because our ultimate goal is to create a tool that is free and accessible. This meant we weren't using the largest models available. Finally, and most importantly, the distinction between reasoning and recall. Our results clearly showed that while RAG is great at recalling facts, it doesn't fully solve the inherent reasoning problems. So we have established that our RAG system is great at finding the right information, but it still struggles with complex multi-step reasonings. This brings us to the next frontier in AI, which we believe is the key to solving this issue, moving from simple retrieval and simple LLMs to active reasoning. This diagram illustrates the fundamental difference. On the left, you have a traditional LLM. which is essentially how our system works. Now, it takes a prompt, does a single forward pass, and gives an answer. On the right, you have a reasoning model, which works much more like a human would. It doesn't just answer, it thinks. When it gets a query, it first engages in deliberative planning, breaking the problem down into steps. Then critically, it can use tools. A tool can be a calculator, a code interpreter, or even our entire rack system to go fetch a specific tax rule. Finally, it engages in self-critique, checking its own answer before producing the final reasoned answer. By adopting this approach, we can build a system that doesn't just know the tax code. It can apply it. It can perform numerical calculations that are currently a big hurdle for AI in tax prep. Indeed, just by swapping our LLM with a small reasoning model like O4 Mini, we were able to achieve much better accuracies. But to show what this future looks like, here's a brief demo of our new prototype in action. This is Tax Assist, a prototype tool that intelligently deploys different AI agents for chat calculation and knowledge based on users' intent. The system will start with a simple general knowledge question a user might have. What is a standard deduction? The system recognizes this as a straightforward query. It doesn't need to consult a RAG system. It performs a quick deep search to provide a clear, up-to-date definition. It's choosing the simplest tool for the simplest task. Now let's try something more specialized. A volunteer needs to calculate the taxpayer's liability. As soon as I ask this, the system immediately recognizes the need for precise calculation and activates a specialized calculation agent. Instead of guessing, it begins an interactive dialogue to gather necessary information from the users. After users gives those information, the final and the but generally, it calculates it based on the user's information. It can ask for more, it's interactive. But the key is here the system provides a final tax liability, but it doesn't stop there. On the right, it provides a complete, transparent breakdown of the calculation. You can see the AGI, the standard deduction that was applied, and the result of taxable income. This isn't a black box, it's a verifiable, trustworthy calculation system. Now let's give the system a complex beta scenario and question that requires applying a specific rules. I'm pasting a full scenario from the beta test about a married couple, Maria and Oscar, who have investment income. The question is simply whether they qualify for earned income tax credit or not. Now the system correctly identifies this is a rule-based eligibility question and activates knowledge agency. You can see it doesn't activate the calculation agency anymore. It uses internal reasoning to analyze the rules for EITC, uses RAG. It calculates the AGI, compares it to the 2022 threshold, and correctly concludes because their AGI of 26,000 exceeds the limit, they do not qualify. Then it provides reasoning right there in a panel of analysis. Now, for the final demonstration, let's use a scenario that requires both deep knowledge of the EITC rules and a complex multi-step calculation and reasoning. This time, Maria and Oscar have two qualifying children. The query asks for an explanation of the EITC rules and the calculation of potential credits. So using the rack system can be a couple of seconds each time. So I'm going to skip some parts of it to the answer. Okay. So the result here is incomprehensive, two-part answer. In the main chat, it provides a text-based explanation of EITC rules and the final calculated credit of 2849. But the real power is in the sidebar. We have a knowledge tab that shows the reasoning for why they are eligible. And if we switch to the calculation tab, we see a detailed line-by-line breakdown of how the credit was computed, including all the input parameters. This intelligent multi-agent approach, choosing the right tool for the job and combining factual retrieval with verifiable calculation, is what allows us to solve complex scenarios, real-world tax problems. I think it's the future of intelligent tax assistance. So to conclude, Retrieval augmented generation greatly improves the accuracy of LLMs for tax assistance and makes solving numerical and reasoning problems possible. To achieve the highest level of accuracy and trust, especially for complex calculation, we move beyond simple retrieval to explicit multi-step reasoning and tool use. The ultimate AI tax assistant for beta volunteers will be a hybrid system, combining the factual grounding of RAG with verifiable calculation power of reasoning model. And thank you for listening. And I'm sorry I couldn't be there, but it was very exciting to present this work for you. Thank you.
Thank you so much, Sina. Should we move on to the next speaker? Kenneth?
Okay, got it. All right. Okay. Okay, there we go. All right. Good morning, everyone. I'm Kenneth, the tester, and I'm here to present my work on a risk-based estimate of the large corporate tax gap. So to start things off, these are the views of myself and do not necessarily reflect the views of the Department of Treasury or the Internal Revenue Service, standard disclosure. So to start things off, I first want to talk about changes in corporate tax administration in the last 25 years. So the first and most notable change here is that there have been substantial increases in information reporting for corporate tax returns. This first sort of started with Schedule M3, which is a sort of a more detailed book tax difference decomposition in 2004. We had FIN 48 reporting requirements for financial statements for publicly traded companies. Schedule UTP required a bit more detailed information about those FIN 48 footnote reporting requirements on uncertain tax balances. And there are other additional information we didn't have previously in the Form 3800 redesign and country-by-country reporting, which gives a bit more information in where specific intangibles and tangibles are held at a country level report for the tax return. In addition to this additional information, data availability and computing power have greatly increased. We can now have a broader picture of a corporation's operations, both domestically and internationally, and we have the sort of computing resources to actually use sophisticated data analytics to inform tax compliance. Additionally, perhaps the last most notable change in this process is that the Tax Cuts and Jobs Act has substantially altered the corporate tax system. So we're all familiar that the top tax rate on corporate income fell from 35% to 21%, but there were also differences in how foreign source income was treated with GILTI, BEAT, and FDII. Now, in addition to all these changes, the corporate tax system faces unique challenges in the estimation of the tax gap. Unlike the individual income tax program, there is no national research program, which is a stratified audit sample of the whole population that makes sure every aspect of the individual income tax paying population is covered. There is no such program for large corporations, which we define as corporations with assets in excess of $250 million. This causes questions with both selection, as in we're relying on operational audits, which are characterized by inherent risks, and also with completeness. On the NRP, every issue on the 1040 is required to be examined, while in a large corporate tax return, that's infeasible. The second issue is that there's no way to adjust for undetected noncompliance. So as of now and currently, when we can only take the examiner determined adjustments and use that as our measure of noncompliance, while with the NRP, we have methods to adjust for potentially auditors not finding all the whole level of noncompliance. And finally, because corporate income tax deals with so many gray areas, many of the issues that arise in an audit are settled either in appeals or tax court,
And those incentives may be different from what is actually determined, what is actually true tax liability versus avoiding taking a particular issue to court. And underlying this is that the lack of a standardized research audit procedure for corporations makes audit results highly sensitive to operational changes. This is really important to keep in mind, considering the real value of the IRS enforcement budget has fallen by 20% between 2006 and 2017. We can see this by looking at the total exam time for a given fiscal year audits that close. We see that it's fallen precipitously over the last 15 years or so, seeing substantial decline in the total amount of exam time dedicated to large corporate returns. Now, a natural question is, what does this mean for our tax gap estimates? Our previous approach, and the one we currently use now, relies on the extrapolation of audit results to the full population. This is going to ultimately result in, this operates under strong assumptions regarding the level of noncompliance in the population, presumably that there is a similar rate of high levels of noncompliance in the audited population as in the full population. It's also highly reliant on audit coverage and quality to make consistent comparisons across years, which is hard to imagine given that we're seeing this large change in overall IRS resources. Like I've said, there's a way to think that advances in data analytics and data availability have sort of made the audit process more efficient, but it seems like it's not going to fully close this gap. So what I propose is that a new approach is needed to flexibly adapt for these changes in examiner resources and differences in population characteristics. So what is this new approach? I think there are two main ideas that underpin this new estimation method. The first is that the tax gap should not necessarily be based upon just the audited results. It should be based upon population characteristics. This is the same idea that we use for the individual income tax gap with the stratification of the National Research Program. So very, very similar idea is with the individual gap. The second is that conditional on risk, unaudited returns and audited returns would have similar adjustments. So if we are able to fully model that selection process, then using some sort of risk measure, that we would imagine that the similar returns would see similar adjustments. So how do we go about modeling the risk? We are going to utilize risk measures from Large Business and International Division, or LB&I, to create a risk score that's directly tied to audit adjustments. Based upon this risk score, we're then going to partition the population into risk bins and assign the average voluntary reporting rate, or VRR, in the risk bin to the full population. Now, before I go into more detail about what this looks like in the new method, I want to just give an overview of what we are currently doing and what we've done in the past. The current approach is the extreme value method, which was first used in tax year 2006 to estimate the tax gap. This method is based off the idea that, like firm size, audit yields are going to follow a Pareto distribution, which means that they have long tails. This sort of idea of firm size was first shown by Robert Oxtel in 2001, and the EVM method to develop the tax gap was done by Kim Bloomquist in 2014. The way that this method works generally, it's used in many countries, is that they're going to utilize audits that have adjustments that exceed a certain threshold size. In the IRS, we compute this sort of internally. In other countries, they choose arbitrary thresholds. It doesn't matter to a certain extent. And then we, based upon those audits that exceed that threshold, they estimate a Pareto distribution from those audits, and then assume that the fraction of above threshold audits in the audited population would match that in the full population, and then extrapolate out the Pareto distribution, assuming that the unaudited population and the full population would have monotonically lower audit yields than the audited population. And then while this obviously has some strong assumptions associated with it, what was done previously was just, hey, we examined corporate tax returns and the examiner determined amounts, that's the tax gap. It's just what was detected in audit. So it does represent some sort of accounting for not full coverage in the corporate tax examinations. Now, for our method, it's going to pull in data from a variety of sources. The first source is going to be audit data from the Audit Information Management System, which contains detailed information on exam time, projects, which are usually sort of the idea of like the source of the audit, and the amount of the adjustment. This data is going to cover tax years 2010 to 2017 to ensure that we include the most possible information returns and characteristics that we can within a reasonable time frame. And so we take tax years 2010 to 2017. We then link these audit data to return level information from the following sources. So we use the business returns transaction file, which is the universe of originally processed returns. So the first return that comes in, it has all of the returns, but it's typically limited to just what's on the 1120. This is then supplemented with information from the XML Returns Database 2.0, which contains the universe of all filed electronically returns with the accompanying information returns. So we can bring in information from other sources that are associated with their return, but not directly on the 1120. We also supplement this with the data capture system from LV&I, which contains all the paper returns and their associated information returns for all corporations with assets in excess of $10 million. DCS is sort of a new program. It has information sort of reliably starting in 2008, from what I can tell. And so given we're beyond that, it has pretty good coverage. Now, keeping in mind, paper returns generally represent a fairly small fraction of total large corporate returns, as you might imagine, about 5%, and a very small share of dollars, about 1%. But there could be reasons to think that the decision to file a paper return may be influenced by compliance, and so they need to be accounted for in some way. Now, our risk measure and model, our risk indicators are going to come from the Large Business International Large Corporate Compliance Model, specifically their transfer pricing rules. So this is a set of about 20 different indicators that are related to the operations of multinational corporations. In our view, from our understanding of how these indicators are used, they're best thought of as determinations for whether a return should be audited, period. They aren't directly, they are obviously associated with the adjustment, but they're primarily used in the selection process for an audit. So we think of these as just sort of being proxies for the underlying risk of the return. And so given that these are a set of proxy variables, we follow the Lubotsky and Wittenberg procedure for using a proxy to derive an index value. And so we first standardize the risk variables to be mean zero, standard deviation 1. We then take our examiner determined adjustments and regress them on the risk variables for the audited population, obtaining a beta z for each indicator z. And then we use these to obtain the index z rho by summing them up and using a standardization standardization or normalization adjustment to normalize the index. Now, once we have this risk index, it's going to also be mean zero, standard deviation 1. And then following Agarwal and Tester 2024, we're going to divide the index into percentile bins. And one thing to note about large corporate adjustments is that they are heavily concentrated at the top. So granularity is going to be particularly useful here. And so what we do is we divide the audited population into 50 percentile bins, so 0 to 2, 2 to 4, 4 to 6, all the way up to 98 to 100 in terms of percentile. And from what we can tell, the risk index percentiles seem to do a reasonable job of measuring the riskiness of the audit returns by looking at audit outcomes and also sort of the inputs that go into the audits. So to show you this, I present here some results in what I refer to as the extensive margin of the exam, which is whether any non-compliance is detected in the exam. And we see that as the risk index bin values go up, the no change rate falls pretty precipitously, suggesting a strong negative correlation between our risk index bin and the no change rate. In addition, on the intensive margin, here this is reported as the log of adjustments on their return, conditional on there being a positive adjustment. We see a strong positive relationship between the risk index bin and our natural log of the adjustment, suggesting once again doing a fairly reasonable job of modeling those parameters. Now, how do we go about estimating the tax gap? Using these percentiles that we construct from the audited population, we just map the full population into their respective bins. This is sort of implicitly the same as doing the reverse. It's just computationally a little bit easier, given that the index is estimated first. Unsurprisingly, for some of these small and less risky bins, there's not a lot of variation in the risk score because not every large corporation is a multinational. And so we aggregate up some of these smaller bins by tens and fives. In general, this seems to have pretty minimal impact on tax gap estimates. But if we were to think about incorporating standard errors via some bootstrapping method, it's likely that it would reduce some of the noise associated with those. Returns are then assigned the average voluntary reporting rate of the audited returns in that bin. This is to sort of adjust for potential size differences within a given bin. Otherwise you could use average adjustment, but that doesn't really probably doesn't properly account for that. The key assumption that's made in this constructing this measure is that returns that occupy a given risk bin are going to have similar compliance behavior. And now, before I produce the estimate, I just want to give a little bit of a preview of some of what the average VRR looks like at the bin level. And so you can see it's follows a bit of an interesting distribution. For some of those lower levels, there's a lot of noise associated with those. Those in general are smaller returns. There's where it's likely that we're not within our index, it's not really where it's targeted, so it's unsurprising to see quite a bit of variation there. In the middle, it's pretty consistently flat, but starting at about 35 to 40, we see a pretty significant relationship and strong relationship between our index measure and the voluntary reporting rate, whereas the index measure increases, the voluntary reporting rate falls. So it seems to be a fairly good job of even picking up, sort of somewhat adjusting for size, picking up the level of noncompliance. Now, the tax gap estimate, here I present them along with our releases for 2014 to 2016. And we see that this new approach leads to modestly larger estimates overall. We find about, on average, a 35% increase from our previous release. So the new method's obviously in the new method column. Column 2, I call that previous method projection. That's actually what was released on the 2014 to 2016 tax gap release. But what's done there is based upon the EVM results from 2006 to 2011, they averaged the compliance rate there to account for not all the audits closing and project it forward. So I do that in that previous method column. In the previous method estimate, I actually estimate the EVM approach for those years. And this, I think, for the most part, this is going to highlight some of those resource challenges that we see. So in the sort of projection, those are coming from audits that closed at previous time periods where we had more resources sort of feeding into them. In the estimate, we're at this sort of new time period where there's less resources, there's less coverage. And so we're starting to see some of those effects. There's still also the effect of not all these exams have closed, but at this point in time, we're talking a pretty substantial majority have for these tax years. Now, some concluding thoughts. Our risk approach leads to a modestly larger tax gap estimate. It is slightly larger than projections, 35%. I mean, maybe slightly larger is a bit understating. It's modestly larger. It's significantly larger than the estimates, but given the data changes that we see in this period, there are reasons to believe that that method, the assumptions are unlikely to hold given our change in resources. This method also applies well to the projections of the tax gap. we can go and, for a given set of years, we can estimate the risk index on these years. And then based upon the index constructed in those values, we can then project that to future years. So it does bode well, and it allows for the underlying risk characteristics of that year to lead to alterations of the tax gap instead of assuming the compliance rate is fixed. While it does do a good job of modeling noncompliance of returns with the largest adjustments, there are obviously other compliance issues that exist. In particular, you can imagine domestic-only firms facing different compliance challenges that might require additional modeling, because the issues that they face are just systematically different from those of sort of these multinational firms that are impacted by these transfer pricing rules. While this method addresses some of the issues with the previous approach, there are several challenges that remain unaddressed. There are still issues of completeness, detection, and sustention that we haven't fully incorporated here that sort of remain open to be investigated further. In particular, I think when we're thinking about the corporate income tax gap, it's really a number that is very different and harder to measure than the individual income tax gap due to the level of gray areas that are present. And so I just think it's, in general, the corporate tax gap could have a broader view potentially than the individual gap. And so with that, I'm out of time, so I thank you.
Thank you, Kenneth. That's a very promising approach to the underreporting corporate tax gap. We're going to put you in charge of the non-filing corporate tax gap as of now, and after that, solving world peace.
I'll resign.
So, all right, thank you. Daniel, thank you so much for being willing to talk to us today on the short notice, and we're looking forward to it.
How do I change slides? The green button. Okay. Hello, everyone. Good morning, and thanks for coming. I guess my slides will be up in just a moment. There we are. Okay, so as you mentioned, this was a little bit of a last-minute inclusion in the paper, so this work is a little bit preliminary, but I'm excited to see what you might make of some of the dynamic patterns we're studying here. So this is joint work with a large number of co-authors, a great team whose names you can read there. It's part of our ongoing work on the Foreign Accounts Tax Compliance Act. So depending on when you start the clock, FATCA is around 10 years old. It was passed in 2010. The first provisions of third-party reporting started in around 2014. And so this is part of a longer research agenda where we're trying to understand what FATCA did and what we can learn about offshore wealth from FATCA. What the law is doing, the Foreign Accounts Tax Compliance Act, is trying to curb offshore tax evasion by mainly requiring robust automatic information reporting by foreign financial institutions with a beneficial ownership standard. So all foreign banks, almost all in the world, are required under FATCA to report to the IRS information on the ownership and assets that are held at those institutions and owned beneficially by U.S. persons. As I said, the law was passed in 2010, and the first third-party reports started in 2014. There's some withholding provisions. I'm not going to get into some of the details of FATCA, but that third-party reporting is our main data source. And with that data, along with tax return data and so on, we're trying to understand what the information reported by these foreign financial institutions reveal about what Americans hold offshore and how taxpayer behavior, especially their compliance behavior, responds to the implementation of these rules. So today I'm going to talk mostly about the first of these. It's mostly descriptive on what we learned from these data, and relative to things we've done in the past with this research group, there's an emphasis on dynamics through the first few years of FATCA reporting. Part of the reason we're able to look more dynamically was we've just refreshed the data set to add several more years than what we had in our prior work and give us enough to start drawing out some time series and see some dynamic patterns. And I'm going to tell you a little extremely preliminary things about 2. Don't get too excited about that. It's nothing really definitive. Okay, so the data source is called the Form 8966. This is the form on which this new third-party reporting occurs. The information from that form that we're going to focus on is the account balance. So that's the value of the offshore assets that the bank is reporting to the IRS, as well as the type of owner of that account. So the owner types we assign based on TIN matching to tax returns and a few other forms with TINs on them. And I should note up front, publicly traded companies, nonprofit organizations, and financial institutions themselves are exempt from 8966 reporting. So you won't see many of those in the breakdowns by owner type. Sometimes there's unnecessary reporting, so occasionally we'll see a nonprofit show up in the data, but they're rare. The income reporting, there are fields for interest, dividends, the gross proceeds from the sale of assets, and other income on the form. That reporting is incomplete and inconsistent. You can read an earlier paper by many of the co-authors of this paper in Tax Policy and the Economy for more detail about that. And so I'm going to focus on account balance and other types and decompose those aggregates by some groups of countries based on haven and non-haven status. It's kind of a standard disclaimer by now about the IRS not having a standard definition of a tax haven. And we're using the same list that we've used in several of our other papers, which is a list from the OECD plus a few countries. Okay, and at the very end, I'll also tell you a little bit about some data from foreign bank account reports, which are a form on which taxpayers self-report their foreign accounts, as well as a little bit of information from the tax returns of owners that we match. Okay, so I'm going to forego a long review of the active literature on offshore tax evasion, but I think there's a couple things from our prior work that are useful context for understanding what I'm about what we're about to look through. So the first paper that I wrote with most of these co-authors studied the offshore crackdown in 2008, so most of that was before FATCA was implemented. It was kind of on the horizon at the time that we were studying in the AHA policy paper. So what we saw was a spike in disclosures of offshore wealth via foreign bank account reports. It was about $100 billion disclosed on new FBARs by about 55,000 Americans, and we stopped the series in 2011. So it was from 2009 to 2011 that there's this sort of jump in what's reported on FBARs. And what I'll show you at the end of this is what happened to those FBAR disclosures since 2011. The other paper is in the Tax Policy and the Economy in 2024 is also a descriptive analysis of FATCA reporting. So there the sample stopped in 2018, but that's coming from the 8966 data, so it's very comparable to what I'm about to show you. So just a rough ballparks, the tax year 2018 totals were $4 trillion of wealth in the cleaned data, about half of that in havens, and just under half of that owned by entities. By far the most common entity in dollar-weighted terms are partnerships. So partnerships have a very small share of accounts and a very large share of all of the dollars that are being reported. This wealth, when we match to owners, the wealth is highly concentrated at the top of the income distribution. So one number from that study was that 64% of the wealth owned by individuals or partnerships was belonging to the top 1% by reported income. And 62% of people in the very top 0.01% of the income distribution own an account either directly as an individual or via a partnership in which they own a stake. There are increases from 2014 when the very first reports start to 2018. There are increases in reporting quality, and the totals reported over this time period go up, mostly because more and more financial institutions are reporting higher quality accounts. So a lot of those records had missing TINs in the early years. There's a lot about in that earlier paper about missing TINs. There's been some internal work to assign TINs via name matching. And so that's going to allow us to fill in a lot of what was previously missing and to look at how ownership patterns have changed in recent years. So this first graph is telling you the number of FATCA accounts on the left axis in millions of accounts that are reported. So the reporting in 2014 was highly incomplete, just over 1 million accounts in 2014, rising up to about 7 million accounts, or 6 to 7 million accounts, depending on which year you look at in the more recent years. I think most of that is increases in reporting quality and not real increases in the number of accounts held by Americans. The dollar valued total is the dotted line. That's on the right-hand side axis. So that's going up from going up to from just over 1 trillion up to more like 5 trillion now. So that total's a little bit higher than the totals on this page, because what I'm about to do is there are still some accounts which have missing tens, and we're going to exclude those for the remainder of this. So when we focus on the accounts where we should be able to identify the owner, that brings us up to about $4 trillion of wealth as of around 2018. So the left-hand side is the number of accounts broken down by the owner type. So you can see the vast majority of accounts are owned by individuals, matched to a Form 1040. Small shares for everything else. The next largest category look to be valid SSNs, but which we can't match to a 1040 in the given filing year, suggesting they're also individuals. So the vast majority of these accounts are owned by individuals. The dollar valued totals are much more weighted towards entities. So that gray portion on the right-hand side, those are partnerships. A good chunk of the dollars belong to individuals. And then we have some issues with unresolved matches where we have a 10 that it's difficult to, most of those are matching to a 1040. We don't have a name match, or they match to kind of these odd entity returns. We're still working through what those are. And it's kind of interesting. We're still trying to figure out what to make of the fact that that category is increasing over time. So I'll show you a little bit more about that in a second. Broken down by the haven and non-haven country distinction. We can't produce country level aggregates because of some of the rules by which these data are reported by foreign jurisdictions. So the haven, non-haven, that's the best I can give you about like how these break down by country. So vast majority of accounts are in non-haven countries and owned by individuals. For dollars, the haven and non-haven accounts are on roughly equal footing in terms of the total dollar values involved. And most of these unresolved, this kind of mystery green category we're trying to sort through is concentrated in non-haven countries. So that total in havens is around $2 trillion. And about comparable in non-haven countries. Again, these are both going up over time, largely we suspect due to changes in reporting quality. However, as of 2017 or so, it looks to us like the reporting quality is mostly kind of up to par and stabilizes. And so one interesting pattern that we finally are sort of starting to see in the dynamics here, now that we can trace these out all the way to 2021, is that there is not a lot of evidence of large repatriation responses here, even in havens. So the kind of work on the common reporting standard in this other study by Boas and several co-authors shows, using Nordic data, very large repatriation responses, meaning people took their offshore wealth and brought it home. In response to the Common Reporting Standard, which is an OECD initiative similar to FATCA. So if that repatriation is happening, and there's a study by Lisa DeSimone and some co-authors suggesting some of it did, if it's occurring, it's either occurring before FATCA is fully implemented, or maybe its effects are dominated by increases in non-repatriated reported wealth. So a lot of Americans' wealth remains abroad in the post-FATCA era. About those unmatched accounts, so this is my best attempt to kind of give you where we are in trying to sort through these. A large number of the accounts in account-weighted and dollar-weighted terms, about 60% of them, match a Form 1040, but they don't satisfy our other matching criteria for concluding this is definitely a match, so often there's not a name match. Of the remainder that don't match to a 1040, many of those match to a Form 940, which is the employer's unemployment tax return. That's about a third of the dollars in the unresolved accounts. Many of those also match to a Form 1042. So, don't quote me on this definitively, but our best guess is that these unmatched accounts involve some combination of Americans where we just don't have a name match, as well as potentially foreign persons doing business in the United States. We're hoping to make more progress on that in the future. Okay, so now we're going to do a little bit more work with those that we link to 1040s. So the sample henceforth following kind of what we did in one of the earlier papers, is to look at individual owners who, who are directly identified as the owner. We matched the 8966 to a 1040, as well as those who own through partnerships. So we trace, when an account is owned by a partnership, we trace through the partnership's K1 network to beneficial owners and focus on cases where that beneficial owner is an individual. So that's our sample going forward. That's the vast majority of the wealth falls into this category. So the share of tax returns that we match to those is by rank in the income distribution. This is again showing that those at the very top of the distribution are much more likely to own an account. The top 0.5%, a quarter of them are showing up as matched owners in these data. That's pretty constant over time. Increasing a little bit in the last few years, as well as the dollar value, the share of the account balances. That's about 45% in all of the wealth that's reported in Haven and non-Havens combined. About 45% of that belongs to those in the top 0.5% of the income distribution, and that also ticks up in the last couple of years, 2020, 2021. Whether that reflects selection bias in terms of what's going on with these unmatched accounts or a real increase in the inequality and ownership of offshore wealth remains to be seen, but it's kind of an interesting dynamic pattern. And we get asked a lot about what's going on with the income of the individuals who are identified as owners under FATCA. That's something we would want to look at to identify a compliance effect. So I thought I'd show you a little bit of descriptive evidence about what's going on with reported income. So this is, for the sample here is those individual and partnership owners of offshore wealth who are identified on an 8966 in 2018, and we're balancing the panel. There's especially among the smaller accounts, a lot of people who don't file a 1040 in every year from 2005 to 2023. So we restricted those who do file in every year and to balance the panel. And you can see, first of all, the AGI is per capita or per return income. AGI is very high in this population. These are on average very high income individuals. Of course, it's skewed. Median income would be much lower. But that's hovering just over just under $1 million in most of the years. And so, it's kind of difficult to say exactly when FATCA kicked in, when we should think that the treatment effect, if we can estimate one, with a causal design would show up, probably somewhere in somewhere between 2010 and 2018. So that's one of the challenges in identifying the compliance effect of FATCA, is it sort of ramped up quite gradually. And so, you see these people have, like everyone else, their income everyone else who has a lot of financial income, their income falls precipitously during in 2008, 2009, and then it recovers. We don't see anything like a big hockey stick effect that would suggest that there's a huge response of their income to the introduction of FATCA reporting. But if we do a back of the envelope calculation to think, well, how much of an increase in income would we expect if, we find is that if you take the account balances per capita as well, multiply that by a 6% rate of return, it would suggest that if they went from not reporting any of the income in their offshore account to reporting all of it, then their income would go up by somewhere in the ballpark of $100,000, which you can see compared to the axis scale could easily be getting lost in the noise. So we can't reach really a definitive conclusion about compliance from this analysis alone, of course, because there's no control group, and that's an ongoing struggle here, is that this is a very, sample of FATCA owners is very highly selected on income and wealth. There's tend to be, on average, very high income people, and it's a very large share of all high income people in America. So, like, how you construct a valid control group is a real challenge. One thing we thought we would do is to look at those differences between those who have at least some wealth in havens and those who have no wealth at all in a haven country. In non-haven countries, usually the income in those accounts are already taxed in the foreign jurisdiction. So it has some appeal as a potential control group. An issue there is the non-haven filers. They tend to be much lower income. They're more likely to be residing abroad. So there's some issues with that potential control group. You can see their lower average income on the graph here. Their income on average is more like $400,000 per person, which is around P99 of the income distribution. So if we normalize these, which I'm not sure I would advise doing, but we wanted to see what would happen if we did it by normalize them in 2009 as if we were thinking about doing a diff and diff between haven and non-haven owners. This is what it would look like. So you can sort of see the main issue with this is that it looks like because they're much higher income, they have a lot more financial income, the haven owners' income is much more volatile and responsive to the shocks of things like the 2009 crisis. So we're now thinking a little bit more about how we could what we should do about that. How we could refine this maybe to get to something that's a little bit more credible and causal. So there's no really easy to find obvious effect of a large compliance effect of FATCA. It's not clear that we should expect to see that. But one of the reasons that I am kind of cautiously optimistic that FATCA did have some effect is in what we see in the foreign bank account report data. So in comparing dollar value totals, it's important to keep a couple things in mind. So again, this is a self-reported disclosure. It's not technically a tax form. It's been in place for a very long time, so we can go back and look well before FATCA was implemented at reported wealth on foreign bank account reports. And the two things to keep in mind are that it has different filing requirements from the Form 8966. The most important one turns out to be that the FATCA requirements apply to a much broader class of offshore assets, including debt and equity interests that are in offshore accounts that aren't in what we would ordinarily call a financial account, like a depository account. The FBAR filing requirements are much more directly mainly for individuals owning actual depository custodial bank accounts. And there's also a difference in the filing threshold. That's the one that a lot of people, I think, would already know about if you have some familiarity with FATCA. It's a 10K filing threshold for FBARs, much lower than the 8966 thresholds. And there's some other complicated differences about who files in the case of joint ownership or ownership via an entity, which I'm not going to get into. The FBAR aggregates show a very sharp increase in reported wealth over time from a few $100,000 up to now in the neighborhood of $2.5 trillion. $2.5 trillion. Sorry, I said a few $100 billion up to $2.5 trillion. So this is a hockey stick increase in reported wealth. It started in 2009, and that activity that starts in 2008-9, that was what we wrote our earlier paper about. Breaking that down by entities, you can see a lot of it is driven by individuals as well as accounts owned by U.S. corporations, but most of that dynamic increase is driven by individuals. I'm not going to get into, there's some odd stuff in 2009, which I'm not going to get into. There's some confusion about filing requirements for entities, I think, is what's driving that. Okay, so that's one of the reasons I think there's probably some effect of FATCA. That's just mainly for individuals who directly own accounts, though. So what's going on with the partnership accounts, high dollar accounts owned via partnerships is much more uncertain with what we can see currently. So after the initial ramp up in reporting, wealth hovers around $4 trillion that we can match, and that slightly increases. There's no obvious traces of repatriation. The haven wealth is predominantly owned by partnerships, so that's kind of the most important open question is what was the compliance effect on that population. And non-haven wealth, mainly owned by individuals, some partnerships, and increasingly these owners that we can't classify with confidence. And there's a small increase in the share of wealth that we match. Not ready to take that to the bank quite yet because we don't know what's going on with these unmatched accounts. And there's a big spike in FBARs that continued after the period that we studied in our earlier, and it is now over to $1.5 trillion. All right, thank you.
Thank you so much, Daniel. It confirms my assumption that big money leads to big problems, or at least compliance issues. Sanith, would you tell us what it all meant?
All right, well, good morning, everyone. Thank you to IRS and Urban for inviting me to be a discussant at this conference. I first attended TPC almost 10 years ago, and so it's great to see the growth of this conference over the years. Just the standard disclaimer, these are my own views and don't represent the views of the MITRE Corporation. So jumping into our first paper here on using RAG and LLMs for VETA volunteer support. No conference is complete nowadays without at least one paper on large language models. So thank you to Sina and the team for submitting this. I thought, so my comments are with regard to the paper, which I believe is still going through several rounds of reviews before it actually gets released. But I thought it was very well written, the process in which they created their experiment, and all the steps were very clearly defined. I would just add one little nit in addition to the charts also that were presented to include some kind of error bars for statistical significance of the results. I think the folks already have that information, so just consider adding that. I would say that this category of using AI to provide self-service options is a domain that the IRS has been helping to advance for a number of years, and there's an evolution of technology that has occurred and needs to be referenced in this paper, which I think starts off a little bit further downstream of all the previous work that has been done. So I'd recommend thinking through, experience of chatbots more broadly in government and kind of lessons learned to kind of fold in, and how this work starts to differentiate and adds to some of the challenges that might have been addressed with those efforts. Typically, that involves a lot of overhead in training chatbots. With the advent of large language models, that clearly, that training has shifted to another aspect of it, but it does speed things up, which is kind of the general consensus around on these tools, with the caveat that they introduce errors and hallucinations which require more testing and evaluation downstream. So it's very easy to deploy these models, but then as you start to figure out how to fine-tune them and make sure they're safe, the overhead shifts further downstream. I would say that the finding from the team of using retrieval augmented generation over the baseline tool out of the box is consistent with other application domains. That generally is the trend, that when you apply these additional inputs and context to this search process, that you generally achieve better results. So all of that is quite consistent. The team focused a lot on the improvements to RAG at the kind of retrieval stage and at retrieval stage. That is to say, the pre-processing of the text that was provided to the LLM is where they focused on some of the improvements. But that's not the only place where you can advance the kind of fine-tuning. You can also fine-tune the stage of post-retrieval as well as generation as well. You could also provide inputs that are multimodal, such as tables, that could help kind of clarify where there might be some gaps in the written text that could then help improve your results. The overall performance of this method for open-ended questions is where there was a big gap. And I know there was the demo at the end, which seemed to suggest that some of these may have been resolved. But regards that piece of trying to address these open-ended questions, what I would recommend the team to look at is some potential symbolic logic additions to large language models that have been proposed. There's a fair amount of literature that's coming out on that topic. And I would also recommend the team to consider an intermediate representation of the tax code in a new programming language that has been that has emerged called Catala, C-A-T-A-L-A. Catala is a programming language like Python that was developed by a team at INRIA in France in collaboration with Professor Sorolowski at Northwestern University. What it does is it provides a computationally tractable form of representing a tax rule in such a way that you could compile it and query it and find an answer to a tax question. What that allows you to do is allow the machine to better understand the symbolic logic around which different parts of the tax definition is cast. So Katala is based on default logic. The tax code, to a large extent, has that pattern. That is to say, there is a rule followed by a set of nested exceptions. That's what makes it hard for humans and machines to be able to provide clear answers. Katala is also a literal programming language. That is to say, one line of tax code is translated into one line of source code. And you can write them side by side, which makes debugging and update really easy. So all that on ACE, that's all just kind of a suggestion to consider ways to help improve the performance that you all have achieved to date. Just to kind of conclude here, I think, it is one thing to create an LLM to make it easier for a Vita representative to provide advice, but ultimately, the goal of some of these methods will be to help individual taxpayers as well, directly. And certainly, the demo at the end, I think, was indicative of that path to get there. A delta to consider here is that it's one thing to provide a technically accurate answer to a tax question, but that is perhaps not the way that an individual can even still understand. So there's another translation step I would ask the team to consider, that is to convert that response into a language that's interpretable by a human. And so there is a large body of work around LLMs and code translation, and language translation, unique to the demographic that you're trying to help. Consider options in which you take this next step, where it's not just giving the right answer, but it's the right answer that can be intelligibly, easily understood by the larger population. So I think I will leave it at that for paper number 1 and move on to the next team. So thank you, Kenneth. I really did enjoy reading this paper. I did not realize after all this time that a scale-free distribution could be used for determining a tax gap, so I learned something new with that. Clearly, the update using the risk-based approach was able to build on some of the limitations that were part of that extreme value method, while also having its gaps and limitations as well. One thing that I was a little bit confused by is the title of the paper. You said it was an unsupervised method, and typically that is something that I would associate with a lack of training data, but you clearly use AIMS and some indicators for that from audit. I don't know if you had a quick response to that.
I can clarify real fast. There are sort of two parallel approaches being developed right now. One is unsupervised, mine is supervised. So the title of the paper has actually changed, and hopefully that's reflected in the program. Right, so it's now called, let's see, what did I call it? Oh yeah, estimating the corporate tax gap. Oh no, okay. So the title is a risk-based estimate of the corporate income tax gap, which is much more accurate, I think. We would agree.
Okay, great. I was not missing something there. I was really looking for where that gap might have been, but clearly not part of the tax gap. Okay. So I would say, given the constraints that you have, I think that was a great next step to take with all the limitations, and I couldn't see how you may have tried to kind of address that in any other way. Clearly, there's a gap in terms of the NRP overall to get you a stratified sample in this context. And the fact that the operational audits are very kind of narrow is, other factor that makes this extremely difficult. So I guess the question here is where to next? And here is where I might propose going to a non-parametric model and try to see how you might complement this kind of more top-down regression approach with something more inductive from the machine learning space. And so I think the goal of that model should be to try and explore the kind of converge on a better measure of risk for the entities that you're looking at. There are other efforts to complement the National Research Program using these types of analytical methods, more perhaps on the individual side, but there's certainly lessons learned to borrow perhaps from those efforts, and I know there's sessions later on today that's going to dig further into some of those as well. So there's maybe an overlap in approach that you might be able to borrow from. The other point I wanted to offer there is there's other data sources to consider include in the overall risk measure as well. So for an example, SEC 10K and 10Q filings for corporations might give you a sense of the health of an entity. Oftentimes, their filings to the public through the SEC are more rosy than the tax filings they make. And so the gap between those could factor into the way you might calculate risk for that entity. And so again, this would just complement to the data that you already have and see if there's any kind of additional insight that might be derived from it. I think the calculation of a corporate diff score, if that's a term you're familiar with, is one that is a bit of a holy grail. We have that for individual tax filers, but I think you're heading down that path of creating that risk score independent of even just calculating the tax gap piece of the next step. That could help inform how you want to prioritize the audits that you really need to make in this space. Even though it's kind of a limited data set to draw upon, there may be insights from that just to help then decide where do we need more risk coverage, going down a risk-based approach rather than a policy-based approach, which I think is the baseline today. Yeah, so I think that's kind of the majority of the comments that I had for you, Kenneth, and really would love to see the second paper that you all are working on as well. All right, so Daniel, thank you for stepping in on our behalf to present your study. And I know that the paper is still pending. I'd love to be a reviewer for that as well at some point when it's ready. It's been quite some time before I was involved in international individual compliance. I think that you now have a larger, though albeit potentially still a messy data set to work on. And I thought the findings and the charts that you showed at least were able to get to certain distributions that can form hypotheses from which you can start to dig into further. I think it's a natural step to look at gaps between reporting across these multiple forms and information returns to come up with hypotheses about potential risk metrics and then audits that you might conduct. I imagine some of those are things you may have already thought about and might be already considering. The common reporting standard that was mentioned includes with it another data feed, as you all know. It's the automatic exchange of information. If you haven't already considered that as a way to correlate against the FATCA reporting 8966, please do so. That was a data set that was very valuable back in the day when I was looking at some of the international compliance efforts. Regards the TIN matching, I was looking at the list of forms you had listed and didn't see 1065 on there. I know you were looking at partnerships, so I imagine that's already taken care of. So I think overall, I would say, you had listed, two questions at the start about what does this say? I think there is more questions than answers at this stage, I would imagine, from the analysis you have, but really appreciate you all digging into this and trying to understand some of these causal factors to help inform future enforcement. So with that, my time is up. Thank you all again and look forward to the questions and answers.
Thank you, Saneth. We have a variety of very nice questions. First, from my understanding, is Sina will not be able to answer questions since he is presented remotely, but the questions to him will be forwarded to him, and then he'll be able to answer them in a separate way. Well, Daniel, you're up, because most of the questions are to you. We can start with the easy ones. How might FinCEN beneficial owner reporting cancellation affect FATCA reporting?
I don't know. There's not a legally obvious reason that it would, but we can all speculate.
That's my favorite economist answer. It can go either way. All right, next one. When trying to match 8966 entities to other forms, were there other fields available to use for entity resolution that weren't used? If so, why not?
So the process that we followed is to use first the TINs that came out of a pretty in-depth look at this internally, and then to match those TINs to tax returns. And so that the internal work used, I think, pretty much everything that's on the Form 8966. But one way that we could probably refine what we've done would be to use more of that information ourselves. There's some workflow issues with that, given that some of that's PII. We have to be careful, but yeah, we could probably do better, and that's on the agenda to figure out what's going on with these unmatched accounts.
All right, we're on the roll. We can just go like back to back. All right. Has there been any analysis so far regarding percentage of partnerships owned by Americans for the purpose of repatriation analysis?
As I mentioned, we don't see in the aggregate data strong evidence of repatriation for partnerships or any other type of entity. One thing that we thought might be more interesting would be to look a little bit more carefully at the dynamics of sort of the flow in and out of the 8966 data. When an account disappears from the data or its account value drops precipitously, that could be a sign of repatriation that we might be able to extract some signal from. It's much more difficult in our case to look at repatriation than it is with some other data sets, and the best data sets, the Nordic data, because they have domestic data on wealth, so they can see offshore wealth goes down and domestic wealth goes up for the same owner, and it's very easy to see a repatriation response that way. And with the data you can see in the U.S., it's much more of a forensic exercise.
Well, that goes straight into the next question. For Daniel, you've heard this suggestion before, but if you are looking for comparison groups, why not compare account holders in high tax states versus holders in, say, Texas or Florida? Presumably, pre-FATCA holders who were underreporting both US and state taxes.
Yeah, so I like the idea of looking at the change in, if you imagine that people were non-compliant, what would have been the change in their effective tax rate by being forced to come into compliance. That conceptual idea was why we started looking at the haven and non-haven jurisdictions separately, because wealth would have been taxed in the foreign country. Compared to that, there's a lot less variation in effective tax rates by using state-level variation along those lines. But I'm not saying it's a bad idea. We haven't tried it.
Are you implying that cheaters are always cheaters, no matter where they are?
I take no stand on cheating or compliance effects, really, of any kind yet.
Very safe answer. All right, then there's a very general questions about data sets that I'm not even sure who directed for. Maybe Kenneth would like to answer, if I want to throw you under the bus. How is the IRS addressing the complexity and cost of traditional architectures that separate data lakes, warehouses, and transactional databases?
I'd like to keep everyone in mind I'm an economist, so
Me
I have
too.
no idea. How about you, Valentina?
You know what? The wonderful part of being a moderator is that I don't have to know anything.
Perhaps we can have Sina type that into ChatGPT.
And that is all the questions we have for now. So I would like to thank our presenters and Saneth for being discussant. I can only imagine how much work that took to read and understand all the papers. And we have time for a break right now. I think we're expected to come back at 10:30 for session 2. Thank you.
Morning, everyone. Hope you all are feeling refreshed after your break. Thank you for joining us today for our second session on improving business compliance. My name is Masanu Va, and I'm a social scientist with RAS IRS, and I'll be moderating today's session. Today, we'll be joined by our 3 presenters who will provide insight on how some behaviorally informed outreach techniques and programs can be used to improve compliance among businesses. Our first presenter today is Jan Sun, who will be presenting on behavioral effects of tax enforcement on non-compliant businesses. Next, we'll be joined by tax auditor Vinicius Oliveira on influencing taxpayer behaviors and tax revenue increase following compliance initiatives. Our last presenter will be tax auditor Patricia Lamadrid on implementing a cooperative compliance program in Brazil. Lastly, our discussant for today will be Li Lu from the International Monetary Fund. Thank you again for joining us today, and I'll welcome Jan to the stage for our first presentation.
Good morning, everybody. My name is Yan. So in my today's presentation, I will discuss how the change of tax enforcement programs influence on the change of taxpayer behaviors. This is joint work with Alex Turk, Brad Collins, Mark Payne, Sean Raw, and Chris Wilson. This is a work in progress, but we are very excited to share our preliminary findings with you. Standard disclaimer applies. The opinion expressed in this presentation of authors do not represent Treasury or IRS. So I will begin my presentation by discussing about the motivation behind this research, why we focus on non-compliant business taxpayers. So this graph has shown much of the revenue coming into the US treasuries come from the income tax and the payroll tax. So the employer withholdings play a critical role in facilitating compliance. However, some businesses failing to meet the obligation to pay and file this tax is a significant source of the tax gap. So this graph has shown the total number of non-compliant business taxpayers. They increased from 2.9 million in 2010 to 3.1 million in 2019. So the tax enforcement literature, they have found the tax enforcement have deterrence effect on the tax evasion through direct impact and indirect impact mechanism. However, a lot of the literature regarding this is focused on the singular tax enforcement program. So building on these works, we will study both direct and indirect impacts of IRS main filing and payment compliance programs on the non-compliant business taxpayers. This is original research. So we take advantage of natural experiment as a cost-effective way to provide us valuable insights. So we will focus on 6 filing and payment compliance programs. We summarize them into 4 categories: non-filer contact, ACS letters, field visits, and federal tax lien. The data spanning 10 years instead of just one specific year, and the data is compiled into quarterly basis to match the employer's filing responsibility. So here is a simple framework to guide our analysis. In time T-1 or earlier, some taxpayers, some business taxpayers, they become non-compliant, probably because they don't file their tax return, or they file tax return late, or they didn't submit their payment or deposit. And the tax administration observed this delinquent tax account and assessed this delinquent tax account. In time T, the tax administration implemented tax enforcement programs for this unpaid tax assessment. And in the following period, tax administration observed this taxpayers' behavior. And some of these non-compliant taxpayers, they become compliant, but some of them still stay in their delinquent status. So what are these delinquent tax accounts? We find about half of them are related with Form 941, which is employer's quarterly federal tax return. Is closely related to what I just talked about, the employment withholding. So what happens to the tax programs during that period? We find all of IRS filing and payment programs decline during that 10 years. For example, so the left graph is the total number of business taxpayers received this non-filer contact. It dropped dramatically from 1.6 million to almost 0 in 2017 due to the pause of the program. And the similar pattern we can find for the ACS letters. They all dropped dramatically to the bottom low of 2016 and 2017. Same pattern for the field visits and federal tax lien. So here's our data. We use data 2010 to 2019 to facilitate our natural experiment when IRS underwent the appropriation cut. And we take 1% of random sample for the business taxpayers who have unpaid tax assessment. We join them with the filing and payment compliance treatments, which yielding 1.2 million total non-compliant taxpayers. And the data is compiled in quarterly and entity level. So here's our tax treatments in our sample. So in this study, the treatment is modeled in binary variables. So it equal to the value of the treatment equal to 1 if the taxpayer received that treatment. Otherwise, it gets the value of 0. So in the left graph, it shows the treatment for the non-filer contact and ACS letters. So just look at the black dotted line for the non-filer contact. The mean of this treatment dropped from 5% to 0 in 7 years. Similar pattern for the other treatments. So here's our model specification for our next step regression. So our dependent variable is a resolution of delinquency during the current quarter, and our interest variable is our treatment variables. And we control a comprehensive set of taxpayers' characteristic in the prior quarter, including the payment history, business establishment, major source of assessment, and their delinquent status. We also add the year trend, and we also control for the geographical state fixed fact and the industry sector fixed fact. So we will start from the ordinary least square. And in this regression, our dependent variable is percentage change in the unpaid tax balance. So here's our result for the OLS regression. So the coefficient for the ACS letters is negative and statistically significant, which implies ACS letters reduce the unpaid tax balance. And we also find that the year trend is positive and statistically significant, which implies during that 10 years, the unpaid tax assessment grow. So next, we will come with the regressions, with the models with discrete dependent variables. So in this model, in this regression, our outcome variables is modeled in binary values. So it takes 1 if the non-compliant taxpayer, they reduce their tax debt. It takes 0 if it does not. So the first left graph is just to show the distribution of these two values. And the right graph, it shows the mean of that outcome variables. It dropped from 25% in 2010 to 15% in 2019. So in this regression, we use 2 models. One is linear probability model, LPM, and the second one is logistic regression. So here we show the coefficient of our interest variables, which are our treatment variables and our year trend, side by side. So it's a slope from LPM model and the marginal effect from the logistic model. So we have 3 interesting findings. So the first one, the coefficient for ACS letters, personal visits, and federal tax lien, they are positive and statistically significant, which implies these treatments increase the tax compliance. And our second finding is the notice of intent to levy. It has a steep slope in LPM model, and it has the largest marginal effect in the logistic regression, which implies this treatment has the biggest impact. So finally, we find the year trend is negative and statistically significant, and the value is consistent in these 2 models, which imply during that 10 years, the compliance decrease, and non-compliant taxpayers, they are less likely to resolve their tax debt. So here comes our preliminary findings. So we estimate both direct impact and indirect impact. So we find tax administration's filing and payment programs has significant impact to secure delinquent business tax payments. And among them, the notice with deterrence message, which example is the letter of intent to levy, this notice emphasizes the penalty enforcement has the biggest impact. And we also find the evidence of the indirect impact after we controlling all the comprehensive characteristic and the significant direct impact. We still find the negative trend, time trend, indicating during that 10 years, non-compliant taxpayers, they are less likely to resolve their tax balance. So briefly talk about the next steps. We start from simple model, and in the next step, we will gradually introduce more complex modeling techniques. So from the previous regression, we already get the strength and direction of the relationship between the tax enforcement programs and the change of the behavior. But we will introduce more techniques for our next steps, including the relax of the exogenous assumption and incorporate more lagged treatments and develop more heterogeneous response variables. Yeah, that's end of my presentation. Thank you.
Thank you for that, Yan. Next, we'll welcome Vinicius to the stage.
Good morning, everybody. My name is Vinicius Oliveira, and I am tax auditor at Brazilian Federal Revenue Service, RFB. As this is my first presentation in English, I decided to use a written script, and please accept my apologies for that. Let's go. I am one of the co-authors of the paper we'll be discussing today, which is the result of a collaborative effort by a group of 5 colleagues listed in this slide. Before I begin, I would like to sincerely thank the IRS for the invitation. It is a great honor to represent the Brazilian tax administration at this conference. Before diving into the presentation, I would like to make 2 brief disclaimers. First, the usual disclaimer. The views expressed in this paper do not necessarily reflect the institutional position of the Brazilian Federal Revenue Service. Second, and equally important, we are not academic researchers. Rather, we are tax auditors trying to analyze the effects of our actions to improve future performance. With that said, let's move on to the presentation. Let me start by describing our context in Brazil. In response to the current challenge of reducing tax evasion with a declining workforce, RFB has intensified its effort to improve tax compliance by using automated audit systems to detect discrepancies and issue compliance notice, thus minimizing the need for punitive audits. For over a decade, RFB has developed and implemented large-scale digital auditing initiatives using computational tools to process large volume of taxpayers' data. This new approach automates auditing procedures that would be impractical through traditional methods, enabling a relatively small team to enhance tax compliance on a broad scale, significantly increasing the efficiency of the auditing process. One of these initiatives was focused on the Simples Nacional tax regime. The Simples Nacional is a simplified taxation regime that consolidates the calculation and payment of federal, state, and municipal taxes for micro and small businesses with a maximum annual revenue of $844,000. The number of enterprises enrolled in this regime has been steadily increasing over the years. Currently, approximately 7 million companies are enrolled in the Simples Nacional tax regime, representing around 70% of the 10.4 million enterprises in Brazil. Despite this large share, their contribution to federal revenue is less than 6%. The substantial number of taxpayers under the Simples Nacional, combined with their relatively low revenue levels, results in a significant low rate of traditional audits within this segment. Analysis of RFB data from 2016 to 2019 indicates that an annual average of just 0.07% of Simples Nacional taxpayers were subjected to traditional audit process. Going back to the compliance initiative, it was launched in November 2020, focusing on businesses under the Simples Nacional. The initiative was entirely based on electronic tax declarations and electronic invoices to identify discrepancies. The first phase, known as voluntary tax regularization phase, consisted in sending electronic notifications to taxpayers, highlighting the discrepancies identified, and providing instructions and deadlines for rectification. This phase was announced on the official Simples Nacional website to inform taxpayers and accounting professionals about the operation and the opportunity for regularization. The initiative, as outlined in this official statement, target only enterprise engaged in commercial activities. And this is important. There is a reason for that. RFB only has access to commercial invoices data. In Brazil, municipalities are responsible for service invoice, and Federal Revenue Service still does not have access to this data. The second phase was the enforcement phase and target non-compliant entities that had not rectified their irregularities during the initial stage. These companies were subjected to electronic audits in November 2022, with the identified tax discrepancies being enforced. And what were the results of this initiative? The outcomes can be categorized as either direct or indirect. First, let's talk about the direct outcome. During the voluntary tax regularization phase, nearly 33% of the notified enterprise ratified their declarations, aligning them with the amounts specified in the notifications, which resulted in an additional of approximately $56 million in tax revenue. In the enforcement phase, 9,056 audits resulted in approximately $116 million in tax fines and interest for late payment. We need to say that this is the least important result. The primary objective of the initiative was to encourage voluntary tax compliance and behavior change among taxpayers. It is also important to say that during the voluntary tax regularization phase, broader criteria were applied, as this phase aimed to give taxpayers the opportunity to correct any possible mistakes in their tax filings. In the second phase, the criteria became stricter, focusing on ensuring the accuracy of tax assessments and reducing the chance of future disputes. This difference in selection criteria between the phase helps explain why not all taxpayers who remained non-compliant moved to the enforcement stage. Now, the indirect outcome. Essentially, any indirect effect on voluntary compliance represents the gap between the taxes paid by taxpayers as a result of an intervention and the amount they would have paid in tax had the intervention not occurred. This study focuses on the indirect outcome. We analyzed and verified the tendency towards behavioral change in fiscal compliance among taxpayers engaged in commercial activities, including those who did not receive the notification. The indirect effects were monitored until 2023. We will now present the details of the study focusing on the indirect outcome. First, we looked at the historical trend of annual declared tax under the Simples Nacional. The primary source of revenue data was the mandatory tax declaration to the Simples Nacional, known as PG-D. From 2012, when the declaration started, to 2020, we found a most stable trend line as shown in this graph. However, from 2021 onward, the graph reveals a significant increase in declared taxes that greatly surpassed any other year since the inception of the Simples Nacional. This surge in values declared coincides with the compliance initiative that we detailed before. Since the direct results alone could not explain this increase, a series of analyses was conducted to evaluate the initiative's impact on taxpayers' compliance behavior. Trying to understand the indirect outcome, we developed graphical analysis to estimate the impact of the operation on tax declarations submitted by taxpayers with activities targeted by the operation. This involved comparing the actual tax amounts declared monthly in PG-D with estimate values, which were calculated to reflect the expected growth adjusted for inflation and the expansion of the Simples Nacional taxpayer base. The graphs display two lines. The orange line represents tax currently declared in DPG-D. The gray line represents the estimated values. The analysis of this first graph demonstrates that the actual declared tax revenue significantly surpassed the estimated values. These results suggest evidence of the operation's impact on the increase in declared tax amounts. Then, we designed a second graph, illustrating the annual declared revenue to provide a more comprehensive view of the difference. This graph clearly reveals a significant increase compared to the project growth trajectory since 2021, suggesting, again, a considerable indirect impact of the intervention. Between 2021 and 2023, the declared tax values exceed the estimated declared tax revenue by over $6 billion for the target business activity. The same graph construction methodology was applied to the group of taxpayers whose activities were not targeted by the operation, resulting in this third graph. In a remarkable contrast to the pattern observed in the previous graph, the second group exhibited current tax revenue values consistently aligned with the established estimate. These taxpayers also participate in the Simples Nacional, but exclusively declare service-related activities in the DPG-D. Now, this is the key image of the presentation. It captures the essence of the study, highlighting a clear difference in the behavior of the two groups. Then, let us talk about the conclusions. The study suggests that the initiative contributed to an increase in tax compliance within the Simples Nacional regime, primarily through behavioral changes influenced by heightened perception of fiscal presence and audit risk. The effect was not limited to the taxpayers who were directly notified, but extended to others engaged in the same activities, indicating the presence of indirect effects. One relevant aspect that may have contributed to the observed indirect effects is the organization profile of companies under Simples Nacional. Often, they do not have internal accounting departments. These businesses usually use outsourced accountants who work for several clients simultaneously, which facilitates the rapid dissemination of information. As information is spread within sectors, including through informal channels and official communications, taxpayers who are not directly notified became aware of the initiative. This broader awareness may have contributed to a more cautious and compliant posture across the sector. Another important aspect that may have contributed to the observed behavior shift was the enforcement phase implemented in 2022. By auditing over 9,000 taxpayers who failed to comply and applying fines and late interest, the second phase served to demonstrate the seriousness and credibility of the operation. As a result, even those not directly targeted may have perceived an increased risk of fiscal intervention, which likely contributed to a broader compliance. The notice published on Simples Nacional website made it clear that the operation targeted only commercial activities. Consequently, taxpayers not involved in these activities may have not perceived any need to regularize their situation, resulting in the absence of a significant change in their tax behavior. The magnitude of the operation also strengthens the findings. Approximately 26,000 taxpayers were involved in the initial notification phase, adding robustness and external validity to the results. These findings not only align with previous research, but also provide further insight into the effectiveness of compliance effort within simplified tax regime. Finally, this result raises a relevant question. If taxpayers begin to expect periodic enforcement, will they delay compliance until formal notification is received? We don't have the answer yet. This possibility shows the importance of continuous monitoring. Future studies will be essential to assess whether the current pattern of compliance persists or gives way to strategic weighting behavior. As a preview, we can say that we have some clues. The analysis is still ongoing, but in our latest initiative, launched in 2024, we observed a stronger direct effect, with regularization reaching 51% during the voluntary regularization phase. However, indirect effects appear to have decreased. Perhaps one of the authors will return in a future edition of this conference with new studies trying to answer this question. That concludes my presentation. Thank you all for your attention.
Thank you for that, Vinicius. We'll welcome our last presenter, Patricia, to the stage.
Good morning, everyone. I'm Patricia Lamadri, a tax auditor at the Brazilian Federal Tax Administration, just like Vinicius, who preceded me. We call our institution RFB, and that's how I'm going to refer to it during my presentation. It's a pleasure to be here and to share an overview of CONFIA, that is Brazilian's cooperative compliance program, focusing on its development, governance challenges, and most importantly, on its costs and benefits observed so far. A quick curiosity before we begin. The word confia means trust in Portuguese, a concept that sits at the heart of the entire initiative. The conceptual foundation of CONFIA comes from OECD's 2008 report called Study into the Role of Tax Intermediaries. That report introduced 5 pillars to support an enhanced relationship between tax administrations and large taxpayers: understanding and respect, transparency, disclosure, responsiveness, and mutual trust. The goal was to shift from an adversarial enforcement-heavy model to one based on collaboration, dialogue, and voluntary compliance. In 2013, a follow-up report introduced the concept of cooperative compliance, which added a crucial element, the tax control framework, internal systems that companies use to manage tax risks. OECD encouraged tax administrations to assess these frameworks and tailor their compliance strategies to the profile and behavior of each taxpayer. These were the guidelines that inspired the design of CONFIA. In 2021, Brazil's RFB launched CONFIA to adapt this model to the national context. The primary objective was, and still is, to enhance legal certainty by offering faster and clearer interpretation of tax rules in order to prevent litigation before it arises. It's important to emphasize that CONFIA is not about increasing tax collection. It's about building a relationship based on trust, in which taxpayers are encouraged to comply voluntarily and the tax authority takes a proactive and service-oriented role. So, why was such a program necessary in Brazil? Vinicius already talked a little bit about Brazilian context, and I'm going to add some elements to his speech. So, first, the Brazilian tax system is notoriously complex. Tax rules change frequently, and their interpretation is often unclear. This generates high levels of uncertainty and, consequently, a massive volume of litigation, which is costly both for the government and for taxpayers. Second, historically, trust between RFB and large taxpayers has been low. Relationships, as Vinicius showed us, were primarily based on audits and control mechanisms. Third, even though RFB has invested heavily in digital services, these are mostly automated and designed for standard cases. Large businesses, when facing complex or atypical issues, often struggle to get answers, especially when their problem involves more than one department within RFB. This is partly due to RFB's vertical structure, which makes cross-area cooperation difficult. These contextual factors helped shape CONFIA's structure and goals. CONFIA's governance rests on two main bodies. The steering committee, composed of RFB senior management, which sets guidelines and approves programs decisions, and the Dialogue Forum, which includes 40 large businesses selected based on objective criteria, along with 3 business associations representing large taxpayers. The forum plays a central role in developing proposals and testing solutions. Its design is a major innovation. It brings the taxpayer into the process of policy design, not just implementation. CONFIA was built gradually in 5 stages. The first step was aligning expectations internally within RFB and externally with the private sector. Only after that, the governance bodies were formally established. The design phase followed, where both RFB and taxpayers worked together to create the program. And it was here that challenges emerged. The main difficulty was designing a program that offered real value to taxpayers while still requiring tangible commitments, such as transparency and timely disclosure of tax risks. Another challenge was legal. Brazil's tax penalty system didn't allow enough flexibility to support the cooperative model. The solution was twofold. RFB offered a limited version of services as a test to participating companies. And RFB proposed a new approach to penalties for CONFIA participants, allowing reductions based on their transparency level. With this, CONFIA moved to a pilot phase, which is where we are today. Before the pilot, an important intermediary phase called procedures testing took place. Between August 2022 and April 2024, 9 volunteer companies worked with RFB to test the processes developed in the Dialogue Forum. This allowed both sides to assess feasibility, build confidence, and make final adjustments. At the end of the test, a survey was conducted to understand what worked and what didn't. And these insights directly shaped the design of the CONFIA pilot program. The pilot began in April 2024, expanding eligibility to 1,600 companies subject to RFB's special monitoring. To ensure fairness, participation was subject to opt-in procedures and eligibility criteria. Quantitative criteria included gross revenue above $360 million, total tax paid above $18 million, and tax debts under litigation not exceeding 30% of gross revenue or assets. Qualitative criteria included the existence of internal tax governance structures and compliance with return filings and payments. This combination aimed to ensure both objectivity and equal treatment. The opt-in process had 5 steps. The first was the self-assessment by the taxpayer. Second, the application submission with forms and documentation. The third was a validation phase done by RFB tax auditors. The fourth was the development of a compliance work plan, and we will talk about this in the next slide in more depth. And the fifth phase was certification. Out of 31 applications, 24 were validated and 20 companies were certified and entered the pilot program. The compliance work plans are at the core of Confia. They identify the most relevant tax issues for each taxpayer and define how they will be addressed cooperatively with RFB during a defined period. This step was the most demanding for two reasons. Plans were designed in dialogue with each company, and their preparation involved multiple technical areas within RFB. By August 2024, 127 tax issues had been agreed upon, and by the end of that year, 35 were fully resolved, 62 were in progress, and 30 had not been initiated. Delays were largely due to external obstacles, a national mobilization of tax auditors, delays in administrative restructuring, and the fact that the Confia bill has not yet been voted by the National Congress. As a result, the new system of tax penalties that is essential for the cooperative model is not yet in force, which continues to hinder the full implementation of the program. In 2021, researchers from the University of Vienna proposed a methodology to measure the costs and benefits of cooperative compliance. They identified three guiding principles. There's no one-size-fits-all approach. Comparisons must be made to the current strategy, and transparency and dialogue are central benefits. So far, Confia has brought measurable and qualitative benefits. We can see more legal clarity. So controversial topics were clarified and institutional positions were issued. Voluntary regularization, leading to tax revenue and penalty reductions. We had real-time guidance on new legislation, for example, in the transfer pricing reform. We also had expedited issuance of federal tax or federal debt clearance certificates, improved internal governance for both RFB and companies, and also direct channels of communication through designated focal points. Three main types of costs were identified. The first one relates to trust building. RFB had to offer new services, and companies had to adapt to transparency and governance standards. The second cost is related to cultural change, requiring capacity building, joint planning, and open dialogue. And the third type of cost relates to regulatory adaptation. While many steps of the program were implemented administratively, some features require legal change, and these have a political cost because discussions move from an exclusively technical environment to a political one, where other interests and forces operate. To justify the future expansion of Confia, we have identified 5 evaluation parameters based on the pilots: compliance behavior, risk management, institutional improvement, litigation reduction, and tax certainty. The challenge now is converting these into measurable indicators. One final point, RFB is working with the Brazilian Association of Technical Standards and the private sector to develop a soft law standard for tax control frameworks. The resulting technical norm, Tax Compliance Management Systems, is expected by late 2025. It will serve for self-assessment or certification, which may become a requirement for joining the definitive Confia program. To learn more more, I invite you to visit Confia's website or reach out through the email provided. Thank you for your time and attention.
I'd like to give a special thanks to all our presenters today. That was amazing. Next, we'll welcome our discussant to the stage, Lee Liu.
Okay. Thank you all for being here, and thanks again for the opportunity to discuss this session of 3 very interesting papers, for which I learned a lot from reading them and even more from the real-time presentation. And I particularly enjoy this international perspective, and perhaps that's why I'm discussing it, but the standard disclaimer also apply. The views expressed here are my own and not those of the International Monetary Fund. So my comments will basically focus on the big picture. So for example, how to strengthen the policy message of these interesting papers, and what are some of the implications on the broader tax system. So first, just a quick summary of my main takeaways from these 3 papers. So stronger enforcement in tax filing and payment improves compliance for business taxpayers in the US. And these initiatives can translate to lasting tax revenue increases, even in a different context, which is Brazil, a large developing country, including those that are directly affected, but also indirectly affected. The third paper, cooperative compliance initiatives, can also have the potential to improve the quality of the tax administration, therefore complementing this sort of more traditional type of enforcement initiatives. So what are my comments? Starting on the first paper, it's super interesting just to see that non-compliant business taxpayers do respond to different IRS compliance programs initiatives, both at sort of the extensive margin by starting paying off the debt, and also by reducing the balance. And the impact of these different programs differ. So these results are quite interesting. So my comment was just basically focusing on how to strengthen the analysis to establish sort of the more causal impact. So maybe just to start from some simple descriptive statistics, just to have a better understanding, what is the population of the non-compliant business taxpayers, for example, where they are, what industries they operate, what are their basic financial statistics, and who the owners are, right? Just to sort of better understand what are sort of the primary drivers of being non-compliant in the first place, and how their basic characteristics differ from sort of the population of otherwise similar compliant peers. Because, I mean, the jargon is all of these are endogenous decisions. So basically sort of how do we do a good job to control sort of the primary factors that lead to non-compliance in the first place. So sort of trying to do that, I also wonder whether use of sort of a panel data set in addition to cross-sectional data set would help by tracing sort of the history, the characteristics of the non-compliant guys over time. And also, I mean, even within this sort of population of non-compliant guys, someone who is sort of failing their business and not able to comply, presumably is quite different comparing to those who are sort of recurrent non-compliant businesses. So just sort of have a better understanding of who we are focusing and targeted at. And also maybe you can also try to use some more sort of quantitative variables to capture sort of the impact of declining IRS resources. For example, you know, like some measure of staff or budget cut. instead of the use of these year dummies, which sort of consistent with the explanation that shrinking IRS resources lead to sort of smaller impact, but sort of measure it more directly. So another comment is, this is interesting, and even sort of to further inform operation, perhaps it will be, I think it will be important to understand the overall impact of these different enforcement programs. So combining the extensive margin, whether you start paying off your debt with the intensive margin, right? How much debt do you reduce? And then these are super easy to do in some kind of the econometric models, and which is also essential to identify which measure, which program are the most cost effective, right, in achieving compliance. So that's so much of my comments on the first paper. Moving on to Velicious' comment, again, it's super interesting, especially to see that there is a sustained tax revenue increases in the sectors that the operation was targeted, even including those who did not receive the notification. So that sort of, to me, is the most interesting result of the paper, and sort of I would like to see a little bit sort of in-depth analysis on the scale of the indirect, especially now you're planning the second study on this subject. So first of all, perhaps you can think about sort of separate projection of revenue for taxpayers that did not receive the notification, but also in the targeted sector, just to understand, right, the scale of spillover. How much of tax revenue increase are we talking about for those who did not receive the notification? And this could start some more sort of more systematic analysis into the different channels of spillover, whether it's an auditor effect, whether it's sort of taxpayer effect, or whether it's sort of like spillover through their business linkages. So to me, those are all super interesting questions. And sort of moving on to a broader perspective for the tax policy and tax administration together, I keep asking myself, right, and which already talked about, the goal is to increase voluntary compliance. But if the goal is also to increase tax revenue through better compliance, or at least part of the goal is to increase tax revenue, I wonder what else can we do beyond enforcing enhancing the enforcement. And whether we can improve the design of the simpler program. By saying that, what I mean is the simpler program is a presumptive tax regime, right? And which is basically covers, as you say, 70% of all companies in Brazil below sort of a certain threshold who, like the business can sort of qualify for the presumptive regime. Typically, a simplified regime or presumptive regime is there to help bring down the compliance cost of taxpayers. But in the case of Brazil, the threshold is extremely high. If you compare to sort of countries of other development level. So it's close to 900,000 US dollar, and it's there to replace more than corporate income tax. So it replaces corporate income tax, it replaces payroll tax, it also replaces value-added tax and social security. So to me, so that's sort of like wait a moment, right? In addition to sort of, reduce the compliance cost of these businesses, such an overly generous threshold may have some adverse impact. And then also with the same authors, you find that there is significant bunching of companies below the threshold. And the moment you replace the VAT with the simplified taxes, you take away sort of this self-enforcement mechanism that is building into the VAT production chain, right? So if you also look at this chart, which basically shows what is the revenue foregone through the simplest program compared to sort of other large tax expenditure items, this is one of the single largest tax expenditure items in the federal corporate tax measures, right? Accounting for
more than 1% of GDP. So which to me seems to make a strong case to lower the threshold, also which would allow the tax auditors to focus sort of more on the more well-defined population of small taxpayers. So that's so much about the second paper. Now moving to Patricia's paper, again, I quite like the paper. There is also lots to like about the Confia pilot, right? By adding tax certainty, allow for transparency, the use sort of this real-time monitoring and cooperation between the businesses and the government. And also, I also quite like sort of the perspective of bringing insights into the policy design, right? You sort of learn the business operation of the largest taxpayers, and through that, you can bring valuable insights to reform sort of policy in transfer pricing or interest limitations, so sort of also inform the design at a higher level. So that's a lot to like about the pilot program. What I didn't quite like the program is to give away sort of the authority of revenue administration, so to speak, tying their hands, right? By either having to reduce the penalty or exempting the fines for the non-compliant participants. So that's something I don't quite much like about, especially when you look at sort of who participate in the pilot program. They're the largest ones. So I worry it might backfire, right? And given sort of the public, the general perception that this particular group of companies can somehow negotiate out of the tax obligation. And sort of in a large developing country context, to me, there is also sort of opens up invitation for rent-seeking and corruption, especially when sort of the institution and governance are weak in developing countries. So those sort of my reservation with the pilot program. So now we're talking about sort of introducing the bill to move along towards a full program. So my sort of thoughts over there is that perhaps could the full program align more closely with sort of the Spanish model, so providing a forum of dialogue, as you hinted, and sort of learning and discussing about sort of the tax administration issues without sort of adding on this precondition of giving away or lowering the penalties for the participants. And also, perhaps I think it's also a good opportunity to remind us that Confia does not take away some of the structure weaknesses in the larger system. So for example, in litigation, right? So while sort of the tax tribunal have equal representation from the government and the businesses, and also, well, there is no requirement to guarantee the tax stat when you sue the government. So which makes it much more easier to challenge the tax administration in Brazil comparing to many other countries. So again, so that's sort of my quick thoughts of what are the lessons we can take toward moving toward a full program. So with that, thanks again for the great papers. Thank you.
Yes, thank you, Lee. You provided amazing insight, and I'm sure you've left a lot for the presenters as well as the audience to think about. We'll go ahead and move on to the question and answers portion. And this first question is for you, Yan. Was there any thought in separating the actions taken by field collection versus that of ACS? The operational approaches between the two functions in the IRS are completely different.
So now the ACS letters and field collection, they are separated.
Are you asking me?
So the question is, ask me why I separated them, or like
Yeah, it's essentially asking like, what was your thought process in separating the actions taken by field collection versus ACS?
Oh yeah, so the ACS is the letters. So I include two types, letter 11 and letter 16. And field visits is you personally visit that taxpayers. So I consider they are separate.
Perfect. And a follow-up question for you again, Yan. For the model on the non-compliant business taxpayers, why utilize a fixed effect model with ordinary least squares versus a variable effects models with generalized least squares?
So why I use the ordinary least square instead of the general fixed effect?
Yes.
This is, I think I should explain clearly. This is pooled cross-sectional data. So that's the only thing I start with. It's not panel data.
And our last question for either you, Patricia, or Vinicius can answer. What is the voluntary tax compliant rate in Brazil prior to the interventions?
Prior to the intervention, it would be necessary to have the calculation of tax gap, yes. In Simples Nacional, we had a study about this, and I think that it is about 20 to 30% on non-compliant taxpayers.
Patricia, did you have anything to add to that?
No, I actually don't know the number.
Not a problem at all. Well, that was our, we have one more question for you, Patricia. If a taxpayer disagrees with an administrative position clarified under this program, what happens? Does the issue go to conventional litigation, or is there a dispute resolution process within the program? And how does this matter for potential penalties levied for noncompliance?
So nowadays, if the taxpayer disagrees, if we cannot reach a consensus, the way that the taxpayer will have the ordinary ways to dispute, like go to tax court. But more recently, RFB has created new programs that are not still fully working, but they're going to be different forums to try to solve these disputes. So we're working on having a different forum for resolving these cases, but nowadays they go to normal tax court.
Perfect. Thank you once again to our speakers and our discussant. That will be all for our question and answer portion. And it looks like we are wrapping up a bit early today. So thank you once again, everyone, for joining us for the second session. We'll go ahead and let you all give your time back for lunch. Thank you.
I'd like to introduce our keynote speaker, Alan Plumley. Alan is a former technical advisor in the IRS Office of Research, Applied Analytics, and Statistics. His expertise is in the areas of compliance measurement and modeling for efficient workload selection and resource allocation. A 40-year veteran of IRS research, Alan earned his PhD in public policy from Harvard University. His dissertation on the determinants of individual income tax compliance broke much new ground in the effort to estimate the impact of various IRS activities on the voluntary compliance behavior of the general population. He has presented research papers at many tax conferences and has co-authored chapters for 2 books related to tax administration and compliance. Please join me in welcoming Alan.
Well, it's good to be back. Retirement is good life. But it's been fun to connect with colleagues and friends. I thought it would be interesting for you all, and to some extent me, to talk about tax simplification. And when I think of tax simplification, I kind of think it's like what Mark Twain supposedly said about the weather. Everybody talks about it, but nobody does anything about it. And this may be like that. So I guess the question is tax simplification even possible? Now, you may be thinking it's pie in the sky, but from my perspective, which is from the viewpoint of a taxpayer and a tax administrator, I think it is possible. And I'd like to present to you 6 characteristics that I've identified. There may be more, but 6 essential characteristics that I've identified if we were going to have a simple tax. And this comes from over 50 years as a taxpayer, 40 years in tax administration research, and I'm sure over 40 years of listening to regular taxpayers. And so certainly while I was at the IRS, I would be involved in conversations when I meet somebody, and eventually they would say, so what do you do? And I would say, well, I'm an economist at the IRS. And it's at this point that I'm very thankful that the IRS is America's most beloved agency. But eventually they would say, so what does an economist do at the IRS? And I would say, well, I'm in research, and I seek to understand the nature and extent of noncompliance with the tax law so that we can figure out how to reduce it. And if not immediately, certainly eventually, the person I'm talking to offers a comment like, it's just so complicated. Taxes is so complicated. Can it be simpler? As if the IRS could do something about that. And so that's been my life for quite a while when I'm involved in conversations with people. Well, anyway, these are 6 characteristics that I've come up with. A truly simple tax would be straightforward. I think by definition, right? It would be easy to understand, easy to calculate, straightforward to administer, make it easy for most people to meet their tax obligation exactly in real time, and therefore cost most taxpayers no additional money and very little time to meet their tax obligation. So now you probably are thinking pie in the sky, right? But that's sort of the definition of straightforward, of simple, to meet those characteristics. But a second characteristic of a simple tax is that I believe would have to be based on individual income tax base. When you think about it, all recurring taxes are ultimately paid from people's incomes, whether those people are owners of businesses or employees of some company or consumers, whatever it is, their recurring taxes are going to be falling on them as individuals and should be directly and clearly imposed on that income to be simple and intuitive in most people's minds. A benefit of that, I think, is that all taxpayers would be voters who know how much tax is imposed on them and would keep their elected representatives who impose that tax accountable for how much tax is imposed on them. Another thought is that we say that a tax is progressive or regressive relative to individual income. So it makes sense for that to be our base. And ever since the 16th Amendment was added to the Constitution, people have gotten kind of comfortable with a personal income tax. Well, that would certainly make it easier to be simple. A third characteristic is that a simple tax must be manageable. The tax authority needs to be able to administer it. And I offer as a counterexample corporate income tax. We've had some presentations already today that touch on that. But when you think about it, a large multinational corporation, their activities are so complex, the law is so complex, that even though they're under constant audit from the IRS, literally constant audit, at the end of the day, they close that audit, neither the corporation nor the auditors know what the true liability is. They just have to move on to the next one. It's really, when you think about it, not very administrable. But taxpayers need to know how much they're paying. And again, with any tax that's imposed on a business, that's going to get passed through one way or another to individuals, whether it's the owners, whether it's the employees or the consumers. And those employees and consumers particularly, but even the investors, have no clue what the tax imposed on that institution is. And so it needs to be more transparent and manageable. But then the tax authority needs to verify eligibility for tax benefits that taxpayers have to, taxpayers claim, and the tax authority has no basis for evaluating whether that claim is legitimate or not. And so inevitably there's a need for, under the current kind of system, for people to reveal very private information about themselves to justify their legitimate claim. And so claims for offsets to income, like deductions, and claims for offsets to tax, like tax credits, are good examples of that. Well, fourthly, a simple tax must be permanent, not changing every year. I know when I came to the IRS, a year later, Congress passed Reagan's Tax Reform Act of '86, a much ballyhooed tax reform, completely redoing the tax code. And yet, over time, over the next 20 years, enough had changed that another presidential tax reform panel was constituted to try to make more sense of it. And I think they eventually gave up because nothing came of that commission. It has to be stable and predictable if it's going to be simple. And of course, a moving target frustrates everybody, whether it's the taxpayers or any intermediaries and so on. It's a moving target. Nobody likes it. And one reason is the cost of change and uncertainty are high, whereas a stable environment that's very simple would be no problem at all. Okay, well, a simple tax, I believe, must also be limited. Limited, first of all, in its capacity to generate revenue. That may seem counterintuitive, but being simple for taxpayers should not mean easy to raise taxes. Making the tax completely visible to the voters who pay it will help. And having just one tax bracket would help to moderate the rate. It should also, though, be limited in its capacity to manipulate behavior. Incentives and disincentives greatly complicate a tax. I don't have to convince you of that. And then lastly, it ought to be limited in its capacity to collect personal information. And again, income offsets and tax offsets are the biggest culprits there. And then 6, a simple tax must be equitable. Equitable, of course, speaks of being equal. Everyone must be treated equally, fairly. Inequities, of course, undermine both simplicity and voluntary compliance. Complexity breeds noncompliance. Not only should every person be treated equally, but every dollar of income should bear the same tax rate. That would be simple. No exemptions, no adjustments or deductions to reduce taxable income, no tax credits to reduce tax. You know, the people who have raised this issue of complexity with me said, I'm willing to give up all of that for something that's just simple, right? And no graduated rate structure either. So it would be neither progressive nor regressive. For most people, it would be very much like our current Medicare tax, except that that applies only to earned income. But the concepts are very similar. Well, you're probably already asking, do progressive tax rates really cause complexity? Yeah, it turns out they do. Imagine a tax system that deviated from these principles only due to progressive tax rates. Well, how would that show up? Well, someone with 2 or more sources of income, say from another job or from a pension, whatever, needs to know what the income is from the other sources of income in order to get withholding right, that is prepayment in real time right. You need to know all the other sources of income. Several times, because I work at the IRS, people would come to me and say, hey, you know, we just got married, we changed our withholding from single to married, and we're shocked that we had a huge tax bill at the end of the year. What gives? Well, what gives is that if you have a graduated rate structure and a withholding system that reflects that, a withholding system that of necessity treats each job as if it were the only job, then you could have one job, let's say here, with $120,000 of income. The withholding on that with the current rate structure would be just over $16,000. But then you have another job with $80,000 of income. The withholding on that would be just over $9,000. So we'd have a total of $200,000 of income and $25,351 of withholding, which unfortunately is less than the tax that would be imposed on the combined income. And that difference in this example is almost $8,500 of under withholding, purely because of the graduated rate structure and the fact that each job is of necessity treated separately. So the second job should have been withheld at the marginal rate of the first job or the higher paying job. It would have been very simple. But to do that, the employee needs to make an adjustment to their withholding. How do they do that? Well, there is a Form W-4 that employees submit to their employers to indicate how their situation is not the simple situation. And the two-job situation scenario is one of the big reasons for this. But if you look at the current W-4, it offers 3 choices as to how to handle that particular problem. And the first one is to use the online withholding estimator. And the comment here on the W-4 is that this is the most accurate, which it is. But it gives 2 other options that are not as accurate, but maybe a little bit simpler. The middle one, it requires going to some worksheets and and using a lookup table, and it's approximate, it's not exact. But a more simple option is the number 3, where if your 2 jobs are roughly the same size in income, you can just check that box and your withholding will take care of itself. And it'll be fairly accurate, particularly the closer the 2 jobs are in income. But you notice in these examples, or these 3 options that are given to the employees, you've got the issue of accuracy and a trade-off with simplicity. And if you check that box, there's definitely a trade-off with privacy. Do you really want your employer to know that you've got another job of roughly the same size? Maybe not. And if we're on the subject of privacy, the rest of the W-4 that deals with not the marginal rate, but offsets to income or offsets to tax or even other income, you have to reveal a fair amount to your employer in order to make these adjustments to your withholding. It turns out that withholding tax from sequential or part-year jobs has a very similar problem because the withholding system assumes that you're earning this kind of income for the entire year. And if you're earning it for only a smaller portion of the year, like a summer job, it's likely to put you into a higher tax bracket than the one you will face on your return. So it leads to over-withholding. And I think a general comment here is that graduated marginal tax rate brackets generate an incentive to understate income, particularly just above the bracket thresholds, where a little bit of underreporting can result in a lower tax rate. All right, well, most flat tax systems that have been proposed are actually not flat tax. They actually have 2 rates. One is 0% with a large standard deduction, and another is a uniform rate on everything above that. So that doesn't have what we normally think of as graduated marginal rates, but really it is. It's 2 rates, and it causes the exact same problems that we've already looked at. So, what about vertical equity? Equity, of course, refers to being equal. The rationale here is that those with higher incomes have the ability to pay a higher percent of their income. And by the same token, the poor have virtually no ability to pay. Well, what that's saying is we're approaching this from the perspective of from each according to his ability, to each according to his need, which you might remember is the basic tenet of socialism. And it's now enshrined in the US tax law. There's a problem with that. One is that it's the government who decides what your abilities are and the government who decides what your needs are. Perhaps a more important problem with that is that government redistribution of income undermines personal responsibility on the part of both the donor, like the taxpayer, and the recipient. So rather than trying to figure out what are the causes for this poverty, we're just throwing money at it. And it undermines personal responsibility across the board. Well, some people you might recognize have commented on these topics. Adam Smith, generally referred to as the father of modern economics, said the subjects of every state ought to contribute toward the support of government as nearly as possible in proportion to their respective abilities. That is, in proportion to the revenue, that is, the income, which they respectively enjoy under the protection of the state. His Scottish colleague, J.R. McCulloch, went further to say, the moment you abandon the cardinal principle of exacting from all individuals the same proportion of their income or property, you are at sea without a rudder or compass, and there is no amount of injustice or folly you may not commit. I think he was probably responding to his own experience in that regard. And then good old President Calvin Coolidge, about 100 years ago, said, "I do not believe that the government should ask social legislation in the guise of taxation. If we are to adopt socialism, it should be presented to the people of this country as socialism and not under the guise of a law to collect revenue." Well, I probably killed some sacred cows. But what would a simple tax look like? Yeah, it would have these 6 characteristics which conveniently spell out the acronym SIMPLE. How would we do it? Well, if it were straightforward, you could expect to be able to withhold exactly at the source, benefit from third-party information reporting, of course, and everybody's treated the same. If it's individual income based, then all realized personal income, net of expenses incurred to generate business income, would be the tax base, and there wouldn't be any other taxes. It would be manageable. No indirect taxes, like those placed on businesses. No offsets to income or tax. We'd ignore losses and so on. Now, permanent and limited, I think, would require a constitutional amendment, specifying the tax base and allowing Congress to change 2 things: the tax rate by normal procedures, and number 2, the definition of net income, but only by a supermajority of both houses. It would have to be limited. And then finally, it would have to be equitable, and that every dollar of income would be subject to the same rate. Well, there obviously would be some practical considerations there. Something like this couldn't be implemented piecemeal, which is what we're sort of used to. It has to be by popular demand. I don't imagine any legislator is going to propose anything close to what I've just described. But if it's by popular demand, they might. Probably also in your thinking is, well, what about the winners and losers? You know, I have found it puzzling that we've gotten ourselves into a rut where we try to identify who the winners and losers are for a given tax proposal, and we always compare what the impact would be under the proposal with the status quo, as if the status quo were something to be proud of. If it were, why were we trying to change it, right? We ought to be comparing what we're moving to the ideal. And if we're doing that, I think the winners will be people who are suffering under the current regime, and the losers will be those who are advantaged disproportionately by the current tax law. And I think that's probably a more useful way to think about that. All right, well, whether I've killed any sacred cows today, I think at the very least I've hoped to cause you to think objectively about why and how we could possibly make taxes simpler. And I'll open it up for questions. I understand that there is a mic around for those in the room. If you've got a question, be happy to entertain any of those. Sounds like one over here. Yeah.
Hi, Elaine Mogg, Tax Policy Center. One of the, as you no doubt know, the largest anti-poverty program for working age people, the Earned Income Tax Credit, is operated through the income tax. And it violates a lot of what you're saying here. But we do that in part because it makes it simple to support people. They're already filing tax returns, the IRS already has a lot of information about their incomes. And so I think when you think about simplifying the tax system, it's sort of a simple, like an oversimplification, because we ought to be thinking about trying to make people's lives simpler, not just one aspect. And so I would submit that sometimes our very complicated tax system actually does that. And I'm curious how you would balance those two issues.
Yeah. Do you know how many pages are currently in the instructions for the EITC? A lot. That's not simple. No. And of course, the IRS doesn't have information at its disposal to verify eligibility. And so it, by definition, requires a lot of justification on the part of taxpayers. How many people who claim EITC actually pay a preparer to help them sort through all this mess? A lot. If we want to target certain populations for government support, I don't think the tax system is the right way to do it. That's my opinion.
Sir, wouldn't it be much simpler if we abolished the income tax and went to sales tax and collected the same amount of money? Wouldn't it save in terms of cost of collection and sparing your entire population of keeping records and all kinds of stuff?
Yeah, of course, there's a lot of interest in a national sales tax. Of course, the biggest problem with the sales tax is it's regressive. It's borne by the lower income, relatively speaking, and can, for the most part, be avoided by the wealthy. Yeah.
Carl Polzer, inequalityinc.org, and I advocate for the bottom 50%. Now, I've used that same quote from Adam Smith, but I read it differently. I interpret it differently. You're sort of interpreting it that depending on how much you benefit from this protection of the state, the rich and the poor would contribute the same percentage. But if you read it, if just the amounts compared, like if Elon Musk is benefiting to the, $10 billion and the dishwasher's getting 20,000, that's a different ratio. So you can come to two different conclusions on that one.
Yeah, that's why I included the McCulloch quote, which went a little bit further and said, well, anyway, what he said is if you depart from the same rate for everybody, basically the same rate for every dollar, there is no theoretical, this is the right answer. And so he says you're without rudder or compass. There's no direction there. Yeah. There's one back there.
Two quick questions. One, is there an event or series of events that you could see happening that would garner support for a simple tax? That's one question. And then if you want to answer that first, I'll wait.
Yeah, I would imagine that if my assessment is that the only way this could ever be sustainable would be with a constitutional amendment. And that's, the initiative for that isn't going to come from the Hill, I wouldn't think. People would just have to get fed up enough to say, let's put together a constitutional amendment and force Congress to put it in place. I don't know what would trigger that. I certainly couldn't.
Second question is, have you done any modeling around what a simple tax percentage might be that would, equate to similar revenue returns?
I did years ago, but I gave up because the only data you've got is the income that people report on their returns, and that's not the issue. The issue is, what is their actual income? And as we know, noncompliance is a big problem. Yeah, I've done some back of the envelope things. It's years ago, but haven't recently. Yeah.
Hi, thank you for your presentation. I think it gives us a lot of insight into thinking about the other side of taxation that we usually don't think about, and it just gives us a lot to add on to how we currently run the tax system. The one question that I do have is that when you talked about winners and losers towards the end, it sort of felt like you were just defining what a winner and loser is. Like winners will continue to be able to benefit from the tax system, and losers will continue to lose because of currently standing incentives. When you actually go ahead and try to model, maybe making between like any reasonable estimate of what that tax would look like, that rate would be like, how does that sort of refactor into how that would impact government expenditures, like how maybe politicians would feel about, spending on certain projects? And beyond that, how would that just impact the current state of economic inequality within the country that we see impacting politics at the level it does today, which inherently has economic impacts?
Yeah, I wish I had a crystal ball. Clearly, this would reveal the extent to which behavior is being modified by the tax system at the moment. And some of those things would go away, some of them might not, I don't know. But often these days, particularly in business economic decisions, there's always the question, well, what's the tax angle? And for the most part, that can just be set aside if it's really simple. So, yeah, very good question. I don't know the answers to it, but I think it would become more obvious the more people think in these terms, and maybe even how to quantify it. But that may be naive. I don't know. Yeah.
Sorry, thank you. I was just curious on what your thoughts are in regards to all aspects of non-income wealth generation, things like capital gains, estates. What's kind of preventing, an uber rich person from, passing away, leaving millions upon millions to their kids, and they never have to pay, tax on that.
Yeah, that's a very important question. That's why I mentioned that the income base or the tax base would be realized personal income. So at the there are pros and cons, but I think the simplest approach would be when it's realized, you pay tax on it. Yeah. I'm told we have to wrap up. Does that mean no more questions or one more? No. Okay. We've been doing a great job today, keeping on time, and so I'm listening to them. Thank you.
We're going to start on to session 3, and we're going to be discussing investigating filing behavior and underreporting, and various different papers that are sort of relevant and associated with that. My name is Timothy O'Brien. I work at Statistics of Income in IRS as part of the projections team that handles projections and forecasting for a bevy of taxpayer forms and information returns. We do the aggregated volume projections of processing of those items. So as I probably don't have to tell any of you, IRS has a large pool of information and data available at its fingertips. And as we continue to modernize, we're better able to leverage this data to provide internal and external stakeholders and taxpayers with more transparency and understanding of America's tax system. It provides us with better information when we receive good information from taxpayers and external parties via tax forms and information returns. And we can then use that understanding and information to then better figure out what sort of things are going on in the tax system, but also the economy at large. Each of our three speakers in this session will discuss how utilizing IRS data can enhance understanding of taxpayer filing behavior and can inform future decision-making. Our first speaker, who's coming in remotely, is Amanda Eng. She'll be discussing how a new look at amended returns processing can be used to improve processing of individual returns. Our second speaker, Patrick Langeteeg, will discuss how information returns, such as the W-2s and 1099s and et cetera, relate to the filing patterns and how filing type relates to underreported income. And our third speaker, Mike Odell, will discuss how he and his team utilized very granular weekly individual return and processing data to assess how return processing and taxpayer compliance can be impacted by both exogenous events, such as what we had during COVID, as well as changes in congressional tax policy. And then our discussant for this evening, this afternoon, is Stephen Hamilton, who's an assistant professor of economics at George Washington University. He began his education in Australia and has worked with the Australian Treasury as a policy analyst and published several studies in the realm of public and household finance. And with that, I'll start it off with Amanda, who is our first speaker coming in remote.
Sorry. Can you all hear me okay? Hopefully. All right. So hi everyone, thanks for coming. I'm Amanda Ing. I'm an economist in statistics of income. And I'm going to be talking today about characteristics of amended returns and amended return filers. So the standard disclaimer applies here that these are my opinions and not those of Treasury or IRS, and everything has gone through disclosure avoidance review. All right, so what are amended returns? Taxpayers file amended returns to correct previously filed returns. So individual income taxpayers specifically use Form 1040-X to report original values, changes to those values, and corrected values. And in general, tax units that are filing a 1040-X for a credit or refund need to file within 3 years of filing their original return. So why would we want to study amended returns? So SOI estimates currently don't include amended returns, and we'd like to better understand how amended returns might affect our estimates. We have looked at this question before, so Dennis et al. 2021 specifically looked at 2013 amended returns. They looked at individual income tax and corporate tax returns. I'm just going to focus on individual returns today, but you can think of this as a sort of update to that work. In addition, beginning in 2020, taxpayers could e-file their 1040-X for tax years 2019 onwards. And this change provides some new opportunities to understand why taxpayers file amended returns and gain insights into the adoption of e-file options. So in particular, our database captures more details about e-filed returns, which can allow us to see things like the types of changes people make and their write-ins for why they're filing an amended return. And then lastly, IRS has been interested in improving the processing of amended returns, which requires knowledge of amended return filing patterns. So for this study, I had 3 broad research questions. What are the characteristics of tax units who file an amended return? What are the characteristics of tax units who e-file an amended return? And then how do amended returns affect tax liability? Everything I'm going to present today is going to be descriptive statistics, and I'll give you a quick preview of what I'm going to show you. So tax units who have higher income on their original return have a higher propensity to file an amended return. And then just looking at the first full tax year when taxpayers could e-file, so 2020, we find that amended return filers who were younger and had higher income on their original return were more likely to file electronically than older or lower income groups. And finally, amended returns overall decrease tax liability, but there's significant heterogeneity across tax units. So for this presentation, the data that I'm going to be using is the IRS population tax data, so not the perfected SOI sample. In future work, I do plan to bring in the SOI sample, but I haven't had time to do that yet. And I'm going to be focusing on tax years 2013 to 2020. I chose to start with 2013 because that was the year that the previous SOI work on this question was looking at, but they were looking mainly using the SOI sample, whereas this is using the population tax data, so I thought it would be useful to have that comparison. And then I'm going out to 2020 because most amended returns are filed and processed within about 3 to 4 years of when the original return was due. So I think hopefully at this point the filing statistics for 2020 should be mostly stable. There's some chance that the tax change statistics I show you might change a little bit going forwards. But I really did want to look at 2020 because that's the first year when tax units could start filing their e-filing their returns. And then in terms of actual data sets, so the main place that we see information about amended returns and the subsequent tax changes that come from them is the individual master file, which is essentially like the register of all transactions for individual income tax accounts. And I'm going to link those records to the originally filed Form 1040, an e-filed amended return if it exists, and then the DM1, which is like the Social Security numident to get taxpayer date of birth. So amended returns are a little bit messy. Taxpayers are allowed to file multiple amended returns, and they often do. And then also just based on processing quirks, sometimes amended returns can show up before the original return comes in. And so I do have to make some assumptions to put together the statistics that I'm showing here. And I'm going to only count amended returns that show up no more than 60 days before the original return. I'm also only going to focus on whether a tax unit filed an amended return and not how many amended returns they filed. So everything here is going to be at the tax unit level. And then in terms of counting tax changes and how they, like whether they're related to an amended return, we see lots of different tax changes in the IMF. We can't just assume that all of them are related to an amended return. So I am going to count a tax change as being related to an amended return. First of all, if it comes after the amended return, and then also it has to either have an amended return date associated with it, or we have to see a record of the amended return being sent to examination. Overall, I think this is going to give us a slightly conservative estimate of how amended returns affect tax liability. Okay, so I'll go into the results now. So first I'll talk about just overall patterns of amended return filing. So on the left-hand side here, I'm showing the total number of tax units that filed an individual income tax return, just a standard 1040, between 2013 and 2020. And then on the right-hand side, I'm showing the number of tax units that filed an amended individual income tax return, so a 1040X. One thing to note here is that those vertical scales are very different. So that right-hand graph is showing you that about 3 million tax units file an amended return each year. And that's equivalent to about 2% of tax units in a given year. Another thing that I think stands out from these graphs is that you can see that the number of tax units filing an amended return doesn't appear to follow overall tax filing patterns. I'll go now into the characteristics of tax units that file amended returns. I'm just going to focus on tax year 2020 for simplicity, but the patterns are similar across years. So I'll walk you through what is going on in this graph. So on the horizontal axis, I've grouped tax units based on their filing status on the original 1040 that was filed. And then the gray bars are showing the percent of 1040 returns that were filed by filing status, whereas the blue bars are showing the percent of amended returns that are filed by filing status. The gray bars add up to 100 and the blue bars add up to 100. Right, and everything is based on the filing status on the original return. So what does this show? We can see that married filing jointly tax units made up a larger proportion of amended return filers than Form 1040 filers, and the opposite is true for single tax units. This next graph is set up similar to the previous graph, but now the tax units are being categorized by the age of the primary filer, and we can see that tax units with a primary filer between the ages of 30 and 69 were somewhat more likely to file an amended return. This figure is grouping tax units by the AGI on the original return. Going down the graph is moving up the AGI distribution. And we can see here that about 65% of amended returns are filed by tax units who reported less than $75,000 on their original return, but higher income tax units have a higher propensity to file an amended return. So tax units with AGI over $100,000 on their original return made up about 19% of Form 1040 filers in 2020, while they account for about 26% of amended return filers. And then the setup of this figure is a little bit different than the previous chart. So now tax units are grouped based on what types of schedules they used on their original return, but they can show up in multiple bins. So the bars aren't going to add up to 100 anymore. So that left-hand side bar or left-hand side group of bars is showing that about 10% of 1040 filers had an attached Schedule A, whereas about 13.5% of amended return filers had a Schedule A on their original return. And so overall, what we can see is that tax units that used Schedules A, C, D, or E were more likely to file an amended return, and particularly so for the Schedule E filers. Okay, so now I'll go into patterns of amended return e-filing. So now these graphs show the percent of amended returns within a given group that were filed electronically. So that dark blue bar on the left-hand side shows that about 57% of all amended returns for tax year 2020 were filed electronically. And then when we go across the different filing status groups, you can see that essentially all of the filing statuses, except for married filing separately, had similar rates of electronic filing. And again, these are all based on the filing status on the original return. And then looking at these statistics by age, we can see that amended return filers with a primary filer under age 40 were somewhat more likely to e-file. And then by income, amended return filers with higher income on their original return were somewhat more likely to e-file as well. But overall, we don't really see any differences across the types of schedules that people used. So I'll go now into the effects of amended returns on tax revenues. So this graph here is focused just on tax units that filed an amended return. And the gray line shows the total tax on the original Form 1040, whereas the blue bar is the blue line is showing the total tax after the amendment has been processed. So overall, the change in tax is relatively small, about 2 to 4% per year during this time period. And I'll note here that the measure that I'm using of tax is total tax liability, so that's excluding refundable credits and other payments. And you can think of this as the last line of the tax and credit section of a 1040. And I'm focusing on that concept first for a couple of reasons. So first of all, I think that it's easier to compare these concepts across the original and the amended return, because if I were to bring in refundable credits and payments, we'd be comparing to the overpayment or balance due line, which can often be 0 or negative. And then also, this is the tax measure that was used in the previous SOI report, so I wanted to have this point of comparison. So this graph is just showing the difference between the gray and blue lines on the previous slide. This is the overall change in tax liability from amended returns. So each year it was about $2 to $4 billion. Okay, but those totals that I just showed you hide a lot of heterogeneity in outcomes. So many tax units have higher taxes or no change in taxes after filing an amended return. And this figure shows the percent of tax units whose amended return resulted in no change in tax, which is in red, an increase in tax, which is in green, or a decrease in tax, which is in blue. And that's year by year, and you can see if you look at the more recent years, the proportion of tax units with no change in tax after an amendment is over 1/2. And that might seem a little bit odd, but at least part of that is because I have not yet accounted for changes to refundable credits or payments. So I'm gonna go into that next. So in this graph, I've added in changes to refundable credits and payments, and we see that that further decreases tax and credits after amendment by about $1 billion each year. And then when we go look at outcomes, as expected, adding in changes to refundable credits and payments decreases the percent of tax units with no change after an amended return. It also increases the percent of tax units with lower taxes and credits after an amendment. And in some years, if you were to look back at the previous graph, you would see that the green bars, so the percent of tax units that saw an increase, has also grown. Okay, for the sake of time, I'm not gonna show those statistics by all the different groups, all the different demographic groups that I showed you before, but I will show some statistics breaking down by AGI groupings. So this figure shows the percent of returns in each AGI category that experience no change, an increase, or a decrease in total tax after amending their return. This figure excludes refundable credits, and we can see that lower income amended return filers are more likely to have no change in their total tax. I think to put that another way, the lower income amended return filers are likely mostly filing an amended return to claim a refundable credit, or correct a refundable credit, sorry. Okay, and then when we take into account refundable credits and payments, then things look a bit more constant across the AGI distribution. And if you look at the AGI groups with positive income, so everyone except that top bar in the graph, about 40 to 45% of amended return tax units have no change in tax and credits after amendment. And then if you go down the graph, so up the AGI distribution, it looks like higher income tax units are more likely to see their taxes increase. Okay, and then this is the last graph that I have today. So on the left-hand side, I'm showing the average increase in tax and credits after amendment among those tax units that had an increase. And then on the right-hand side, I'm showing the average decrease in tax and credits after amendment among tax units that had a decrease. And we can see that the highest income group has both the largest average increase and the largest average decrease after an amendment. Okay, so that's all I have for you guys today. This work is really preliminary and I'm hoping to expand on it. I think my main next steps are to bring in the SOI sample to get a better sense of how incorporating amended returns would affect our estimates. And then I'd also like to dig more into the data that we have on e-filed amended returns, and particularly try to do some descriptive analysis of the right and reasons that people give for amending their returns. So thanks everyone, and I'm looking forward to your comments.
Thank you, Amanda. I appreciate all the work that you're doing on that front. It definitely makes it a little bit easier to try to figure out projecting some of the amended return data. So with that, I'll pass it off to Patrick.
Okay, good afternoon, everyone. Today, I'm presenting some work that Jerry and I have been working on and off for a little bit now. And we're really just showing a lot of descriptive statistics from NRP, and it will, here we go. It will primarily be looking at business income, specifically net business income, and at the end, the components of net business income, and how we can observe the misreporting and where it is in the distribution. I've already plugged NRP, it's been said before, but the NRP is a program that the IRS runs for stratified random samples of audits so that we can get a pulse on essentially the entire distribution of income tax filers for the individual 1040 filings. The key findings from this work, some of these are just key findings from NRP in general, which is that the type of income and the information reporting on that income matters a lot for misreporting and noncompliance, specifically things that have significant information reporting as well as withholding, like W-2s, have very little misreporting, and things that have very little information reporting, such as sole proprietorship income and rental and some other things, have fairly significant misreporting. And this is all stuff that's kind of just known for folks who have tracked tax gap type things for a while. It's not our finding, but it's the general finding. And one of the big things from folks who track tax gap is that sole proprietorship income is a pretty big area where there's misreporting. And so we're gonna look a lot at sole proprietorships and Schedule E and Schedule F here. But one of the big takeaways is that folks who have net negative business income account for around, or misreporting account for around, individuals who have negative net business income account for around a third of the misreporting we see in business income on 1040s, which is a pretty significant chunk. And if we correct that data, or if we correct their income and rank them by their true income, or their DCE corrected income, 2/3 of those folks actually have positive net business income. So a lot of these folks who are taking negative positions on their tax return in reality really do have positive positions, and we're gonna show where they look like they are in the income distribution. And some chunk of them actually move up into the top 10% of business income. Before I jump into a lot of figures, I'm gonna say a little bit about NRP. As I already said, it's a stratified random sample. The idea behind NRP is that it expands upon what we get from our operational audits, where they typically just look at a few issues. NRP theoretically examines everything, but because of resource limitations, we just audit a lot more line items on the NRP surveys, not necessarily everything. There are some issues that have been documented over the last several years with NRP data, one of which is that there's evidence that when individuals have pass-throughs or 1120Ss, the examiners don't necessarily pick up those returns. And so we might see some limitations in how much misreporting is being observed directly for entities. And it's also, there's some evidence that offshore underreporting is not necessarily picked up. It's just harder to observe. And the types of exams that are done for NRP aren't necessarily geared well to catch that type of noncompliance. And I'll plug that we use NRP for tax gap. We use it for audit selection training. And we also use it to get some signal in places where we don't necessarily have data for our typical operational audits. All right, so to set the stage a little bit, here is total misreporting total reporting and misreporting for 1040 filers. On the left in dark blue is total reported total income. I've given you 3 batches of years that we've combined together to get more granularity, but we can see there's around, I don't know, 8 to 9 trillion in reported. And then in the light blue is the NRP operational audit results, which is around 400 billion a year across these subsets. So that's the part of the audit, that's part of the misreporting that we can actually observe through our audits. The red bar is the detection controlled estimates, which are statistical estimates for the undetected misreporting that our examiners didn't find. So in essence, if the best examiner audited every single case, how much more misreporting would we find? It's a statistical estimate for what that is. Same idea here, except for I'm showing where the misreporting is in the income distribution. I'll just say again, this is all misreporting. It's not business income yet, but we can see that it's just give you an idea where the misreporting is, both operationally and fully blown with DCE estimates in there. So as I move us towards understanding and getting an idea of where the net business income misreporting is, here is misreporting by essentially 1040 income line item. It's pretty obvious. Schedule C, rental pass-through, and capital gains are the largest single contributors. For this paper, or this paper going forward, we're really just going to focus on Schedule C, rental pass-through, and Schedule F. And just kind of look at what those combined, so that's net business income misreporting, what those combined, what their misreporting looks like, where they are in the income distribution, and all of that. Here I've combined them for you, so you can see that it's around 650 billion in all for net business misreporting. Okay, so the first step through here, we're looking at only net business misreporting, and this is the location of net business misreporting when ranked by reported income and ranked by DCE corrected income. Now the stacked blue, dark blue and light blue area is the misreporting when ranked by reported, and the stacked red and yellow lines is misreporting when ranked by true income, DCE corrected income. And I mean, like the big takeaway, and it's going to be the takeaway for most of these slides, is that if you look at where the density shifts from the reported ranking to the DCE ranking, an awful lot of that misreporting that is at the bottom of the distribution is shifted up when you rank by the true distribution. So this is business income ranked by total income. And if we flip to the next one, as opposed to ranking by total income, we could rank by actual net business income. And it's the same type of figure as the prior slide. But in this case, we can see we're able to just look at these cases where it's negative net business income. So you've in excess of 200 billion in misreporting at the bottom in the negative spot, in the negative position in the distribution. And then when you correct for, when you re-rank by true net business income, we can see that the majority of that negative position that people have, the misreporting in the negative positions, shifts to people who actually have true positive net business income. And this is the exact same shapes as I showed in the prior slide, except from the left that we have ranking by reported, and on the right we have ranked by DCE. And in here we're able to see when it's coming from Schedule C, rental, partnerships, Schedule Fs. It's pretty consistent all across each one of these different 4 types of income flows for net business income, where the negative positions are getting reduced, or the misreporting of negative positions are really for folks who have positive net business income. Here is there's just a ton of, we're going to look at what happens to the negatives on this. So this is another piece where we're looking at the shares of misreporting of net business income, but by their position in the distribution. So we can see, looking at the bright red, around 30% of all misreporting for all net business income is from negative positions. If we look at rental and pass-through and F, we're looking at an area where around 50% of the misreporting is coming from negative positions. And we can also see that there's way more misreporting in the negative than there is necessarily for any of the other income categories. Okay, here we're looking at the distribution of the underreporting rate by centiles. And so that black line on the top is the 95th percentile for each centile for where we're for the underreporting rate. And so, I mean, you have for that big spike, it's around 1,800, or so folks are misreporting by 1,800% or more in the top 5% of that centile that's right there. Pretty clearly, as you move up in the income distribution, the distribution of underreporting rates narrows and gets tighter. That's probably just a function of the fact that the denominator is growing. And so just what it looks like. Here is net business income reporting as a percentage of where they are ranked. In this case, if we rank all of the business returns, the net business income amounts, and we put essentially, if we rank by the magnitude of the changes, we can see from decile 2 to 10, the 10th decile are the folks who had the largest changes. We can see that 10% of the folks who have net business income, 10% of them are responsible for 50% or more of all the misreporting. So you have a smaller number of folks in the distribution, so roughly 10% are responsible for the vast majority of misreporting that's found in NRP and also predicted for DCE. If you look at the light blue plus the red, you're talking about upwards of 70% or more of all the misreporting is coming from 20% of the folks who are filing. So you have 10 to 20% isn't a small number, but I mean, you have a limited number of folks who are responsible for the majority of the misreporting that we're finding and predicting. Okay, so keeping on theme for the folks who have a negative position as reported, this slide is kind of showing us what happens to the folks who had a negative position. So most folks who have a negative position when corrected are somewhere else in the income distribution. They're no longer negative. This is showing us that around, the blue bars, just under 4 million or so of the folks who had a negative position continue to have a negative position after controlling for their true business income. But you can see the rest shift up into the distribution. And the light blue line is where the money's going. And so we can see that a good chunk, we can see that around 20 billion or so is staying in the negative position. But the rest of that 200 billion plus is shifting somewhere else in the distribution. Okay, so one of the first this is the same data, just kind of ranked a different way. So this is the misreporting for folks who have a negative position. And this is where they look like if we rank if we show their misreporting just for those who had a loss position by total income. And similar story is that all these folks a lot of folks who had a negative misreporting position, or had a negative position, net business income, had a lot of misreporting in the negative income category, but when we re-rank by total income, most of that non-compliance gets shifted up in the distribution, and we can see a lot of it's in the top 10%. Okay, so far I've only been looking at net business income. I'm now going to share some slides that show the components of net business income. So essentially, I mean, if you think of Schedule C, you have gross receipts and other income, and then you have, on the other side of that, you have expenses as well as like loss limitations and other things that can offset income on the Schedule C. Similar concepts for rentals and pass-throughs. And we're going to take a look at what the components of this stuff looks like. So here, we're just looking at Schedule C net income misreporting, and it's been broken out by, I need to mention, this does not include DCE. DCE is not, it's estimated at the line item level. So these are just all reported and corrected. So it's what we observe as reported and what we observe after the examiners found it. But in these two charts we have here, the dark blue is underreported Schedule C income, and the light blue is misreporting of expenses. And so it's, and other adjustments being loss limitation types things and other things that can move around. And so what we can see, I mean, similar story is folks who are claiming a negative net position, a lot of it is coming from, or more than 50% of it is coming from over claiming of expenses or not taking the appropriate positions on the losses that you're trying to take or for loss limitations. But we see that entire piece shifts up in the distribution when just ranked by corrected, not even DCE corrected. So you can see there's only like 5 billion or so left in that negative position just for Schedule Cs. Just to put some numbers to it, here we're just looking at underreporting For Schedule C, and we have on the left, we have income, and on the right, we have expenses and other adjustments. We can kind of see that as you move up in the income distribution, the percentage of the misreporting percent or misreporting rate goes down. So, I mean, in the 0 to 40 spot, you're around 74% underreporting. And then when you get up to the top, you're around 3 to 1% underreporting. For expenses and other adjustments, though, with the exception of the 0 to 40 group and the negative group, it's kind of 10 to 5% or 5% to 10% range. I guess towards the bottom, you're around 3 or 4, so it's a little slower, but it's not as dramatic of as a decrease. So, I mean, it looks like expenses are a little less dramatic as you move up through the distribution. Okay, so here's the same exercise with Schedule E's, Schedule E pass-through income. We can see a pretty large, the majority of the net positions are coming from other adjustments and expenses or other adjustments. Most of that gets wiped out when you re-rank by corrected. And we also see a lot of that income. I mean, you could see, kind of look at the masses, the dark blue mass for just the underreporting of income. Most of that moves up in the distribution pretty noticeably. And here's the same exercise for rents and royalties, where we just see these lost positions are really for folks who don't really have lost positions. And this is for corrected data. Okay, so before wrapping it up, there are some limitations. I hit on some of these things before I started showing all these figures, but there is some evidence definitely that some of these individual audits from the operations streams that they come through can miss entity level noncompliance. Some of that's fixed from DCE, but I would venture a guess that DCEs, there's still some more out there. And there's also just some evidence from some Jolfanes. I mean, if an individual's cheating on their 1040, they're likely cheating on a corporation they control. There is S-Corp data on underreporting. That's not in here. And let's see what else might matter. And we're doing some things to clean up. I mean, so there are some types of evasion that also possibly missing from here, like microcaptive or conservation easements and other things that might be aggressive positions that could be challenged. But these types of audits aren't, like I said, they're not geared necessarily to be working some of the more complicated and hard to find and harder to work items. And so that's about it. General takeaways are that sole proprietors are responsible for an awful lot of misreporting, which probably should not be news to most of the people in this room. Rental and pass-through are also large contributors. As a small number of the filers who have business income report less than 5% of their corrected business income. And generally, unreported ratios of unreported to reported incomes decline at higher reported rates. And yeah, that's about it. Thank you.
Thank you, Patrick. Next, we're going to be going with Mike Goodell.
Great. Pat, is this you? Great. Okay. Right. Good afternoon, all. Now we're going to talk about something a bit different. So, Tim, first, as a disclaimer, I was going to talk about a vector autoregression model. I think that was sometime in February. So the vector autoregression model are the bonus slides in this deck. So the last 14 slides are about that. But I'm not going to talk about that today. Today, we're going to talk about something. We're not going to talk about enforcement. We're going to talk about voluntarily paid tax. So imagine a world where we understood as much about how the IRS, what the IRS did with taxpayer services, what they did with technology, and its relation to the trillions of dollars of voluntary income tax that are paid each year. Imagine that we knew as much about that as we do about maybe the $100 billion of enforcement revenue, which the vast majority of the papers in this conference are about, frankly. So that's what we're going to try to talk about. But in order to do it, we realized we're going to need a different kind of data set. And so what this paper is about, this is research that's preliminary and we're developing it. This is a paper about developing a data set that lets us understand the relationship between voluntarily paid tax and how the IRS allocates its resources to support that. So it's essentially, how does the IRS allocate its resources up to, but not including, collections and examination? You can think of it that way. All right. So this research is consistent with the Evidence Act of 2018. It's consistent with a 2024 Treasury White Paper on return on investment of the IRS. So first, I'm going to hop around a little bit, so don't try to focus too hard here, because I want to get to the punchline first. Right, here we go. Okay, so here's the punchline. We're going to go left to right on this table, and we're going to describe the various pieces of information that we need to do this. So on the left, there's that number, 1,924. That's actually $1.924 trillion of voluntarily paid individual income tax and a little bit of SECA tax in 2019. So that's a voluntarily paid amount of tax. In 2019, the total voluntarily paid tax was about $3.5 trillion. So this is 1.9 trillion, all right? The middle panel in red is going to parse this into the returns that were filed in 2019. And we're going to talk about, well, how much of that 1.9 trillion is associated with a group of returns that we call no-touch taxpayers and another group that we call touch taxpayers. We're going to talk a lot about them today. So we're going to quickly just assume for now that there are 107 million no-touch taxpayers in 2019 and 46 million who were touch. Total 154.3 million returns filed. Continuing over to the right, to the very rightmost, there's a number there called 20 and another one called 95. Those are the estimates, our calculations of how much it costs the IRS to process that voluntarily paid tax for the no-touch taxpayers, $20 a return. For the touch taxpayers, about $95 a return, right? We want to build the data set that allows us to build this table in tremendous detail and in a very consistent way, all right? If we look at the top row, the $20 per return, we can go a little bit to the left, and there's a number, the 2191. That's actually 2.191 billion. That's the portion of the IRS budget in 2019. The IRS budget was 11.8 billion. 2.191 billion of it was spent on processing these 100 million returns. And just below it is a number 4.46 billion. That's how much of the IRS budget was consumed processing the 46.7 million returns. So our project is to build this data set, all right? And it's not easy, but it's a kind of an interesting data set. And it'll allow all sorts of calculations about this. So now we're going to go back to the beginning. All right. So as I said, the motivation for this project, it's just the middle sentence, so don't try to read it too hard. The purpose is to understand the relationship between service and revenue. And to do that, we're going to build this data set. But let's just imagine a simple equation. And we're not going to do any estimates here, but imagine a simple equation that's gross revenues, which is voluntarily paid tax before refunds. Gross revenues is some function of the returns, this thing called the taxpayer journey, or the journey of the return at the IRS, and the IRS cost allocations. If you're familiar with graduate student micro econ 1, this might look like a production function. In fact, it probably could be one. So we want to take this general idea, and we need to build a data set to explore it. And that's what Table 1 does. There are 4 pieces of information we need in this data set. We need a tax return provided by taxpayers and preparers. We need tax payments provided by taxpayers and third parties. The unit of observation is returns, is dollars, And then we need this thing called taxpayer journeys. And taxpayer journeys is a data set hanging out at the IRS in RAS. And we're going to talk a lot about it in a moment. But basically, a taxpayer journey is a vector of activities that that particular tax return experienced at the IRS. Every single individual income tax return has a taxpayer journey. And so we're going to use that fact that every one of these returns has this long set of labels about what its journey was. We're going to use that to connect it to this fourth data set. The fourth data set are cost accounting calculations. So I know the accounting team is here, but most of us are not accountants. So it turns out that over on the CFO's side, there's a group that actually calculates how much did it cost to do an activity at the IRS. And we're going to see some of those costs today. So the purpose of this data set is to take these budget cost accounting dollars, they're prices. For economists, we can think of them as the price of an activity, connect them to a tax return through this thing called the taxpayer journey, and then relate that to the amount of voluntarily paid tax. That's the effort, right? So what are taxpayer journeys? So a taxpayer journey is simply a snapshot during a calendar year of all the activities that occurred with respect to a taxpayer. Does not mean with respect to a tax return, although in most cases it will, but with respect to a taxpayer. A taxpayer may have filed a return years in the past, had some compliance activities with it. The IRS continues to reach out to the taxpayer, and maybe the taxpayer responds to the IRS, but the taxpayer doesn't file a return. They still end up as a taxpayer journey if they had activity in the calendar year. So taxpayer journey data is calendar year, and it's broader than just filing a tax return. So there are some non-filers in the taxpayer journey data, all right? Next, we're going to need cost accounting calculations. So what are they? The CFO's office prepares cost accounting, and this is basically the total cost, and sometimes they use the word fully loaded, the total cost of doing a particular activity. We're going to talk today about the cost of a notice. All right, so how much does it cost the IRS to send out a notice? Well, there's the paper, the production of the notice, some regulatory forms and pubs folks working on the notice. There's the postage, which is pretty big, it turns out. And then the notice goes out, but sometimes these notices come back. That's called downstream costs. So we'll see that, in fact, the average cost of a notice over the 1,000 notices or so is kind of high, like $6, but in fact, most of it has to do with what happens when the notice comes back and there's a communication with the taxpayer. So the CFO's office produces these cost calculations, not to be called estimates, for an amazingly wide range of activities. The lift in this project is getting those cost calculations to align with what a taxpayer journey is. If they're talking about the same activity, we're in great shape, we have the right price. There's no a priori reason that they will, so we have to do a little bit of work. Okay? Don't strain your eyes here. So this is a table, it's an excerpt of taxpayer journeys for 2019. So at a high level, we have a table. It has 225 rows, of which this is only 15. So again, don't strain your eyes to read this. These are taxpayer journeys, so I'm just going to explain a little bit what they are. Look at that top row. It says filing. And if your eye goes across that row, you'll see a number, 95 million. 95 million returns were filed in 2019, and that was the only activity they had with the IRS. And so if your eye continues across that top row, there's a column that says no-touch filer, and it's a yes. That's a no-touch filer because the IRS didn't have a subsequent communications or interaction with them, and the taxpayer didn't have any subsequent communications with the IRS. They're in a sense, They're our standard. We want every taxpayer to be a no-touch taxpayer who only has to file their return. That would probably be the lowest cost tax administration system, right? So there are 8 unique activities, and they're highlighted in red here. And it turns out that these 8 unique activities, an outbound notice, an inbound contact, a non-compliant taxpayer, we're going to talk about these in a moment, a return review, amended filing, delinquent. The 225 journeys are just various combinations of these 8 activities. So if we can get good costs for these activities, we have a chance. Now, it turns out we can do far better than that because the CFO's office creates thousands of cost calculations. So there's 2 rows here I do want you to talk about. The first one was filing. That's at the top. But the second one is let your eye go all the way down to where these grayed out bars are. And let's just look at the first grayed out bar. And it says delinquent, outbound notice, and inbound contact has about 3,000 taxpayers in it. This group of taxpayers didn't file a return, but they had a delinquent account, and that's a technical number that comes off of a data set called IMF status history. We have a status code for that return, and it tells us if it's delinquent. There was an outbound notice, so the IRS sent something to the taxpayer, and there was an inbound contact, so the taxpayer talked to the IRS. That's a journey, 3,000, all right? Now let's go a little bit deeper into these journeys. I have to go to slide. Here we go. This is where we see some prices. Far left-hand column, we have 8 unique journey elements, and these were the ones that were in red in the previous slide. Pre-filing, filing, return review, amended return, outbound notice, delinquent, inbound, and non-compliant. We're just going to look at the top 2 panels because that bottom panel is actually not in our analysis because it's collection and exam. So the top panel, pre-filing, filing, and return review, we're just calling that filing at the moment, even though we have the data for pre-filing and filing and return review. We have to still get those costs to be aligned. 90% of the cost in filing is actually filing. So it's pre-filing is pretty small dollars, return review is pretty small dollars. The cost for this group called filing is $20.30 for 2019. That's the cost of all those no-touch filers for the most part. Some no-touch filers, though, file amended returns. And that doesn't make them no-touch if the IRS didn't reach out to them and if the taxpayer didn't try to contact an inbound contact to the IRS. They just filed an amended return. So we still call them no-touch, all right? It's the second panel, outbound notice, delinquent, and inbound contact. This is where all the action happens for the touch filers. There are all manner of costs of activities here, all right? And we're just going to explore one of them right away. Outbound notice, $5.92 per notice. So let's quickly see what that looks like. So this is the table that calculates it. There are the top 3 rows are the cost components of notices: production, 91 million, postage, 152 million, downstream costs, $1 billion. Total cost, 1.2 billion to do the 218 million notices that went out in 2019. Average cost of a notice, $5.92. That's what our cost is. Below it, I just want to show you a little bit of the heterogeneity in these cost components because it will matter for journeys. There are over 1,000 notices, and we have 1,000 different prices from the CFO's office for these notices. So the most expensive notice was $82.08, and I think you can see from the footnote here, that was for an installment agreement default notice in Spanish. So think about taxpayer services here, all right? That was probably a really expensive downstream notice. On the other hand, there was some notice only cost 17 cents, and that was for information about your request for an ATIN, an Adoption Taxpayer Identification Number. So I think that's kind of neat. Okay, now, did that. We have to go back. Slide 7. Oh, I don't know if this is slide 7 or not, do I? Great. Okay. We've talked about no-touch filers, still don't really know what they are, right? So here is what a no-touch filer is. They timely file their return. They don't have an outstanding tax delinquency, which we can observe in an IMF status history. They didn't receive an outbound notice from the IRS, and they don't initiate an inbound notice. So basically, if you pass every one of those tests, you're a no-touch filer. All right. And I think this takes us right back to here. So let's go back to our no-touch filers again. $1.9 trillion of revenue voluntarily paid. The no-touch filers, we had 107 million returns, and there's in between there is a TBD. So the TBD is going to be what portion of that 1.924 trillion is the no-touch filers. That number is going to be about 1.1 trillion. And that means for the touch filers, it's going to be about 800 billion. Now, it's not there yet because we still have to check the calculation, but it's basically going to come out to that. And so we can do another calculation. If we know that there was 1.1 billion of no-touch of voluntarily paid revenue, and it cost the IRS 2.191 billion to collect, to process that return, and these were no-touch, on the order of $500 of revenue for $1 of cost to the IRS. On the other hand, if the touch filers are at about 800 billion of voluntarily paid tax, and it costs the IRS $4 billion, on the order of $150 per dollar of cost. So we have these sort of relative cost ratios. So think about this. How much would the IRS save if it could move touch filers to be no-touch filers? It's clearly $75 a return. To make the 46 million no-touch filers have the same cost as a touch filers, same cost as a no-touch, that 4.4 billion of budget would go down to about $1 billion. So there's about a $3.5 billion of IRS cost that is involved with the downstream complexity of dealing with tax returns, individual returns, up to, but not including, collections and enforcement. So that's the main sort of punchline. Our work is to build this data set. It takes a lot of time just talking between the CFO and the folks that run taxpayer journeys to align our concepts. And that's where we are at right now. So thanks.
Thank you very much, Mike. I will call Stephen up.
G'day, I'm Steve Hamilton. I have written notes, but I promise I file electronically. So I'll start with first thing, a broader comment, which, I found these 3 papers really quite fascinating and important. I've only ever worked with Australian tax data and the Australian Tax Authority, and I think they could only dream of doing this kind of stuff. And it's really a testament, I think, these 3 in particular, to the importance of funding research on the way our tax system functions. And that funding of research on the way our tax system functions can, 1, reduce the burden of our tax system on American taxpayers, but also raise additional tax revenue with greater efficiency. So it sounds like a good idea to me. So I'll start with Amanda's paper, which I found pretty interesting. I don't know much about amended returns. 2 striking features. There was a very modest decrease in the proportion of amended returns over time. I think they the proportion of amended returns went down by about 10%. That is, maybe 0.3 percentage points over, a 10-year period. Will that trend continue? What drives that trend in the reduction in amended returns was a question I had. I also think I was struck by how little variation there was across, different kinds of taxpayers, right? There was actually very little variation, which I found quite surprising. There was a little bit of variation by filing status and by age and other things, but not a huge amount. The huge variation that we saw was in the fact that amended returns almost always lead to lower tax revenues. Now, the fundamental question from, I think, a tax policy design perspective is that a coincidence? The people who come back and amend their returns always win. Is that luck? Is that by design? And it's one way in which I think Amanda's paper connects to the other two papers that we have, which is there a correlation between amended returns and misreporting? And can we establish that in the data, or are these data sets too small and don't have enough overlap or whatever? But I think that's an important question. So to the extent that Amanda, in her future work on this project, can give us an understanding of what's driving the amendments, and can we change policy accordingly and maybe collect additional revenue by, pushing enforcement resources onto those amended returns? I think that would be an interesting question. So the other thing I was going to just suggest for Amanda is I'd like to see more detail on, both the nature of the amendments, and I think she mentioned that in terms of looking for the descriptions, but I'd really like to understand the nitty-gritty of exactly what they're changing, which I didn't quite get from the presentation, and also obviously the nature of the people making those amendments. Can we learn something about the motivations for the amendment and to the extent that they are misreporting, can we learn something about the people doing it? So that's Amanda. Let's move on to Patrick. Patrick was second, right? Yeah. And Jerry, I see there as well. Patrick, I found this quite amazing, to be honest. I've worked a little bit with the Australian equivalent of this data set, statistical kind of auditing, and I just found this fascinating. So, So one minor takeaway was I kept asking myself, I would love to know this in proportions rather than levels. I saw that the Schedule C bars were huge, but then I wanted to, control for the level of Schedule C revenue, and I didn't know that calculation. So if everything could be presented in proportions to let me kind of scale, I think that would be helpful. That's a kind of minor comment. I want to go to the more fundamental comment, which is, there's these two key results. One is it's mostly business income, that is Schedule C income among those, as in sole proprietor income, right? And mostly from low to middle, income individuals, which I found quite striking. And then furthermore, this significant spike in, people who have losses, which you focused on a lot. But I really want to drill into that further. I want to understand what's going on, right? I've written a paper on sort of the tendency of taxpayer behavior to bunch at kind of round numbers. And obviously we know Alex Rees-Jones's paper that looks at, people moving to a refund position in the tax refund distribution. So we sort of know there are these strange behaviors around these sort of kink points, and you could think of, a loss position versus a tax owing position as being one of those, reference points. I wondered whether if you could rescale that x-axis to rather than these kind of bins that weren't super consistent, if I could have on the x-axis the actual dollar amount and then plot functions according to that dollar amount, so that I could get a bit more fine understanding of how, the y-axis is varying with the x-axis, right? So we had a big spike at negative, but they're all lumped together into one bin. So I'd like to just sort of figure out, is it really discontinuous at zero, or are we just lumping together all of the losses together? So little details like that I think would help me understand what's going on. I have this, overarching question about, what is going on with these losses? Is it selection? Is it you know, what are these businesses doing? Why, you know, why would it be the case that if you misreport, you're more likely to have a loss? I mean, I would think of it as a continuous thing. You know, if you have a $50,000 income, you're going to misreport. A $20,000 income, you're going to misreport. Suddenly, you could hit a loss, and you know, you're going to misreport more. I don't understand what's going on. So, to the extent that you could figure out, you know, dig deeper and figure out what's going on there, I think that would be really useful. Let me see what else I have here. How am I going for time? Oh yeah, I've got a timer here. Just reading through my handwritten notes again. Okay. Yes. Yes, and the only other major comment I had was, you know, again, can we dig deeper into both the drivers of those misreporting? So I think you looked at expenses, but can we dig into the expenses? Do we know which lines are actually driving it disproportionately? My wife claims an expense for her business on the proportion of our, you know, house that we can claim as a business deduction. You know, I do that myself. I do the calculation, and I think to myself, whoa, there's got to be a lot of misreporting on this line. You know, are there particular items that we pick out? Don't audit me. Are there particular? This isn't being recorded, right? Are there particular line items that we can pull out that we see, you know, are systematically driving this? Maybe the loss kind of thing. Is there a particular expense item in there that's doing most of the damage? And again, more work on the heterogeneity of the misreporters. So I don't know how much data you have on the individuals filers, you know, but trying to understand what the relationship is between their characteristics and these results, I think would be also useful and interesting. But no, I thought it was amazing and really fascinating. I'm looking forward to seeing where you take it. So lastly, Mike, this is a remarkable thing. I mean, I thought, what a good idea. What a good idea to take, you know, administrative information that's inside the IRS that I think certainly people like me who are outside haven't really thought about. You know, we talk about administrative costs all the time as being important, but I talk about it as this sort of nebulous thing, right? But you can actually go in there and you have a list of them, right? You have, as you said, a menu of prices, right? Thousands of prices for these individual items, right? And linking that up to the data, I think is just enormously valuable, and I should be obvious to everyone in the room, the potential I think that creates for really interesting research. So, you know, I commend you for doing it. You know, this high-level result that, you know, I think I've got this right, 2/3 of returns account for 1/5 of costs, right? That imbalance there is really quite striking, right? And it does lead you to, as you mentioned, think about, well, couldn't we move some of these people to that bucket, you know? And would things like direct file help us do that? You know, can we change the design of the tax system to shift more people into those no-touch buckets, and how much money would we save if we did that? You know, can we simplify the tax system to move people from one bucket to another? How much would we save? Well, that's exactly what your data set can help us to do. So I think that's really interesting, and I'm looking forward to see where you take it. A big question, a kind of conceptual question I had was, and you sort of answered it there, you had a list of, you just pointed towards the heterogeneity a little bit, right? You have this distribution of different items. I really want to see that distribution of items connected with the data so that I can see what's the distribution of costs. So within the touch group and within the non-touch group, what is the distribution of costs within those groups? And I think you just need to kind of multiply them, and I think you can do that with your data. Because what I'm wondering is, you know, if we have this central policy question of what's the consequence of moving people from, you know, touch to non-touch? Well, my question is, where do they come from the distribution, right? If you have a distribution of costs within the touch group and policy can shift people from one to the other, you kind of want to know, are they average or are they from one end or another end of the distribution? If policy is only going to move people from the cheap end of the touch distribution, then you're not going to save as much money as you think you will, right? So I think trying to get an understanding of that, I think, would be good. And something that plugs into that, which I don't know if you can do this, and I actually thought that across all three talks, to what degree can we use the dynamics in the data to teach us things? So, you know, in yours, do we see a dynamic over time of taxpayers moving from touch to no touch or no touch to touch? And what kinds of events kind of predict those movements? Is there redesign of the form or introduction of, some kind of pre-filling, or, are there reforms or changes over time that prompt shifts from one state to another? And can we leverage those, maybe plausibly exogenous changes in policy to try to tell us something about what would happen if we were to try and move people from one bucket to another? What changed about these people? Where did they come from the distribution, and what would that do to costs? So I think that's a promising avenue if you could somehow leverage that. Now I just wanted to make one more comment, which is, and this is something I think about. I mean, I teach my students that, all about, I'm a Joel Slumrod student, so of course I teach my students a disproportionate amount of administrative and compliance, tax, public finance. And all I could think of when I read your slides was, this just embeds so beautifully into a welfare framework, right? So, we think about, I think, welfare as, okay, taxes have an effect on behavior, and that generates a deadweight loss, which, we have pretty good estimates of. I think I read a paper recently that said the average is about 15% or something like that of AGI in terms of the deadweight loss generated, which for an average taxpayer, I think is $11,000 a year. That's pretty big. We think about compliance costs on the individual, and we can look at Yusuf Benzadi's paper that looks at, the standard deduction, bunching around the standard deduction, and he showed that compliance costs are in the order of $175 to $591 per person, right? Which is an order of magnitude less than the behavioral distortion. And then your paper comes along and says, oh, and we have an administrative cost of, on average $43, but it could be 20 or 95 depending on, whether these people are, how interactive they are with the tax system. So, it's not nothing, but certainly, the administrative burden of the US tax system is extremely small, right? I'm pretty sure I'm a no-touch tax filer. My tax return costs the IRS $20, but the IRS, the tax code costs me, in terms of the way it distorts my behavior, what is that, 1,000 times that, right? So our tax system is actually not expensive at all when we put things into context, right? But anyway, I think, the beautiful thing about your paper is I think you provide a kind of, hopefully when you let it out into the wild, you'll provide people like me, some data and some information that we can use in embedding it into a sort of welfare framework. So yeah, thanks a lot. And I look forward to, hearing more and hearing the questions.
Oh, wow. Okay. With that, we, I think, have some interest with maybe passing a microphone around as that's working its way around. I've got a few questions. I'm not sure if Amanda is still on. Okay, I'm going to skip Amanda's questions for now to see if we might come back for those. But I'll start out with Michael. Mike, are information returns issued to the individual by employers or financial institutions and filed with IRS counted in an individual taxpayer journey? Presumably there are some processing costs for those.
Yeah, so I'm pretty sure the answer to that is yes, and it'll sit in the filing space. So it's not in the return review space, which is limited, but it'll sit in the costs in the filing space. But that is something that we have to follow up with. That's the exercise, to figure out if each of these components is actually has a price.
Okay, and have you considered how to measure the relationship between the dollar investment in customer service and voluntary compliance?
So we haven't done that calculation yet, but it actually goes to Steve's comment that we have these data beginning in 2018, So in fact, we have longitudinal data about the taxpayer journeys for the same taxpayers. So we have an enormous panel, if you think about it that way.
A real journey.
A real journey, a journey as a set of labels, right, for that calendar year. So the answer is we can, because as Kyle, who oversees all this project, has reminded us, even though you may be a no-touch filer this year, if you were a touch filer in the prior year, that may affect what you did this year. And we can see that in the data once we build it out beyond just 1 year.
And it seems like all the rest of the questions are for you as well, so I'll just.
Why don't you answer questions that do you have any?
No.
For Steve? Okay.
Well, no, I mean, thank you for the feedback.
Okay, so also for Mike, the calculations do the calculations include interest, fines, and calculated tax to offset the cost per touch return?
It's a good question, but those items, so there is interest and penalties included when they are included with the voluntarily paid tax. So if you file your income tax return on time and you realize that you did not pay your estimated taxes timely, and if you calculate that penalty and pay it when you timely file your return, to that extent, and we can observe that extent, to that extent, it is included in the voluntarily paid tax. But other than that, it's in the amount of revenue that we're not looking at, which is collections and enforcement, collections and exam.
Okay, and has there been any consideration into how moving a taxpayer from touch to non-touch in order to reduce costs may end up compromising the intention of correcting the pre-assessed return submission such that now the costs and burdens are shifted to exam and collection?
It's a good question, and we're aware of it because it reaches to a very deep issue that we don't want to address right away. And that issue is, just imagine if when a return is filed, there actually are a whole lot of tests to that return to determine whether we're going to accept it or not. So just imagine what would happen if the tests around, should we accept this return, what if we loosen those tests up a great deal? Then we're all of a sudden going to have an increase in returns that are filed, and they're going to look like no-touch taxpayers, but in fact, they may have all manner of compliance issues. So it's a very deep and nuanced issue as to whether we are moving the bar that says, you're a no-touch filer, and we're moving it only because we've decided not to review your return very carefully, right? So it's a big problem, it's a big question, and we haven't delved into it, but we're aware of it.
And we've got a comment here from a CPA who says he greatly appreciates the work that you're doing in this. And he's curious as to whether or not no-touch includes a vast majority of paid preparers, if you have any idea of what the percentage of that might be.
I don't have an idea of the percentage, but paid preparers are a pretty big chunk of voluntarily filed returns, so I'm sure they're fairly well represented. I would not be surprised if they're more represented in the touch filers, but not sure.
And it looks like that's all the questions that I have on the tablet. Did anybody in the crowd want to stand up and ask a question? There's a microphone moving around. Oh.
Thank you, Lillian. I'll keep up the trend of asking questions of Mike. And I apologize if you touched on this already in your presentation. But were you able to account for pre-filing touches when you called, the telephone calls, even the chats on the website?
So we didn't, oh. So we didn't, but I do want to bring up a point. We do see inbound contact, and the way the taxpayer journey knows that there was an inbound contact is that there was an online authentication, or there was a visit to a taxpayer assistance center. So to the extent that online we can see an authenticated touch, all right, as like where's my refund, or a calling call center, or a visit to a taxpayer assistance center, then we do see that it falls into the inbound contact journey, all right, as opposed to the pre-filing journey. So it doesn't fully answer your question, but the granularity of the data is around this data system called the status history, where we have status codes and transaction codes for every kind of interaction and touch that happens. And so that's how they construct the journey. If the phone call is authenticated, so if you call and you actually are talking to someone at the other end, that is definitely an authenticated call. But if you're cruising the website and you're downloading some information without an IRS person on the other end, that we generally don't actually know that it was you who did that.
Thank you. So this is very exciting. I was wondering, Mike, if you could just expand on some next steps and kind of where you see this going.
Right. So the next steps are actually very immediate. There was a slide where I called 3 particular journey activities one. I called them filing. I said pre-filing, filing, and return review. I said I'm going to lump them into one journey. We want to decompose them. I'm pretty confident we can do that because I know that the CFO's side has those measures for pre-filing and filing and return review. We just have to align them with the way the taxpayer journey data is. So that's by far the single most thing we're going to do tomorrow is begin to work on that, because that will refine our calculation of the individual, both the touch and the no-touch filers. So that's what we're going to work on first.
And I think we have time for one more question over here.
Thank you. So my question is to Mr. Patrick. I'm wondering, I don't know if I missed it, because I was late in your presentation, that in your analysis of underreported income, so like I think you mostly looked at the ratio of underreported income to the reported income. So do you, in your analysis, do you do some analysis at looking at the industry level? Like, I am working as a Joint Commissioner of Income Tax in India and presently on a study leave in US. So when I did my audit, I found more of the real estate company, they're reporting losses. And they have, all the accounting mechanism they do, and they just say, every year they're incurring losses, despite the fact that they have a higher revenue. So in your analysis, do you find any particular kind of trend in a particular kind of industry where there's a higher amount of underreported income? Thank you.
Yeah, so that's on the to-do list. The granularity of industry-based data on the survey is probably not great for doing a really extensive review, but we're trying to categorize the types of industries that folks are reporting, as well as like the occupations listed on their 1040, which is like what they just list when they file. So it's something we could kind of do, but it's not, I don't have anything available right now.
Adding on to that, I'm good to see the amount of research which is happening in IRS in India. We are still working on the research, and and there's a way to. Yeah. I'm just saying that amount of research which I found here in the IRS is mind blowing. So we in India we are more focused on audit and touch and no touch, but less on research. And there's so much to learn from the IRS in US, and we are going to do more analysis of our research. Most of our energy invested in audit and defending our cases in litigation. And then we have very less success rate in litigation, but doing research and finding the data, because every year the tax return generates millions of data. But we do not look at in that regard as the volume as I can see the research over here. Thank you.
All right, and we'll wrap things up here for the third session. We're going to take a 15-minute break and be back at 3 o'clock. Thank you.
Thank you for coming to the last session of the day. I'm glad you've all lasted because this is a really interesting and very relevant set of papers. Topic, I'm Janet Holtzblatt from TPC. The topics today deal with the measurement of the tax gap and the use of the tax gap. We are going to hear from Dan Rosenbaum, who will speak first. He is the supervisory economist leading the compliance model at RAS. He'll be followed by Aviv Caspi, who is a postdoc at Stanford at the Regulation, Evaluation, and Governance Lab. And then to wrap it up, we'll have David Splinter, who's a senior economist at JCT. Now, as you listen, I want you to think of 3 themes or 3 issues that come, well, 3 points to come away with from this session. The one is the issue of measuring undetected income. As Dan will, as Aviv will talk about, not all income is observed by the auditors, so the measurement has to be made for undetected income. And that turns out to be a big deal in terms of the aggregate tax gap. But it also matters when you start distributing income, as David has done in some of his previous analysis, at using tax information. It also matters importantly with respect to how you distribute the tax noncompliance. A second issue that is extraordinarily relevant at this time and has been for all time is the amount of resources that the IRS has. And resources come up here in 2 different ways. One is that the work on the issue of not only the aggregate but the distribution of the tax gap was really relevant in the debate for the last 2 years with the concerns about the size of the tax gap not only driving the congressional interest in raising the amount of money that the IRS would receive, but in terms of framing the analysis with respect to how that money would be used, with concerns that perhaps noncompliance or the tax gap was highly concentrated at the higher end of the income distribution, which led to the prior administration wanting to use the additional funds to increase audits on higher income people. So both Aviv's paper and David's paper will discuss both the measurement and the uses of this kind of measure. And then finally, this is not a technical point, but I think this panel really highlights the importance of collaboration between the IRS and outside groups. MITRE has had a long-term relationship with the IRS. In more recent years, the Stanford group has also joined with the IRS on doing research. And this has, I think, added value, not just for the IRS, but in terms of the dissemination of information when all of the groups come out together with really good collaborative work. And so having said that, Dan, will you come to the podium and talk about your work?
First of all, I want to thank my co-authors. It includes a bunch of folks from my lab at the IRS, including Kenneth, who spoke this morning, and it includes our partners from MITRE. I guess a new part of my job this year has been, justifying, that contract week after week after week, and we're so thankful, to have them. And we've had a lot of collaboration, on this work. It's very preliminary, both this paper and the paper that Aviv is going to present. But, so I think any feedback that we get from, everybody, would be very useful. But, so we would, kind of appreciate that. I guess I can do the next slide. I'm going to, kind of the agenda for this, I'm going to talk a little, for this group, I probably don't need to justify why we estimate the tax gap, but I'll have a slide related to that. I'm going to talk about the National Research Program because I am from the IRS and we talk about the National Research Program. So I have a slide on that. And I'll talk about how changes in the National Research Program is motivating the new tax gap methodology, estimation methodologies that we are going to present. I'm going to introduce a binning rating approach that we're potentially going to use to estimate the tax gap. There are not a lot of results in what I'm going to present here, but I will show some results about how the NRP has changed from 14 to 16 to 18 to 20. And then I'll talk about because of changes in the NRP, we're going to potentially be considering incorporating prior year NRP audits and potentially non-NRP audits in our estimation procedures. And I'll talk about some of the challenges with that, and then there will be some final thoughts. So again, this is a group where I probably don't need to explain why we estimate the tax gap. But it's very high profile. I've only actually been at the IRS for 2 years, but I think within one of the first weeks I was there, we were briefing the commissioner on tax gap related stuff. We briefed folks in Treasury, lots of congressional inquiries. Janet is bugging us all the time. GAO and TIGDA, I feel like we should have members of their teams embedded in our lab because we're so constantly, talking with them. So there's just a lot of interest. I also think there's also a lot of interest in the improper payments estimates that we provide from our lab. And I think the tax gap estimates are a good way of putting those into context. And I think that's an important role, that the tax gap plays. And then it's an important part of a lot of our goals at the IRS, and it's not a performance measure, but it plays a role in a lot of our workload selection decisions, and some of our resource allocation decisions. I think both for enforcement and, for taxpayer outreach. Again, this is a group where I probably don't have to spend a lot of time talking about what the tax gap is, so I'll go through this slide quickly, but it's a estimate of the overall non-compliance. It's difference between true tax liability, true as if some omniscient being could, calculate what your tax should be, and what taxpayers actually pay on time. And it includes both what we can kind of detect with our examiners and what goes undetected. And there's a lot of different components of the tax gap. There's individual, there's corporate that Kenneth was talking about today, there's employment, excise, estate taxes, and there's different types of non-compliance. There's underreporting, which is what I'm going to be focusing on here, but there's non-filing and underpayment. So think about this as being one of the many pieces. This is the big piece, but there are many other pieces. And in terms of the way that we have typically reported our tax gap estimates, so our last set of tax gap estimates were actually from prior to me getting to the IRS. It was I think it was put out in the fall of 2022, and it was for tax years 2014 to 16. They're very delayed because it takes a long time for these audits to close, and you want to wait for almost all the audits to close because a lot of those late closing audits are the interesting ones. And then we have, the last couple of years, we've had projections that came out. Projections basically take the compliance behavior from a previous set of years. So in our most recent ones, it was the 2014 to 16 estimates, and projects them forward using the return characteristics in 22 last year. For this fall, what we're planning to do is have estimates for 18 to 20 and project them forward to 23 using the return characteristics. And we're doing a lot. This is the slide where I kind of joke, you should question my, my sanity, because we are taking methodologies that we've used for decades to estimate, the tax gap, to estimate undetected income, and to estimate the corporate income taxes tax gap, and we're changing them all in the same year, in a year where there's a lot of other things going on at the same time. I'm not sure I would have necessarily, took all these things on if I had known that was going to happen, but we are where we are. And I was joking that, I'm from the IRS, so I have to talk a little bit about the National Research Program, but it's really fundamental to what we're doing here. And as, as Pat and others, kind of mentioned, the NRP is, is a comprehensive, stratified random, 1040 based research audit, program. And from tax year 2006 to 15, it was about 14,000 audits per year. Now, starting in 2016, it changed to only being about 4,000 audits per year. And this is going to be part of the motivation for why we're changing our methodology of how to estimate the tax gap, because this is a much smaller sample than what we've had in the past. In 2019, we started NRP redesign, and this was a way to try to optimize that 4,000, that sample of 4,000, with a sample of 1,500 that was like our old stratified random samples, but a little bit more highly targeted towards areas of the tax return population where compliance was changing more, dramatically. And then there's a second sample of 2,500 returns, our high-risk sample, that's focused on high-risk returns for every kind of different type of, for different types of returns. And we have a model, a random forest-based model that kind of helps us with stratification. Since NRP redesign and since the reduction of, to 4,000 audits, we've had cuts in the number of examiners. We don't know yet what the effects of all of those cuts are going to be, but we anticipate that it's going to mean a smaller NRP going forward. Probably won't affect 21 that much, but probably will affect 22 and 23 quite a bit. And, this is the seed corn that all of us use to kind of do what we do. And the AI models that are, that we use this data. So this is gonna affect things. We're trying to think about ways of developing strategy to optimally reduce these samples, kind of given all of our needs for it. It's not just tax gap estimation, it's also our improper payment estimation. And, this is the seed corn for all our workload selection models. So again, it's these changes in the NRP before this spring. I think these spring just kind of exacerbated that, have led to us needing to kind of rethink how we estimate, the tax gap, using the NRP-based part of it. And I think in particular, we need to think about, are there ways in which we could incorporate, where it made sense, prior year NRP audits in the estimation process, or non-NRP audits. And I'll talk about some of the complications of that, later on. We also plan to try to compute standard errors for the first time that we've done this, as part of what we do, this year. And we wrestled with a number of different approaches that we would consider for this. Thought about a structural model. at first that might have made sense, but there's so many interdependencies between the different line items, and we need to be able to estimate things at the line item level as well. And the distributional thing, aspects matter a lot, as we, kind of saw in Pat's paper, and, we're going to see in David's paper, coming up. So we felt like that was not a viable solution. We went to kind of a binning and matching approach, and that seemed promising at first, but matching ended up being both conceptually and computationally very challenging. So now we're using this kind of binning approach that I'll describe in not a great amount of detail, but some detail in the next few slides. So our first step of this binning process is to put the returns, both the NRP audits and the population IRTF returns, into these macro bins that are roughly defined by their EITC audits, their wage and salary that aren't EITC, and then it's Schedule E, Schedule C, Schedule F that aren't EITC, audits. Then we take those macro bins and further subdivide them into 37 bins using some of these characteristics. Not every single one of these characteristics is used to subdivide every single bin, but obviously the other schedules that are in the return, whether or not there's EITC, and the number of qualified dependents and exemptions in the case of places where that matters. These are some of the things that divide things into the 37 different bins. And then once we have the 37 bins, we further subdivide those by income and by risk. So the NRP sample now has this high risk sample that's attached to kind of something that's a more stratified sample of the entire population. So we can't just pretend as if our sample is a random sample of the entire population. So first we split by income, each of those bins by usually like 2 to 6, splits. And then we split very, very finely using risk measures, both from our ICM model that we use to stratify the NRP, and my group is also actually responsible for the diff model as well, and so we have that to use in addition. And so we then split very, very finely so that there's like 15 to 20 NRP audits, in each of the micro bins. In that case. And so the idea there is we want we're going to have a micro bin in the NRP. We're going to have a micro bin in the IRTF. There's going to be audits. There's going to be audits in the NRP one. There's just going to be returns in the other one. We want those to have very, very similar risk profiles is really the key thing, so that we're not biasing ourselves upwards or downwards when we're trying to estimate. And then what we're essentially going to be doing is creating a new weight from what we get naturally from the NRP. You can think about for each of these little tiny micro bins, we're going to have some number of IRTF returns in the population. We'll count those up. We'll also have some number of NRP audits. We'll count that up. And then the weight essentially becomes the population returns divided by the number of NRP audits. And then when we think about introducing prior year NRP audits, that would obviously change the denominator because you're going to have more NRP audits. So we have to think about how we do that, in a smart way. Same thing with the non-NRP audits. And we'll talk about that a little bit more later. And then projections, I think you should think about as we're going to really use the same methodology that we're using for the estimates, but the numerator here, the population returns are going to be used from the projection year rather than the estimation year. And that should capture any of the changes in compliance that are taking place, that we can capture through changes in the returns. There's a good chance that's going to be captured. Any other compliance over and above that, obviously, we're not going to know about that until we're able to audit, those returns later on. I don't have a lot of results here. This is just a little bit of a tease, I think, in the sense that it shows kind of some of the, differences between the 14 to 16 NRP and the 18 to 20 NRP. And the 18 to 20 is a mix of kind of the old sample design and the new sample design, whereas 14 to 16 is all the old sample design. But what you see here, and we have it split here between low and medium risk and high risk returns. And what you see is there's a huge drop off in how many low to medium risk returns that we have in the NRP now versus, what we had in 14 to 16. There's a much lesser drop off, in the high risk, returns. And the other thing you see is, I think sometimes we forget that, 61% of the, of the returns are low risk wage and salary returns, where there's, essentially no salary gap. No tax gap. And most of the tax gap is in the high risk. I think it's nearly 3/4, is concentrated among, those high risk, returns. And so talking about some of the issues in terms of, first incorporating prior year NRP audits, I think this is what we're most likely to do this, in some cases in particular, I think with, some of the medium and low risk areas where we've cut back on, the number of audits. But we have to think about things when we do this. Tax law changes, where there's been big tax law changes, we're not probably going to be able to use the prior year, data because it's going to be hard to kind of match up likes and likes. We will have to think about whether we want to downweight the, those prior years when we put them into the equation, creating the weights. And we'll have to think about whether, there could be trends in compliance that aren't picked up by the change in return characteristics. We may want to account for those and adjust the prior year data to some degree, for those. And we have some thoughts about how we do that. Incorporating non-NRP audits is more challenging because they're high risk and they're non-comprehensive. High risk isn't so problematic because we have these very finely tuned risk bins by risk, so we can just put them in the right bin and that's probably okay. But the comprehensiveness is challenging. That's going to mean that we potentially have to kind of figure out what did they carefully look at in that return, and can we adjust the weight for that part of the adjustment? And for the parts where they didn't really look at it very carefully, we just use kind of what we would get from the NRP alone, essentially, is kind of, I think, the theory of what we would do there. I don't think I'll be able to do the last point here. We're going to talk a little bit about the update of DCE as being part of this. That's in the next slide. And then final thoughts. This is obviously kind of a challenging endeavor. We're going to have a lot of explaining to do when we put out these publications in the fall and explaining how a lot of these estimates look in the past and in the present. I think we're very open to any ideas that anybody has. So that's all that I have.
Thank you, Dan.
Okay.
Thank you, Dan. And now we will talk about
Wonderful. Thank you all so much. I feel very lucky to be the face of this collaboration. with my colleagues at the Reg Lab, our partners at IRS, and our co-PIs, Jacob and Dan. And the usual disclaimer applies. These are our own thoughts and findings. Okay, so the goal of this project is to introduce a new method that addresses the kind of general question of how do you estimate the prevalence of a phenomenon in the world when all we have to go off of are imperfect investigations. So you might imagine we want to know how many children there are at risk using imperfect Child Protective Services investigations, or the prevalence of a health care phenomenon using restaurant inspections. Obviously, in our case, we're thinking about the total amount of underreported taxes using audit data. And the core challenge is going to be that not all investigators are going to find the same amount of underreporting on the same return. And we don't have a guarantee that the kind of overall population of investigators are unbiased. So we want to do better than just taking the average investigator's finding and really try to get at this question, which is, what would the best examiner find if they were the ones who did all of the audits in the population? I don't need to motivate the tax gap, especially after Dan's talk. It's of core importance to tax administration and fiscal policy. And so the IRS has a procedure that they use right now, which many in the room are familiar with and has gotten mentioned a few times, which is DCE. I'm not going to talk too much about kind of the specifics of DCE for the purpose of this presentation. I'm happy to talk about it in the Q&A or after. But kind of for the purpose of the new method, DCE relies on some embedded structure that we're going to try to avoid and be transparent about the assumptions. And then I'll call out throughout the presentation where we're able to do different things than DCE is in the implementation itself. So the new method is focused around 4 contributions. The first is identification. So what we find is the tax gap is not identified just by variation in examiner skill or examiner recoveries. That variation in examiner skill identifies a frontier. And you need an additional assumption in order to identify a point along that frontier. The second contribution is estimation. So we want to efficiently extract signal while regularizing noisy estimates, and that noise comes from 2 sources. One, the returns that the examiners are looking at are different from each other, and so the amount of noncompliance we'd expect is going to be different. And also, examiners do very few NRP returns, or at least many do very few returns. And so we want to be able to regularize for both those sources of noise when we estimate relative skill. The third is integration. The method that we're going to propose fits nicely into the existing IRS frameworks, and so it's going to leverage things like AI Select, or in any other setting where investment has gone into creating a risk model, we can use that and then further investments in that risk model carry through directly into the performance of our model. And then last, we'll produce uncertainty estimates, which kind of existing methods often don't do. Okay, so for this talk, I'll go quickly through the identification framework just to build intuition, and I'll talk about the estimator that we propose. We'll look at simulation results where we see the ground truth, and then I'll show you the application to IRS data and end by talking about kind of the extensions that are currently in the works and implications for design of audit programs. Okay, so let's think about the identification. So we're going to build intuition by thinking about 2 examiners, examiner 1 and 2, who audit a set of tax returns, and we'll use A bar as the average adjustment found by each examiner, subscripted by J. Let's just assume that examiner 1 finds more than examiner 2. And if A bar 0 is the true average adjustment, then the detection rate of each examiner is just going to be the amount that they find on average over the true amount on average, and that'll be D. D will tell us how much we need to scale up each examiner's determination. So if D equals 100%, then the examiner's average determination is correct, and we don't need to scale them at all. If D is 50%, then we scale them up by 2. And that scaling is done by theta hat. Now, unfortunately, we don't observe D because we don't observe the true average adjustment. What we are able to estimate is the relative difference between 2 examiners. So we don't see that one examiner gets 50%, but we can say that one examiner gets twice as much as another examiner. And the question is, what can we do with that? Because if one examiner gets twice as much as examiner 2, that's consistent with an infinite set of points along our frontier. That frontier would look like this. And so on the y-axis here, I have the detection ability of any referent examiner. And on the x-axis, I have the underreporting estimate that comes out of that. And so if the referent examiner collects 100%, then we know how to scale everybody else up relative to that. If the reference examiner collects only 50%, again, we know how to scale them up. What's important is pinning down that reference examiner. How do we pin them down? Well, we can anchor them using a few different possibilities. The first is if we know something specific about that examiner. And so this J star who we want to anchor, if we know that their relative rate is 75%, or sorry, if we know that their rate of recovery is 75%, then we know how to scale everyone up to them. We might know that specific information by re-auditing the returns or by looking at appeals data, right? There might be other sources of data that we can bring in to pin down that reference examiner. Absent that other data, we can make an assumption about the best examiner or some examiner in the distribution. And so we might say that the examiner who has the highest recoveries recovered all of the underreporting and then scale up accordingly. Or we might say that, in fact, the highest examiner needs to be scaled up more or was over-recovered, and we can pick a different point in the distribution. And if we don't want to make as strong of an assumption, we can take a partial identification approach. We'll have wider bounds, but then we only have to assume that an examiner in the distribution has a certain range of recoveries. So there's all these different options. For the purpose of this talk, we're just going to stick to the kind of baseline where we assume that the best examiner is the examiner who recovered the most after we kind of appropriately shrink for noisy estimates, and that they recovered 100%. But one of the extensions that we're working on right now is trying to pin that down in a more principled way. Okay. So we have our identification framework. Oh, I don't know what happened on that slide. Where we can, once we have these relative rates, we can anchor them and then have an estimate for the tax gap. Now we need the estimation procedure itself to get those relative rates. So we want from this procedure that we'll be able to efficiently extract signal from these noisy exams of very different returns. We want to be able to regularize the estimates for examiners with free returns, and we want to produce these uncertainty quantifications. And so that leads us to a Bayesian model where we model each examiner relative to predictions and not the raw adjustments. The reason we do that is that we can take these predictions that capture a lot of the differences in the returns themselves. And so you can imagine that two different returns that have very different amounts of underreporting, we want to compare the examiner's performance on those two different returns. Well, if we have a prediction model that captures a lot of the differences of the returns other than the examiner who did the examination, we can evaluate each examiner relative to that prediction. And so that gives us this new framing, which is how do examiners perform relative to the expectations, where the expectations can capture a lot of the differences. In the IRS context, of course, we're going to use AI select as a baseline and evaluate examiners relative to that. How does that look? Well, we have the f of xi, which is the prediction from AI select or whatever prediction model we're using. The AI observed is the adjustment that examiner found for the return. And the difference between those relative to the prediction is going to be the relative detection rate observed by that examiner on that return, which will denote RI observed. So if RI observed is 0, right, then the examiner found exactly what was predicted. If RI is 0.5, then we can scale up the prediction by 50%. So we can ignore the math on the left and focus on the figure on the right, just to give intuition for how the estimation procedure happens in this Bayesian model. So in the middle, we have these RI observed. Those are going to be observed for each return. That's why it's indexed by I, and that's the relative rate that the examiner found for that return relative to the prediction. Those will come from a distribution for each examiner, indexed by J, and that distribution will be with mean, gamma, and variance sigma squared. And so that distribution will be estimated as the relative rates that examiner found on the returns that they examined. Those gamma J's will be drawn from a distribution that's population-wide with mean mu and variance tau squared. And so so the mu is going to be the average performance of an examiner, and tau squared will tell us how different are the examiners from each other in reality. We're going to have uninformative priors on mu and tau squared. In the paper, we test the robustness to different priors, which is kind of the key choice of the researcher in Bayesian models. And we find consistent results across priors, and so we stick with the uninformative one. What the model does then is shrinks the estimates that we observe for each examiner on each exam, and it shrinks it in desirable ways. So we'll get more shrinkage on an observation if that examiner had fewer exams. We'll get more shrinkage if that examiner's results are more diffuse, and we'll have more shrinkage towards the mean of examiner performance if we observe less variation between examiners. So the kind of the intuition to have here is we'll have noise from the exams, we'll have noise because examiners will perform few exams. In both those cases, we'll learn less from that examiner, and those will be less likely to drive kind of overall results. Okay, let me show you. Oh, and then one more thing. So then, then we'll be able to estimate these gamma J's. We'll identify the best examiner, in this case by taking the maximum gamma J after the shrinkage occurs and setting that person equal to 1. But in the paper, we also discuss using a percentile or the partial identification approach. And then we'll report these posterior estimates. Okay, let me show you some simulation results. So in the simulations are kind of broadly calibrated to the IRS setting. We'll have 100 examiners performing different exams, and we'll vary a few features. So the first feature that will vary is the data generating process for the returns themselves. So when we think about a population of audits, we think about a large mass at 0 and then a long tail. And so that we have a few different ways of creating that distribution. One is by following the data generating process of DCE, that's assumed within the model. And the second is a Tweedy distribution, which some of you may be familiar with. It's a compound Poisson gamma distribution, and it has the exact same desirable features, but doesn't kind of match the structural assumptions of DCE. And then we'll vary how much heterogeneity there is in examiner skill and ask how do different models perform in these different settings. So I'll show you a few of those results here. The rest are in the paper. So on the left, I'm plotting the root mean squared error and the bias for both the relative rate estimator, the model we're proposing, and DCE under the first 3 scenarios. So the 2 bars on the left for each of those series of 4 bars are going to be root mean squared error, and the 2 bars on the right are bias. And so you can see in scenario 1, where we assume the DCE data generating process, and we have high variance between examiners, both models perform pretty similarly. The relative rate model has slightly less root mean squared error, slightly higher bias. But as soon as the data generating assumptions of DCE are violated by going to the Tweedy model, the root mean squared error and bias of DCE explodes. Ours kind of remains pretty robust. And just to be clear, the relative rate estimator does not assume Tweedy. It doesn't assume DCE, right? We're modeling relative to the predictions. And so we're able to be more robust to the underlying distributions. The place where the relative rate model struggles relative to DCE is when there's little difference in skill between the examiners. And so that's scenario 3. And so when we look at the results in IRS, we're going to be keeping an eye for kind of how much variation we actually observe between examiners. We'll find that what we observe in the IRS context is higher than what we assume for the high variance case. And so we're not worried about this low variance case for our setting, but it's something to keep in mind if taking this to other settings, that if there's in fact no variation between examiner recoveries, this model might be less appropriate. On the right, I'm plotting the coverage rates. You can see that, again, only in the situation where we have low variance between examiners do we drop below 95% coverage. Okay, let me show you this in the IRS data. So we use NRP examinations from 2006 to 2014, about 100,000 exams completed by just under 5,000 examiners. The key variables we're looking at are the tax change determined by the examiner. That'll be our outcome. And we'll have the prediction from AI Select, which we'll calibrate. Just a few notes about the implementation here. The way we set up the relative rate, it's a ratio relative to the prediction of AI Select. And so we might be concerned that if that prediction gets really close to 0, the relative rate will blow up. And we'll create instability in the estimates. Now, I told you before that that the shrinkage procedure accounts for when there's a lot of variability in the relative rates in an examiner, or if that examiner has fewer examinations. And so we actually see that the extreme cases are brought down dramatically. And so we're not super worried about what this looks like given the current implementation. But if we want to implement this in the best way possible, we want a principled approach for how to deal with these these low prediction cases. And so there's a few different parameters that we're choosing that we can choose to do that. One is to set a floor for that denominator to make sure it doesn't get too close to 0. Another is to reweight by those predictions directly. And the third is to use percentiles if we think that that's going to be more sensitive to the weighting decisions. Right now, we're working on a principled way to choose those 3 jointly. For today, I'll just show you the results without those 3 parameter sets. So no floor, no reweighting, and no percentile. And so I want you to kind of see these results as preliminary for those reasons and others. But keep in mind that these are kind of decisions that have to be made during implementation. So I told you we're going to calibrate AI select predictions. That's because if we look on the left, we see that that AI select understates, so that's the red line, understates predictions at the high end of the income distribution. When we use a generalized additive model on the right, we're able to kind of correct for that bias and use the calibrated predictions. And what that means is when we roll out our model relative to DCE, we're able to lower the examiner inclusion dramatically. So DCE requires an examiner to have completed at least 25 NRP audits in order to be included as a separate examiner. We can lower that down to 2, which triples the number of individually identified examiners that can be used in the estimation. We also don't have to truncate outliers or do kind of any hand coding there. The model-based regularization handles those for us. We can incorporate negative adjustments instead of forcing them to 0, which is a non-trivial number of returns. And we integrate with AI select and then again kind of capture additional value that will be created when AI select is improved. And what we get is something that looks like this. So on the right, I'm plotting the posterior estimates for the tax gap. The dotted line, the dotted vertical line is the average observed adjustment of $3,200. When we scale when we scale those returns using the relative rate estimator, we find that the posterior mean is closer to $7,000, which implies a multiplier of about 2.2. So for every dollar that's recovered by an examiner, about every dollar is recovered by the average examiner, $1.2 is undiscovered. And when we look at those relative rates directly, so on the top, I'm plotting the raw estimates, and you can see how those get shrunk down. The size of the dot, which you can't really see on this slide, but you can see in the paper, is the number of returns that examiner performed. Those get shrunk down. And again, this is where we can look and ask, how much are we actually worried that the top estimated examiners are really driving this? Well, they're getting shrunk down considerably, particularly because they either have few examiners or they have a lot of variability in their returns. And I told you that we're seeing variation of higher than the high variation case, we're seeing a tau about 0.359. In the high variation case, we were assuming 0.3. And so we're pretty comfortable on that front. And I'll just close by telling you about the extension that I'm most excited about. The one advantage of this approach is it's very modular. And so if we think about another type of exams that these examiners are performing, and we want to ask, well, what can we learn from their relative performance on that type of exam? Let's call that other type of exam operational. We can ask, how does your performance on this type of exam relative to the other examiners who are performing that teach us something about your skill performing NRP exams? And we can do that without actually comparing NRP and operational audits directly, right? For all the concerns that Dan laid out, the risk selected, they focus on different issues. But your performance within that pool might be correlated to your performance within the NRP pool. And so in a situation where your number of NRP audits are coming down, but you still have a significant share of operational audits, we might be able to learn something about your relative skill. And we don't have to tell the model anything about the correlation. The model will estimate the correlation between those two and then borrow strength if it deems that there's something to learn. And so what I'm showing you here on the right is varying the correlation of skill between NRP and op audits on the x-axis. And on the y-axis, we have the average absolute bias. And so in the red, we have ignoring the operational audits, and in the blue, we have using the operational audits. And what we can see is even when there's no correlation between the two skill types, the model is not confused by it. There's no change in the bias. But as soon as you get above 0.6 or so correlation, the bias comes down significantly. And so in a time where NRP audits might be coming down, or we want to focus on issues that have fewer exams, we can borrow strength from places where we have it. And this is just simulation data. We're still working on the IRS implementation. Okay, and so let me just conclude. We proposed a new method in this paper that identifies a detection under reporting frontier to be transparent about the identification assumptions necessary. We estimate these relative detection rates while regularizing noise. We estimate the tax gap that comes with uncertainty measures, and we have these opportunities to extend the analysis using other types of examinations. Thank you so much.
Thank you, Thank you, Aviv. Our third presenter is David Splinter. The last two papers have talked about methodology design issues. David will talk about an application where he estimates the distribution of the U.S. tax gap.
Yeah, as Janet said, this is going to be a lot of results. So instead of words and equations, it's going to be a lot of pictures. So first, my colleagues Will Gorman and Jamie McGuire from JCT are co-authors, and they're here today. These are our own views and not those of the Joint Committee or any member of Congress. The paper is posted online. If you want to search for it, you should be able to find it. So our main results are pretty much in line with some prior estimates of how the tax gap is distributed over the income distribution. There we go. And so you can see there's a whole long literature of this. I think Jerry and Pat Langetig's paper is also kind of finding similar results, and that is that non-compliance rates, whether you're talking about the tax gap or underreporting of income, tend to be highest at the bottom of the distribution and then fall as you go up the income distribution. In contrast to these prior papers, these were looking at portions of the tax gap. We're going to look at the full tax gap, and we're going to do it for multiple periods, for 4 periods between 2006 and 2015. So this gives us a picture of how things have changed over time. We're going to show you that our estimates appear to be robust to considering differences with DCE and having high or less, more or less non-compliance at the bottom or top of the distribution. And then over time, what we're seeing is a pattern that low income non-compliance went up. That is, the low incomes became less compliant, while the top 1% became gradually more compliant. We also briefly are going to talk about an inverse correlation between overall compliance rates and audit rates, and just kind of what this might suggest as we think about policy. So I think you guys know the definitions by now. The gross tax gap is going to include all late paid taxes not paid on time. So this is, in our estimates, are going to include not just filers, but also non-filers, late taxes from corporations, estates, and underpayments. And then we'll also show some estimates for the net tax gap, which takes account of the late payments, including from audits. So this just shows our main results, and I'll go through step by step later about how we get these. So on the left is the bottom quintile, and on the right is the top 1%. These are ranked by true income. So this is using the NRP data, reported income plus detected income adjustments plus undetected income adjustments using a variation of DC that we'll describe. This also includes non-filers using a whole lot of information return data such that we can allocate them across the distribution. Now, the non-compliance rates here that we're showing you are the total tax gap for each of these income groups divided by their true tax, which is the taxes they paid on time plus their tax gap. You can see for the bottom quintile, the non-compliance rate is 38%. For the top 1%, it's 9%. So basically, we're seeing a non-compliance rate that's 4 times higher at the bottom than the very top. Okay, so how does this compare to prior findings? On the left, we have some evidence from the 1988 TCMP, that's the predecessor of the NRP, and this is just the detected adjustments by the auditors. And you can see here that broadly there's higher non-compliance rates for the low incomes, and then they fall for higher incomes. Now, for the other 3 papers, they're considering both detected and undetected non-compliance, so the non-compliance rate on average doubles. For the 2001 study, this is Johnson Slimrod, they're seeing a very high non-compliance rate for the bottom of the distribution, over 70%. For the latest 2 papers from Johns and from IRS, there's also very high non-compliance rates at the bottom. I left out the 100% non-compliance in the figure on the right. Now, what's going on here relative to our estimate of about 38% for the bottom, which is about half of what these estimates are saying, is we're including non-filers, and we're also including FICA payroll taxes. Now, that has really high compliance rates, so if you include payroll taxes, that's going to drive down the non-compliance at the bottom of the distribution. But unlike the Johnson Slimrod, we're not going to use the old kind of DCE simple multiplier, so we don't have this hump at the top of the distribution, and our results are going to look more like the more recent DCE method from the 2 Wright studies. Okay, so you know the background already. Operational audits are not random based on likelihood of non-compliance, whereas the random audit studies like the NRP are randomly selected, and they're going to be representative of all filers. And so this is the basis of all our estimates. These are going to include all changes by the auditors, even if there's accidental errors by the taxpayer, or if there's missing documents, or when there's kind of uncertainty about how to interpret the tax law. And so this is why the tax gap is much broader than just evasion. Evasion is only willful noncompliance, so it's a small subset. Okay, so what do the auditors find with their tax adjustments? Well, for 9% of returns, they find that there was overreported taxes, but these are usually not big adjustments in this case. About half of filers had no adjustment by the auditor, and 44% underreported their taxes. And among those, about a third of them had adjustments which increased their taxes by at least $100 or more. Okay, but just the detected amounts are not enough to get us to the full tax gap. We need to also account for undetected underreported income along the lines of what has been talked about with DCE already. So this is the idea among similar returns that DC is going to bring up the auditor adjustment to the largest adjustment within each of these kind of macro bins. What this does in the 2014 to 15 period is it basically doubles the underreported income detected by the auditors. So going from $500 billion of detected, it adds another $500 billion of undetected. So we have a total of $1 trillion misreporting. For taxes, it does a similar thing. It increases the $160 billion of detected underreported taxes and adds another $160 billion. Now, getting the distribution for this is not exactly what DC was made for. It was made to make an aggregate number. The old method was to apply 4 simple multipliers. That was the Johnson-Slimrod method. IRS has updated its method significantly and is in the process of updating again. The critique of this was basically that this method applied the same multiplier regardless of auditor skill, and that's counter to the intended application of the adjustment. So this is going to give you excess re-ranking of the income distribution, and it's going to give you kind of a biased picture of the distribution of the tax gap. So what we're doing in our estimates is we're going to try and account for this auditor effectiveness, but we don't have the auditor identities with the data that we have. And so we're going to start with the gradient multipliers from Otten and Splinter. And what these are trying to do is first they bin each tax return based on the amount of underreporting as a share of total reported income. And so if you had a smaller share of your income was detected by the auditor as being underreported, we're going to say that's probably a less effective auditor relative to somebody who detected a large share of your reported income. We're going to assign each of those gradient multipliers to each tax return, but then for each tax return, we're going to scale that multiplier up or down across about 20 lines, such that we hit the overall IRS implicit multipliers based on what they show publicly. And this is basically going to scale up wages and EITC just a very small amount. It's going to scale up the sole props by about, with a multiplier of about 2.4, and then the largest multipliers are for capital gains and pass-through business income, which is going to basically quadruple those or triple those amounts. Okay, again, this is not the IRS approach, but we are, for each of those sources, going to target their overall amount of misreported income. So how does our distribution compare to the 2014-15 IRS distribution? Our numbers are in gray. For the bottom 2 income groups, the under 50,000 and 50 to 100,000, we're allocating a bit less misreporting to those groups. So our non-compliance rates will be a little bit less than the IRS method would suggest. We're allocating a bit more to the 100 to 500,000 group, and we're right in line for the top 1%, which is basically 500,000 and over. Okay, I'll step you through this figure bit by bit. So this is basically the bottom 4 quintiles, again, ranked by true income on the left. The top quintile is broken up, and these are billions of dollars for the tax gap. So you add it all up, you'll get the whole tax gap. Now, starting at the bottom, this is the numbers that come directly from the NRP. These are the detected individual income tax adjustments by the auditors. And you can see that they're fairly evenly distributed over these groups. The next is the taxes that come out of our DCE method for undetected, underreported income. And this is the light oranges, and you can see those tend to be more at the top of the distribution. And this is because you get some upward re-ranking, and you also have those larger multipliers on capital income. Now, next is the other small part of the NRP, which is SECA taxes. That's the blue and light blue. And then the dark blue is going to be the other components that are usually left out of these distributional analyses. So now we take the FICA payroll tax gap total from the IRS estimates, and then we allocate it proportional to the taxes that were actually paid of that type. There's a lot of uncertainty about exactly what the distribution should be for this, as well as the other components that we're going to allocate. So the next is non-filers, And for non-filers, again, we're getting information returns. So we get a lot of people who are actually pretty high up in the distribution, even though they're non-filers. We're then going to allocate the total of the tax gap for non-filers proportional to the fiscal income of these non-filers. And so that's going to deduct Social Security and other items that are usually not taxed. And so you can see that while this is more at the bottom of the distribution, there's actually quite a bit of the non-filer tax gap in the middle of the distribution. For corporate taxes, again, we're taking the total aggregate amount from the IRS tax gap, and we're going to allocate it by the JCT method, so 25% to wages, 3/4 to capital ownership, and unsurprisingly, a lot of this goes to the top of the distribution. The underpayments are microdata links from the NRP to the enforcement data, and then estate taxes we give all to the top 1%. Okay. Now we're going to add some deductions below the x-axis to get us from the gross tax gap to the net tax gap. Again, with our links to the enforcement data, we're going to take away the late payments. These basically offset a large share of the underpayments in the gross tax gap. So a lot of those are at the top of the distribution. And then also audit payments we're going to deduct for the net. Okay, so far this is just showing you kind of the aggregate levels. But as Stephen Hamilton said, I want to see proportions too. So we're going to stack on top of this the taxes that people paid on time for each of these groups. And of course, we have a very progressive tax system, and so these taxes that are paid on time tend to be larger at the top of the distribution. So the gross tax gap for the top 1%, that's only 16% of the total tax gap, but they pay 27% of taxes paid on time. So when you divide the gross tax gap by their total true tax, you're going to get a non-compliance rate which is below the average for that group. For the second quintile, in contrast, they have 7% of the tax gap, but they only pay 2% of taxes on time. So they're going to be above the average non-compliance rate. Okay, so now we're just going to do that simple division, and we're going to show you what the non-compliance rates look like for these 8 groups. So again, we have the 38% for the bottom quintile, 9% for the top quintile, and then we've got some more income groups here shown. So what is driving this overall pattern, and especially what's driving this kind of bottom 2 quintile really high non-compliance rates? Well, as you see from the other papers, the underreporting rate of income tends to be highest at the bottom of the distribution and then falls as you go up the distribution. And that's really what's driving this, difference of having higher non-compliance rates at the bottom and then lower non-compliance rates at the top. Now, for the bottom 2 quintiles, there's a couple offsetting factors that are pretty interesting. So obviously, they have a lower tax burden because of our progressive tax rate system. So that lowers their non-compliance relative to their underreporting rate. But then that's offset almost completely by their larger claiming of refundable tax credits, which have an above average non-compliance rate. And so those two things kind of offset it, and you get this pattern. Okay, so we're going to do 3 sensitivity tests, and these basically show that these patterns are all fairly robust when you make these adjustments. So the first adjustment is kind of riffing off what Janet said in a paper with her colleagues, and that is that the DCE comes from the auditor with the largest adjustments, but that's not necessarily the most accurate adjustment. And so what happens if you get rid of DCE? I think this is a pretty good question to ask because most developed countries don't actually use DCE for their tax caps. And in other Anglo countries, the tax caps range from 6 to 11%, but ours is well above that at 15%. If you take out the DCE, then we're more in line with those other estimates. So that's why you always need to be wary when you're doing these kind of international comparisons. So besides lowering the level when you get rid of DCE, it also kind of tilts the non-compliance rates towards being higher at the bottom relative to the top. It's especially, the sole props and pass-throughs that have these high DCE multipliers that are going to see the reductions in the top quintile. Okay, what about adding more high-income non-compliance? So we, going off what Guyton et al. Have suggested, we add some offshore income, failure to pay taxes. This is right after the beginning of FATCA, so we kind of take half of their estimate. It's unclear exactly how much we want to add. This increases the top non-compliance rate 0.5 percentage point. We also add $20 billion in pass-through taxes for S corps and partnerships. That also increases at 0.5 percentage point. But overall, not much of a change when you add these 2 sources. Okay, what about adding low-income non-compliance that's missing from the tax gap? Well, first we try and change our assumptions that are unclear for some of the distributions, the corporate taxes, FICA, and estate taxes. Those have really negligible effects. What does have a big effect is if you add some things that are explicitly excluded from the tax cap, and that is nannies and ag workers. If you add them, then that's going to significantly increase the bottom quintile noncompliance rate. And also if you add credit noncompliance due to double claimed kids, which is also basically missing from the NRP. This is going to increase it from 38 to about 46%. Okay, so how have things evolved over time? So here we're basically applying essentially the same methodology across 4 different tax gap estimates. And what we're doing here is we're targeting the official IRS tax gap totals for each of the kind of sets, those groups of sources of the tax gap. And then we're using the NRP data for that period. Now, what you can see for the bottom quintiles, there was a big jump from 2006 to 2008 to 10. So of course there was the Great Recession, but this was a persistent jump. And so one other explanation may be the expansion of refundable tax credits for the EITC in particular, but also I think the CTC was expanded in that period too. For the middle of the distribution, you kind of have this up and down shape, which might be due to a business cycle. For the top of the distribution, it's kind of a continuous decline in noncompliance rates over time. And we're not really sure where this is coming from, but it looks like it's just kind of a broad-based decline across various sources. Okay, so one of the things when people think about the tax gap is they usually jump to thinking about audits and who we need to audit more, who we need to audit less. One thing that jumped out at us is if you look at the overall compliance rate between 2001 and 2015, you have this kind of U-shaped curve. But audit rates follow an inverse U-shaped curve. And so they actually have an almost perfectly inverse correlation. And so what's really interesting here is especially the jump up to an 87% compliance rate in 2015. That's way above the kind of long run historical average. I mean, we've been doing tax gaps for about 50 years. And so it really raises the question, what's going on in those years, especially as audit rates are falling? This is kind of speculative, but some ideas that I think really need some follow-up research is the effect of increased third-party information reporting for example, from 1099Ks, from capital gains basis on 1099Bs, all the FATCA kind of changes. Also, the changes in electronic filing are really important. Basically, we went from about half of people filing their individual tax returns to almost 100% e-filing in recent years. And also, the modernized e-file system may have also really helped increase compliance on the front end of the system. And then one thing, kind of after seeing Mike Udell's presentation, what's the pattern of notices? What's the pattern of other kind of non-audit enforcement kind of activities? Did they increase over this period? Did they become more targeted? So in conclusion, we're using the NRP microdata and various multipliers to estimate the distribution of the tax gap from 2006 to 2015. Overall, we have pretty similar findings from the IRS. In 2015, the bottom quintile noncompliance rate was 4 times higher than the top 1%. This is robust to alternative assumptions. And between 2006 and 2015, this ratio between the bottom and the top increased from 2 to 4. So basically, the bottom of the distribution got slightly more non-compliant, while the top became more compliant. Overall, looking at this literature, there's been this large emphasis on audits. So we tend to think in the literature, audits are overrated, especially if you consider that they only account for about 0.3% of all taxes paid in this period. And also we have this inverse correlation of compliance rates and audits. On the other hand, it'd be really nice to know more about information returns, e-filing, IT, notices, and how all these other kind of inputs might be affecting the compliance rate.
Thank you, David. And next, to close out the day, we have John Eastland. He's an economist at the Congressional Budget Office in the Tax Analysis Division. This is also a homecoming for John, who cut his teeth here at Tax Policy Center.
Yeah, so it's very sweet for me. 11 years ago, this was the first academic conference I ever went to. So this is a nice little homecoming for me. Before I can get into that, the normal disclaimers apply here. These are my views and not those of the Congressional Budget Office. I want to say, first of all, it's really cool to be back, to be able to do this, to be on the other side of the stage after a while. Very exciting. It's also really exciting to be able to talk about 3 really great papers about an important subject, the tax gap. And because people have done a great job describing the different components, I think I can skip the first slide that I had prepared that is entirely unnecessary and get straight on to kind of walking through what I think each of these papers is trying to do and is adding. The first paper presented by Dan is exploring a new methodology for estimating the underreporting tax gap, and is really important in the context of a shrinking NRP sample and declining ability to conduct audits, resource constraints. And so the idea, the proposed solution to both update their methodologies and think hard about how to incorporate other sources of information is really exciting. We then have this amazing paper presented by Aviv, thinking about how best to account for differences in auditor skill in estimating undetected reporting. The new Bayesian model they propose has really clear assumptions, which I very much appreciated, and the ability to see uncertainty estimates was great. And then finally, being presented by David and also made by his colleagues at JCT, we have the new estimates of the distribution of the tax gap. And the idea to be able to provide a comprehensive distributional measure of the tax gap is really exciting. To be able to see not just how much of tax evasion is happening, but who is it coming from, and what type of taxes are driving those changes. Plus, you have the additional component of considering the aggregate effects of auditors on tax compliance. I'm going to start with the paper presented by Dan. Just to restate, it's very clear that this paper, give me 2 seconds, provides a really wonderful outline for the development of new methodologies for estimating the tax gap. And I really appreciated the bullets that were on one of the slides, which is what are the things that are important to keep in mind here? You need to be able to understand the dependencies between these records, maintain the precision of older and larger NRPs, and aspire to the goal of constructing standard errors, doing this by bringing new information and combined with new methodologies. Some things about this paper I really want to call out. I really appreciated seeing the evolution of thinking about different methods, what worked, what didn't. And as someone who's reading this and also thinking about these issues as well, it's great to think, oh, that's why this might not be the right way to go about it. It's even more important work in the context of potential future changes in the NRP. And I really appreciated, as someone who doesn't touch the NRP data myself, to be able to statistics about how the NRP sample is changing over time. In terms of some overarching comments, and I think this is clearly a project that is ongoing, I think it could really benefit from a very clear, potentially mathematical statement at the beginning of the problem that is being caused by smaller and risk-weighted NRP samples. And this could be, to some degree, and I think that part of this came from me trying to think through what is the goal of binning? What is the goal of reweighting in this setting? Is it just an issue of precision? Are there other issues going on? But if it is one of precision, you are going to have fewer returns for particular subgroups. Clearly stating that and showing the connection would be really useful, i.e., smaller samples decrease precision. The NRP redesign means that decrease in precision happens at particular points in the income distribution or for particular returns. It sets up potential for a clear statement about how a particular method might improve or not improve the particular problem. Further, incorporating this new information, prior year audits, partial audits, and non-random audits seems to reflect a fundamental trade-off between getting new information and increasing precision and inducing new forms of bias or complexity. And I think with a clear statement of the problem in part one, you can create evaluation methods for determining whether these trade-offs are worth it. It also might allow you to pull in cases where similar problems have been faced in other settings. One thought that occurred to me is whether or not you could create a process of systematically estimating these trade-offs using existing prior year audits. So borrowing from some just basic machine learning setups, could you use prior year NRP cycles, randomly select those cycles, create a sample that's reweighted to look like a new smaller NRP, and then use a leave one out methodology to try to figure out whether or not the trade-off is worth it in any particular situation. This approach likely would work better in my mind for non-random audits rather than prior year audits, mainly because the years where you have these continuous NRPs are before the Tax Cuts and Jobs Act and other major legislative changes that might influence this decision making. Two other smaller comments. The first is it's really exciting to think about incorporating new information into the NRP because it might allow you to think about cases, particularly entity-level audits, where the NRP might not be able to capture everything. If you're including new information, could those components be included as well? And then this was explicitly mentioned in the paper, but I think it's worth calling out that at each of these steps, considering how these changes might interact with the assumed random assignment of auditors that is implicit in TCE. The next paper, presented by Aviv, I really appreciated it. It was developing new methods for estimating the average true adjustment when different auditors have different abilities, building clearly on DCE by introducing a model, and again, loved the introduction on one of these slides. It can calculate an average adjustment per examiner. It can and that is used based on the assumption of random assignment of auditors. It then can summarize the potential set of tax gaps given a range of different assumptions regarding the reference examiner, which I absolutely loved, and coming straight out of that, you have a range of different ways to get potential uncertainty estimates. I thought the clear framework and assumptions here were really great. I thought it was wonderful that you could include a much larger sample of auditors. I love the idea of uncertainty estimates. And I also really appreciate in the context of resource constraints in the future, being able to think really creatively about where is the best place to spend an additional dollar. Is the best dollar spent getting an additional auditor or hiring another person to audit the auditors in some sense? Where do you actually get the most bang for your buck? I have 4 basic comments about this paper. The first is I'm curious about how sensitive is the approach to the choice of machine learning model you use. And this is less about what is the best model, but also in what I'm expecting to happen over the next next decade is there's going to be a lot of work in building out and developing these models, improving on what's already there, building new things. And if one of the inputs of these models will be these sorts of estimation strategies, does that change what type of models we want? Are there different trade-offs to consider? And it'd be really interesting to know what those trade-offs are and how best to think about it. The second, and this is, I think, maybe a potentially technical point, is I'm trying to understand the relationship between adjustment sizes and the shrinkage estimator. So this equation I have up here is just the equation for shrinkage, where the kappa term kind of captures to what degree you're going to trust the overall mean skill level versus the skill level captured from a particular auditor's behavior. And the basic logic, one part of the logic here is that if you have fewer exams for a particular auditor, you're going to have a larger kappa, which is going to translate to less information being pulled from that particular examiner. This makes a lot of sense in a lot of settings that if you have with less information, you have more uncertainty about this particular examiner. However, I was curious whether or not there are any reasons in this setting that particular returns with fewer exams might be systematically more likely to have larger or smaller adjustments. And therefore, what could be interpreted as noise is actually signal because of some systematic reason. 2 examples of why that might be the case is if audits of complex returns or returns that are larger with potentially larger adjustments take more time and expertise. The second is that if an auditor with a lower skill level might take more time to conduct a particular audit. So one question I have is if there's any way to evaluate or show that for these groups of auditors, many of whom are newly added into the sample because they have relatively few audits, do have some sort of, whether or not the randomization assumption holds for those particular groups. So one way to do this would be to look across characteristics of returns from the returns themselves by the number of audits per auditors. Third, and this is connectedly, I'm curious how the results vary with different cutoffs for the minimum number of exams that could be used. Many exams are included that are being excluded from the DCE, which is I get excited about because more data is great. But it would be really interesting to isolate what is being driven here by the changes in methodology versus the changes in the sample. So, you use the cutoff of 2, I think is what you use now, but you could also go up to 10 to 25, which is what DCE uses, showing how the results vary in that way. I also think to connect this with the first paper in the session, it would be really interesting to see how sensitive is this approach to changes in the NRP sample, i.e. if the idea is to use this methodology going forward, it would be great to estimate basically taking the your sample, pulling random samples to resemble the redesigned NRP, and then seeing if this methodology continues to perform as well and is in the same settings. The final paper of this session was presented by David, looks at who evades taxes and the distribution of the tax gap. So as I said before, this paper develops a structure for estimating the distribution of the entire tax gap over time. And it builds on a previous literature by both changing the estimation of undetected underreporting by this combination of gradient multipliers and the IRS multipliers. And it adds in multiple other tax gap components, non-filers, corporate, et cetera. And I think this bringing together this range of tools is really exciting. I really appreciated the ability to see step by step how this distribution is constructed. I liked the ability to compare the distribution over time, and the idea of being able to actually directly pull out the drivers of both overall shifts in the distribution and changes in the distribution was really exciting. I think I have 3 basic comments on this paper. The first is whether, I'm curious about what the interaction is between the gradient multipliers and the IRS multipliers. So both of these multipliers, as I understand it, are based on related but different assumptions. The gradient multiplier is based on where the particular taxpayer's adjustment, which is a function for the auditor's skill, sits in the distribution. The second is aggregate return type accuracy. And I'm curious how these two types of multipliers interact. If auditorability as measured in the DCE is a function of return type, i.e. the way that the DCE is working, particular types of returns are more likely to be tagged as higher or lower skill, would there be a double counting issue here where some amount for some particular taxpayer is being scaled up or down by DCE and then further being scaled up or down by that same type of return? I think you could show this by plotting the share of undetected evasion with just the gradient, like the share of overall dollars with the gradient multiplier, the IRS multiplier, and then both, which I think would be an extension of figure 5 in your paper. And then this leads to a related question, which is how do these multipliers change over time? Which is, as you might imagine, that contained, I don't have a strong prior on whether or not they would be, but thinking through those changes over time would be an interesting approach. Difficult with data availability, but it might get at some interesting dynamics here. The second comment is that I actually thought one of the most interesting, my favorite figure in the thing was the one where you actually saw the stacked amounts by income group, which I thought was incredibly illustrative for me. But one of the most interesting ones as well was the change in the bottom of the income distribution non-compliance between 2006 and 2008. And David, you are exactly right that I think there were 2 changes over that period in refundable tax credits. The first was the expansion of the EITC to for those with 3+ kids, but also the drop in the refundability threshold for the child tax credit. It would be great to see whether or not the gap, that the change in that is reasonably explained by the increase in the generosity of those refundable tax credits, i.e. what degree of compliance would we need? Because the other thing that I was trying to wrestle with about the that measure at the bottom of the income distribution is whether or not how likely it is that a change in the denominator, i.e. The amount of true taxes owed, whether or not that would be variable enough at low incomes to cause there just to be more variation in that particular bin. The simple example here would be if the Great Recession caused average incomes in the bottom quintile to drop by some amount, whether or not that would translate to a larger reduction in the denominator or a change in the denominator relative to the numerator that might explain to this shock. Which gets to my second larger point, which is it would be really interesting to see how sensitive this measure is at different parts of the income distribution to random income perturbations. Basically, whether or not the different parts of the income distribution should implicitly in my head have different error bars around them because of potential changes in the denominator or the numerator. It's also possible to explain the tax gap to basically examine this just by a couple additional figures, looking at the breaking out of the source of the tax gap over time for just the bottom few quintiles, or comparing returns with or without the EITC or CTC. The final point is on the time series patterns of compliance you showed, and I think they really do contain some useful information. Understanding the overall trends in compliance and audits over time is really useful. However, I think the claim that audits are overrated seems strong relative to this evidence. There's a lot of recent academic work, of which you do cite in your paper, that shows that high rates of that audits, particularly audits of high income taxpayers, can have very high rates of return. And there are alternative explanations, mismeasurements of the tax gap, lag structures, confounding economic factors, the fact that the ability to conduct an audit might vary in some important way over time through IRS resources, might complicate any causal claim. My personal take is that audits are a low probability event that can produce large returns, the effect of which might be currently being lost in larger macro trends. But the point of trying to figure out where is the best place to put additional dollars of resources between expanding efforts for information returns to building out audits is an active question that's worthy of debate. Thank you all.
Thank you, John. Thank you, John. Before we open up for questions, and we have some really interesting ones coming in, I just want to turn to our presenters, and I know you all want to thank John for his comments, but beyond the opportunity of thanking him, is there any points to which you would like to respond to knock him down?
First, I guess, I mean, I think they were actually very useful comments, and they're, you know, I think we've struggled a little bit with, I think, the trade-offs issue that he, you know, kind of mentioned in terms of, you know, we may be introducing bias with some of the introduction of prior year audits and non-NRP audits, and kind of figuring out how we, you know, the gain and precision is worth that. And I actually want to talk to him a little bit more about his ideas about how to evaluate some of those choices, because that I think is also something, you know, that we've, you know, struggled with as well. And then I guess since I'm also a co-author on Aviv's paper, I just wanted to say one of the huge advantages of the approach that they're putting together is its sensitivity to almost any assumption that you make is so dramatically less than I think what the previous DCE model was. And that's really, I think sometimes we have a little bit of an over-reliance on the magic of Bayesian shrinkage, but there is a lot of magic there that is very useful. And I appreciate this. It brings me back to when I was working for NBA teams, and some of the models that we used there used Bayesian shrinkage models. So we've had a lot of discussions of NBA, you know, models in our discussions about their model.
Dan, it always comes back to your experience working for the NBA.
Always. Yeah, I would respond to just a few things. First, I will thank you because those are great comments. On the point about the predictions, I think that the proliferation and kind of focus on ML prediction models makes a modular method that fits on top of that even more valuable. Like I don't see that as a trade-off. I think that we'll have more precise estimates of what we would expect to find in a return, and thus be better calibrated to estimate the relative, or like the value add of an examiner. On the point about when shrinkage might be undesirable, I think it's a reasonable thing to say, you know, like this was a complicated return, so we gave it to our most experienced examiner. They only did one NRP. It's a bummer that we're going to shrink from that person. But you know, on the other side, we wouldn't want to extrapolate too much from a single return sent to a single examiner. And where we can kind of undo some of that is by using something like operational audits to learn about that examiner, and then have to shrink less because we can borrow strength. And then your third point, which I have a plot on, but didn't have time. About where to draw the threshold for how many exams per examiner to include. It's a really good point. We find that in simulations, at least, when we experiment kind of with where we draw the threshold from where DCE draws it to 25, a lot of the returns are kind of in between 25 and 10, and then it plateaus, and maybe even you introduce some bias by allowing people with 2 returns. And so I think that's an implementation decision of like maybe you want to set the threshold at 5, but you certainly want to set it below 25.
David looks happy.
Great comments.
Okay, so we've gotten some comments here, some questions. Several of them are for Aviv. I'm trying to figure out whether I can consolidate them, but I don't think fast enough. But at least 3 of these questions have to deal with the examiners. So question number 1, was there consideration for tenure and how that correlates with skill of conducting audits and examinations? And there's a follow-up question to that, which is, with the assumption, and I don't think we have to assume, with the assumption that there has been a meaningful brain drain from IRS of the most tenured cohort of examiners, would that impact the best case that you peg everything else to?
Yeah, really good question. So on the first piece, we don't do anything explicitly about examiner tenure. The model looks at the returns that the examiners find, but I see that as a validation, right? We can after the fact then compare people's estimated relative rates or estimated skills and compare that to things that we know about the examiner. We know very little about the examiners. We have GS level, and then we can impute something about experience just from within the sample we have. But obviously, IRS has more, and so that is on the list to do that kind of validation. On the point of the brain drain, hard to answer that. When you lose, if you're going to lose the top examiners, perhaps you have reason to say then the top examiner that's left needs to be scaled up. It wouldn't be appropriate to set their relative skill rate to 1 or their skill rate to 1. Maybe you'd want to set it to 0.75 if you had a disciplined way of doing that. I think the advantage of the frontier is it forces you to be transparent about what that assumption is. But I don't have a principled way of setting it.
Okay. The second question dealing with the examiners was this person's understanding is that examiners are not randomly assigned to cases, which threatens identification and older new methods for identifying undetected underreporting. Is this a potential concern, or did she miss something about the newer method? Can you do some tests for selection bias using observed examiner characteristics?
Yeah, it's a really good point, which I should have mentioned. We do assume random assignment. There is reason to believe that it doesn't hold. DCE also relies on random assignment, and so doing validations to ask how much selection we might see is important and is on the list. And then kind of the next step is if you see a lot of selection within examiners, the other option is to ask questions about aggregation. So we could aggregate examiners to a group, or we would worry about less about selection into a group. So there's a bunch of things on the list, but randomization is a necessary assumption for the method as it stands.
And so question number 3 about the examiners, and they all kind of fit together nicely. Is there concern that an equation which can measure tax examiners against a best optimal case may result in goal-seeking behavior among examiners and/or a policy of quotas, which may degrade the integrity of the typical exam process? Being able to specifically quantify an individual examiner's ability to, I'll put the quoted amounts in, earn the IRS's money would seem to be very impactful to IRS examiner evaluations.
Yeah, so I think there's a few things happening in that question.
Yeah, there is.
There's the incentive of examiners and kind of like what their incentives are and how they're evaluated, which I can't really speak to. I mean, the method that we have compares examiners to the expectation, to the prediction, which won't be known to the examiner because we calibrate ex post, and the examiners are anonymous to us. So I don't think an examiner would get any convoluted incentives from this other than knowing that, we'll be curious when they find more than was expected to be found.
I knew you'd have something to say.
Examiners, like even their evaluations are not tied to what their adjustment levels or any, they're certainly not tied to the kind of this relative rate measure. I think the sense GAO has actually pushed us a little bit to try to use some of this information that we're learning about examiners to help, maybe improve, what they're doing in general. But I think it's going to be at a more higher level than at an individual level that, incentivizes examiners to maybe over-adjust, or anything like that. So I don't think there's a lot of danger there. To be honest, I don't think there's probably a single examiner that even knows about our DC adjustments or certainly this new methodology. So, it's not really feasible that it would actually have any kind of effect.
Although there's always the question of the parking ticket quota, whether there's just an incentive to find adjustments and if that's what's being captured.
But I think the tax gap is so secondary relative to recoveries, for the examiner. I mean, I'm not in their shoes, but that would be my guess.
All right, so for David, we have a question from our friend Eric Toder. He asks, when TPC, us, and other groups analyze the distribution of legislative tax cuts, they usually emphasize as a metric the distribution of tax changes as a percentage of after-tax income, not as a percentage of taxes paid. So we do report that also. If you view taxes avoided as a form of a self-directed tax cut, what is the distribution of taxes avoided as a share of after-tax income by income group? I'm sure you have those numbers in your pocket.
Yeah, so that measure that TPC likes is a measure of redistribution that changes the available resources with after-tax income. That contrasts to proportional kind of view, which is kind of like tax progressivity. So I did a tax progressivity estimate for this paper, and we found that there's been about a 6 percentage point jump in the Kakwani index, which is the typical measure of tax progressivity over this period. The non-compliance explains about one of those points. So basically, the kind of shifting of non-compliance to the bottom of the distribution has helped tax progressivity go up about 15-16% more than otherwise. That's a different question than what he asked, but we have not done the...
That's the way they do it. That's the way to do it. Okay. Well, at this point, we are at 4:30 hour, and I want to thank our panelists. This was a great discussion. And next up on the schedule to say goodbye to all of us and thank you is Riza, who will end.
Was that kind of embedded with your...
Okay, we are at the end of the hour. I think this has been a fabulous day. I want to thank all of you for attending. I want to thank all of the authors, all of the presenters, moderators, and discussants for a very complete and very engaging conversation today. I want to thank Alan for the keynote, and also I want to thank Robert and Leah and everybody else from Tax Policy Center for a lot of the logistics and making today such a great success for all of us. Thank you very much. See you all.